Real Estate Investment Summit, brought to you by ET Edge, which is part of the Economic Times. This summit is one of the many efforts by the Times Group to promote national growth by recognizing the developments in the sector and by bringing together key stakeholders to meet, mingle, deliberate, discuss, and strategize the way ahead towards wholesome growth. Ladies and gentlemen, as we start the summit, it's my pleasure to welcome the business head, Times Conferences Limited, to of course set the tone and to formally welcome you. Ladies and gentlemen, please welcome Sunita Quadras.
Thank you, Elric. Good morning, ladies and gentlemen. It's a pleasure for me to be here in the midst of leaders who've contributed and boosted the growth of real estate in India. India is poised to become the third largest market by 2020. And for all of us here, we know that it has gone through its own shares of highs and lows. But through it all, what we've consistently managed to do is attract investors and global business houses. So this is in fact encouraging for all of us. And this has resulted in an influx of investments across varied verticals and sectors. And that stands true for the real estate sector as well. As per a FICCI report, the sector has been growing for roughly around 20%. And for investors, the sector has in fact, the Indian real estate market has yielded far better returns than other global markets. India today is amongst the top 20 favored investment destinations. And that says a lot, I think, for all of us. This investor interest has been fueled by varied reforms. So while there are certain clarifications and clarity that's required over the reforms, but generally we do find that reforms like FDI, 100% FDI, reduction of capitalization in wholly owned subsidiaries and JVs have kind of helped the sector. We've received investments to a tune of $3.4 billion in 2012, and that's huge. But at the same time, so while all of this presents a very positive outlook, industry leaders have an alternate view, and we all know that the challenges the industry is facing with policy challenges are predominantly on most of our minds. But the other challenge, the other critical challenge that the industry faces is about lack of availability or lack of funds. And this challenge is actually even further fueled by the fact that we have higher interest rates or depreciating currency. And all of this ensures that, investors as well as stakeholders adopt a very cautious approach. So the question for us here today is that the real estate market is lucrative for investors, but at the same time, we are still grappling, the industry is grappling with so many financial challenges. And for us, I think the biggest question all of us are asking ourselves here is, will the future bring in a tide of change? And that's a question I would like to leave it to be answered by experts here today. In fact, the objective of this forum is to bring together leaders who through their experience, through their so many years of experience, would bring in deliberations and perhaps chart a way forward. I now formally open this day for a series of discussions, and I do hope all of you present here have an insightful day. Thank you.
Thank you, Sunita, for that warm welcome and for setting the tone of the event. Thank you so much. Ladies and gentlemen, we do have a packed program. I do apologize for the about 10-minute delay, and I do request, of course, all our presenters and speakers to help us maintain the time. For two reasons. One, of course, all of you have very busy schedules, and we don't want to delay you or have you miss out on any of the important deliberations that we have from this podium. And secondly, also, since for the benefit of the larger audience, this will also be broadcast. So to keep within broadcast parameters, we have to stick within time, and we have a few other parameters we must follow. One of them being, of course, that while you're in the hall, please ensure that all your mobiles, connected devices are on silent so you can get the best out of these presentations. And while you're in the hall, please remain seated at all times. And for logistics purposes, do wear your delegate badges prominently displayed. Ladies and gentlemen, as we start off with the opening remarks, we are very pleased to have with us a gentleman of immense stature. As he steps up on stage, I'd also like to thank the organizations that have made this summit possible. Most importantly, of course, our silver partner, the MMR Group, our associate partners, who include Arihant Superstructures and HDFC Realty, our knowledge partner, Jones Lang LaSalle, our supporting partners, FIFA, that is the Federation of Independent Financial Advisors, and AIBI, which is the Association of Investment Bankers of India. Ladies and gentlemen, at this India Retail Investment Summit, Real Estate Investment Summit 2014. It's a pleasure to have the opening remarks by a gentleman with a wealth of experience. He is the board member, Asia Pacific Real Estate Association, vice chairman of the British Chamber of Commerce, Hong Kong. He brings to this dais an experience of over 2 decades in real estate, construction, hotel, and investment fund clients, covering everything from IPOs to due diligence to mergers and acquisitions to significant projects, ad hoc projects, you name it. He's had experience in it. He is the China Board and Executive Committee member for KPMG. Ladies and gentlemen, please welcome Regional Senior Partner, KPMG Hong Kong, and the Global Chair, Real Estate and Construction, KPMG. Ladies and gentlemen, Andrew Weir.
Sorry, do you mind?
Clicker, left, right. You can point the clicker.
Yeah. Okay. Good morning, ladies and gentlemen. Excuse me for a bit of a technical hitch there. Can I just check the slides can actually be seen? Can it be seen? Yeah, okay, thank you. It is a great pleasure to be here, and thank you very much for the kind invitation. My role in life is the global chairman of a real estate practice at KPMG. I see so many esteemed leaders in the business community, and a big thank you to the organisers of the event and all the sponsors and partners. What I thought I would do is just share with you, with my global hat on, a few themes I am seeing in the world of real estate, and that this vibrant discussion. But let me just share you some of the themes I'm seeing with my hat on. And really it's a question of giving food for thought. There are 5 themes I'd like to share with you, and they're all interlinked, and hopefully this could give some perspective. Seen as bricks and mortar in one's own country, possibly in one's own city. It wasn't really seen as an asset class in its own right. And I think there's been massive changes in the last 10 years. I think 5 years ago, you could see that real estate is seen as a proper asset class. It is 10 years ago, maybe even 10 years ago. The vast majority of our work was national. Now, much of our work is international and cross-border. And this slide here just shows you the scale of the direct commercial real estate and the growth. Final figures, which we're just updating, to be $563 billion US dollars. That is direct commercial real estate. And that would have been a growth of 20% on the previous year. And that trend of growth is continuing. But there's a couple of points I'd like to share. The first is, still as an asset class, the big institutions of the world are under-allocating capital to real estate. Still, Asia, by global institutions, is under-allocated. So in Asia Pacific, you have a double whammy of an under-allocation to real estate in Asia. Secondly, there's so much capital around, the supply of investable real estate is the real issue. Despite there being 563 billion of business done on direct commercial real estate, the demand is for much more. There's much greater need than there is supply at the moment. On allocations, let me just share with you. Still, real estate is underallocated, but it's changing. I'll give you a couple of examples. The Canadian Pension Plan Investment Board allocated 4.3% to real estate in 2007 and has changed its allocation to 12% by 2012. The National Pension Plan of Korea now has a 10% allocation to real estate. Norwegian Sovereign Wealth Fund, 5%. The trend is increasing the allocation. But there's something just to bear in mind, a key point. For every 1% drop institutions have in their allocation to equities, that gives rise to a 7.8% increase in demand for investment holdings in real estate. So this inevitable rebasing of allocation of asset classes will give rise to very, very big demand for institutional grade real estate moving forward. So you've got real estate as a global asset class. The other big change you've seen in recent years is the global flow of capital. The volume of capital circulating in the world it really is remarkable. This slide from our friends at Jones Lang LaSalle just shows, in respect of the approximately $50 billion of capital raised as global funds, how it circulated through the world. And you can see from this, of the approximately 50 billion raised, which is the grey globe, 33 billion went to the US, 10 went to Europe, and 4 went to Asia. But look how it all circulates thereafter. A couple of trends to note. The trend now is for global fundraising. It's not just regional fundraising, it's not national, it's global fundraising. In the PE world, which is not represented in this slide, $101 billion of capital commitments were achieved in 2013, of which 33 billion was for global funds, 32 billion for the US. So 2/3 is global funds and US, with a heavy looking at debt advisory, debt restructuring, and opportunistic, more than the value-added equity fund approach. A third interesting statistic is the cross-border flows in 2013 on real estate were $113 billion. That is capital flowing from one region of the world to the other. And this cross-border flows of capital is a very important phenomena. In Europe alone, 25% of the total commercial real estate investment in 2013 playing out. And my instincts are we're about to see probably a bit of a swing back towards capital coming to Asia, as some of the recent deals done in Europe and the States are seen as possibly being on the high end of the scale. A very good way of summarizing how much capital is out there is for every dollar of investable real estate, there is $7 of capital chasing it. So the message to the friends in the audience here is, globally, there's no shortage of capital. The real issue globally is supply of available assets. And I know in India this is a slightly different issue, but globally there is a glut of capital and liquidity. The third point I'd like to share is the trends of population and urbanization. And if this slide does look a bit lopsided, don't worry, you haven't been having a drink first thing in the morning. It is actually the map of the world in 2050, updated for the changes in population from now to then. And you can see how remarkably small certain parts of Europe are becoming. In 2011, ASPAC, Asia Pacific, accounted for 27% of the world's population. By 2031, it will be 50%. by 2050, according to the UN, 67% of the world's population will be outside Europe and North America. A third of the population will be in India and China. That's the population side. Then you've got the whole demographic side with the age of population, etc., urbanization, all the infrastructure-related developments going on. The whole population urbanization story for the long term is something which is very, very important in the considerations. And the very smart investors are those who can harness these trends and then access the capital, which I mentioned earlier. There's two other points I'd like to share. Transparency. In the Western world, everybody talks about transparency. Some of the very professional real estate groups have their transparency indices. These tend to be looked at through the lens of a Western investor, where there is regarded as a direct link between transparency, cost of capital, cost of financing, etc. But what I'd like to say is I've been based in Hong Kong for 20 years. I'm based in Asia. And there's a wonderful Chinese expression, may you catch a fish in muddy water, which means transparency is all very good. But if you know how to navigate through the market yourself, you can actually do some very good deals. And there's some very good examples in Asia. Vietnam, for a number of years, was lowest in the transparency index. But Japanese investors, Korean investors, Malaysian and Singapore investors, until recently had done very well there. At the moment, Indonesia, to an international investor, creates some concern in terms of transparency. But a lot of canny Asian investors, a lot of canny Chinese investors are doing very well, thankfully, on that. So this transparency, is it, it'd be interesting to see what the panel thinks, there's a balance on how far one goes on transparency. A certain amount of transparency definitely is necessary for the markets to work well. And that judgment on what balance to have, I think, is very, very important. Linked to that is how sophisticated real estate markets are. I know there's a lot of talk about REITs in India. I think REITs bring a lot of transparency, but they also bring liquidity. They bring professional management. But most importantly, they bring an ordered way in which investors can exit properties. And I think REITs are a very, very important part of the transparency discussion. But the fifth theme I'd like to raise with you is government and regulation. There's a couple of key points here. Government as a regulator in terms of control and policies is a big theme at the moment. You've got central bank involvement in how much can be lent to the real estate sector. I mean, that is an issue in India. It's an issue in China. It's an issue in other markets. You've got Basel III and the knock-on effect of all the real estate funds and how bank capital is deployed. But you've also got tax. And tax, I know in India and other countries, real estate is quite heavily taxed at different levels, multiple taxation. But tax as a use of a public policy is also an important trend. Who would have thought 2 years ago that Hong Kong and Singapore would bring in stamp duty, double stamp duty and prohibitive levels of stamp duty in order to cool two markets which were regarded as pretty free markets? But they have been brought in. So this use of stamp duty and tax as a way of addressing market conditions, I think, is here for quite a while. What's very interesting in Singapore and Hong Kong is that whilst it may have slowed down transactions, valuations haven't come down. And you've now got pent-up demand because there's so much liquidity, as I said at the beginning. You've got pent-up demand to do the deals. But you've got to be a very keen if you're prepared to pay 24% stamp duty on a property. It's got to mean a lot to you. But this use of policy and the impact of policy on real estate is a big theme which I think is going to carry on. I see there's a lot of progress in India on the land pooling and also on the resettlement and rehabilitation, on the REITs and also on the mutual funds. There's a lot of progress. My instinct is it's very important that one quickly gets to progress on the REIT legislation over the next year, so that the markets outside and the investors outside can see it's very meaningful, this step forward. And a very good reference point would be Singapore. A less good reference point would be Hong Kong. The way Singapore has been able to use the REIT market to develop its capital market and its real estate market is very, very impressive. And it's enabled the ability to upgrade on the whole management of real estate. I think one has to be careful then on regulation. I know you have the new real estate authorities coming in. The challenge, of course, is that they bring facilitation into the market, as opposed to another layer of regulation and another layer of bureaucracy. So I think the use of regulators in order to facilitate market development is very important. So look, these are the 5 themes. Really, anybody who thinks that real estate is not a standalone asset class, I think my advice would be to think again. Secondly, it really is a global asset class. Thirdly, there's huge amounts of capital floating around globally looking to invest in real estate, whilst it being recognized that still the allocation of capital is underweight. Then the whole issue of transparency and how to get the right balance in order to get the right market. It's not as straightforward as the Western world of believing full transparency is the right way to go. Then harnessing the full demographic and population story in this part of the world, which means it's often about cities, it's often about new precincts, it's about new development concepts, not just buildings. And then finally, trying to get regulations not to hinder the development of a market, but to facilitate it. Anybody who's able to bring those full 5 things together will end up a very wealthy man. So those are the big themes I see. Just some final comments on India. I'm hugely impressed on the potential. Outside India, rather similar, I'm based in Hong Kong and China. Outside India, it's like outside China. The press at the moment isn't hugely positive about the real estate market and the investment, and have found it quite hard to invest, get the approvals, complete, sell, and exit. Now, obviously, one doesn't want international investors to come in, make a quick buck and leave. It's all about commitment to the market. But there is a sentiment out there that it's become very hard to get things off the ground and done. And because there's so many opportunistic deals back in Europe and in the States, China, India, and a few other markets in Asia have been put a bit on the back burner. So I think one of the challenges is, on the assumption, it looks like there might be a change in government coming through, and it looks like the pro-business agenda may be more at the forefront. My instincts, from what I hear outside India, is there's a lot of optimism that if a few big legislative changes can come through in the next 6 to 9 months, and if this pro-business mentality and mindset can prevail, that there's quite a lot of capital stored up waiting to come into India, but just wants to find a more facilitated way to enter the market. So I think there's still a lot of potential there. So there's some food for thought. Hopefully the panel can digest it and probably destruct everything I said, but I hope that gives you a bit of insight to some of the things we're seeing globally. Thank you.
May I please request Sunita Quadras to step forward, business head, Times Conferences, and present Andrew Weir with a memento. Thank you, Mr. Weir, for being with us here, making it so very special, having a great opening session, setting this day in good stead. Thank you, Mr. Weir. Thank you, Ms. Quadras. Well, ladies and gentlemen, after that great opening remarks, it's time to move on to the first panel. This panel discussion is titled Tide of Change, Perception or Reality. We do have eminent personalities on the panel, and this panel is going to be moderated by a gentleman who knows just about everything that there is to know in the industry in India and abroad. I'd like to invite them one by one. I'd request the moderator, of course, to first take his place on the dais. That would be in the center position. And then I'll call on the panelists one by one. They will be mic'd, and we'll check the mic, and then I'd request the moderator to continue with the discussion. Before, of course, we start the discussion, once again, towards the end of the discussion, if we do have time at the discretion of the moderator, there could be question and answers from the audience, at which time we request you to please stand up. A mic will come around. You can identify yourself, then ask the question. Also to remind our moderator and speakers that we're running very short on time, so at about a few minutes remaining, so that enough time to wind up, about 3 or 4 minutes before wind-up time, there will be some indication, a bell or an alarm will ring. That give the speakers and the moderators an indication that we're about to wind up. Ladies and gentlemen, a gentleman whose career is on the up and is definitely never going to wind up in an industry that does not see a downturn. He's a gentleman who's responsible for the overall direction, the strategy, the growth of the largest premier real estate services company in India. He has over 23 years' experience of multidisciplinary areas in advisory and transaction, ranging from real estate to social development projects. He is truly an acknowledged expert. Ladies and gentlemen, our moderator for this session, please welcome CEO and country head Jones Lang LaSalle, Anuj Puri. Sir. The middle seat, please. Anuj's panel are a wealth of very experienced leaders in the industry. We have Chairman and Managing Director, Rustomjee Group, Boman Irani. So. Thank you for being with us. One of the young first-generation entrepreneurs creating a great name for himself and his company. But of course, Anuj will be speaking about all the panelists in detail in a short while. Joining Mr. Boman on the dais, we do have the CEO and Managing Director of ASK Group, Sunil Rohokare. And now Director, Kotak Realty Fund, Vikas Chimakurti, my apologies, Vikas Chimakurti. On stage, please also welcome the Managing Director, Shriram Properties, M. Murali. And ladies and gentlemen, rounding up the panel, partner Khaitan & Co., Siddharth Shah. After the eminent panelists have been mic'd up and the due checks have been done, it will be over to CEO and country head Jones Lang LaSalle, Anuj Puri, for this panel discussion, Tide of Change, Perception or Reality. As the miking process is being done, I request all of you who've walked in a little late, please ensure that your mobile's connected devices are on silent or buzzer mode. All yours, sir. Thank you.
Thank you very much. Good morning to everyone. Let me quickly reintroduce to my right is Murali from Shriram Properties. He's the Managing Director of Shriram Properties. Next to him is Sunil. Sunil is Managing Director of the ASK Group. To my immediate left is Boman, who is the Chairman and Managing Director of a very large real estate company that he's set up, and it's something that does deliver a lot on quality. Rustomjee. We've got then Vikas, who is Director with Kotak Realty, and then Siddharth, who is a partner with Khaitan & Co. We've got a very interesting topic this morning. Indian investment, is it going to be on the upswing or not really on the upswing? And if it is on the upswing, is this going to be a reality that we're going to see it go on the upswing, or is it only going to be a perception? And why I say is it's very interesting is, if you look at the figures that came out on real estate investments at a global level, there was about $560 billion of investments that were made in 2013 across the three regions, i.e. the Americas, Europe, Middle East, and the Asia Pacific. And out of that 560 billion, about 130 billion came into Asia Pacific, which was great news. That was 30% over 2012. So 2013 was a great year for real estate investments within Asia Pacific. But for India, out of that 130 billion, less than 1% came into India. So it was less than $1 billion that got really invested into India. You know, an economy which is a couple of $1 trillion with over 1 billion people, 1/6 of humanity stays in here, and we're saying out of the Asia Pac, the real estate investments that happened, less than 1% came into India. On the other hand, you pick up the newspaper, the stock market at its peak, the rupee has stabilized at 60, the fiscal deficit is narrowing, the inflation appears to be under control, so there is a lot of positivity, and that's why this is going to be a very interesting panel. That is this optimism going to really take place, or this is only a perception? And we equally know that the economy, real estate, and politics are pretty much interlinked, those three things, and that is what we are going to start with. And perhaps, Bowman, if I can kickstart that question with you. What do you think is the best possible outcome that we're going to get on the 16th of May? That's one. And the second is, how does that impact the real estate sentiment and the investment mood?
Great. Thanks, Anuj. On the 16th, I can speak about the entire business community that we represent is looking for something called stability. Two things are going to happen. Whichever way, whatever government comes along, we're going to have a new prime minister. And whichever government comes into power, we'll have a new finance minister. My view is that people sitting on the sidelines have understood that housing has got to be something that's which is a crying need and has got to be addressed very, very like a war, almost on a war front. And I'm hopeful that the incumbent or the incoming prime minister as well as the finance minister, who are the two key, I would say, people or persons who would be able to decide the future, will understand this. I'm sure that there will be a lot of activity because we, as we heard Andrew speak before us, there's a lot of positive sentiment around the fact that people are going to see something new coming along. And with everything new as it happens, we expect positive changes to take place. Having said that, the last few years also, the government has tried to make the right moves towards getting housing addressed. They've not taken all the right steps, but they've decided to at least move in that direction. So we as MCHI CREDAI and as CREDAI National have been approaching the government time and again with papers to kind of put across to them, to give them the idea as to what housing can do just to the GDP. As such, we are also, housing and infrastructure is the second largest employer after only agriculture in this country. So when you look at all of this and the statements that you made, I was just doing, I was looking at it as an opportunity. If only 1% of all the Asia Pac money has come in over here, can you imagine what is possible in the coming years? And if you take that 1% of the Asia Pac and you look at the world's investment, if India can really shine, which is what we all hope it will, I believe that we will have the floodgates opened up and we'll have the same issue that we had the last time, too much money chasing too little development, and developers might again have to be reined in or understand, but this time around most of us who've been through the last cycle at least would be wearing our hats on tight and working properly rather than just going crazy.
Interesting point, which Bowman says, Sunil, and just carrying on that conversation, with less than 1% that is coming into India from the total Asia Pac investment in real estate, that is a big opportunity. What do you think we need to do at the platform level within the real estate, whether it's the government or the developers or the regulator or the investors? What does need to happen to get more than 1% coming into India?
Okay, I think the point here is that the world investors are looking at demand and supply for real estate. And they are giving a color of the capital which actually takes the risk on either demand side or a supply side, or the risk which is an opportunistic risk. As far as India is concerned, demand is given. We are driven by domestic economy. No foreigners can come here and buy real estate like what you see in Dubai. So we have more people, less livable homes. So demand is given. What's important is supply. So the real estate industry today, the biggest challenge is supply. How does supply get constrained? Is the fundamental question this new government has to deal with. A, approvals. B, changing policy regime. C, the rationality to increase the governance in the asset class. So it's very important that global investors are looking at A, ease of entering in, ease of going out, ease of investment, ease of execution, ease of selling and exiting. So I think it's important. It's a local subject. Real estate is a local subject here. It makes things a little complicated, but it's not impossible. So that's A part. B part is, let's understand real estate is not a short-term asset class. Real estate is fundamentally an asset class which is a long-term asset class, not even medium-term asset class. So I'm personally very, very positive. With the new government coming in, the stability and the confidence coming back probably will change the mindset of the pent-up demand, which is sitting on fence for a long period of time, expecting something miracle to happen. Either A, property prices to come down, which may not be the reality, but property prices not going up for a few years itself is a reduction in the property prices. Okay. Second, the interest rate to come down, inflation has to come down, and their income level becomes stable and start growing up. So I think I feel the global investors at this point of time is looking at predictable entry, the quality and quantity of the returns returning back to the Indian real estate is a function of how does we facilitate the supply side of the story, how do we facilitate by virtue of, as Anuj has already mentioned, one fundamental change India has taken, and it's a very, very bold step to my mind, is the real estate regulatory bill. What SEBI did to, what SEBI did to the capital market, what the IRDA, the insurance regulator, do to insurance industry only grew. Its survival of fittest will come into picture. More governance will bring in more capital. Ease of operations will be much more easier. My sense is that we may find a hiccup in the early years of the real estate regulatory bill, but that probably will give utter confidence to the industry. To my mind, the real estate industry is nothing but the end customer, period. Investors is not real estate industry. If they consume, if they buy, developer get flourished, the investor get flourished. There could be few people will diversify into real estate as an investment asset class, but that is too small in India. And there are too few people who probably are the investors in bulk, managing their own portfolios in real estate. So I clearly feel the real estate regulatory bill is a fundamental bold step by the Indian government and the state of Maharashtra, and subsequently all the states will take it. The second part is the land regulatory bill, which was one of the biggest hurdle we have ever seen, that you enter into an asset class of a potentially 200 acre of land, but you have no idea whether you will do 200. Whether that 200 will ever have contiguity. The 200 will ever have the same sellable FSIs and fundamentally zoning what you have thought of. Those are the uncertainties, and then you are not doing gambling. So real estate in India, apparently not gambling, but was giving a feeling that you are doing gambling. Okay, I think foreign investors do not want this day and age, and apparently looking like you are taking a risk. They are taking a demand-supply risk. They are not taking a risk of uncertainty. So that's what I think the new government probably will be looking at.
Thank you. Moving on, Murli, you've had some very successful relationship with several private equity funds, and most of them are international private equity funds. And then we heard Andrew speak, and Bowman confirmed that there was a huge amount of money that came into India and is going to look at India again once the stability comes in from the period sort of 2006 to 2008 or 9. But then something went wrong. And I don't know what went wrong. There could be several reasons. But can you tell us 2 or 3 foremost reasons? And whether that was lack of transparency in real estate, developers messing up with the private equity investors not understanding the Indian real estate landscape, lack of policy decision. What went wrong? I think it is important for us to understand what went wrong in that first phase so that we don't repeat that same mistakes when there is stability that comes in the government.
Good question. Instead of looking at what went wrong, what is going to be wrong in the near-term future is a good question to address. I see good government is likely to come into this country. Probably people have developed a lot of expectation from the new government and from the new Prime Minister. If at all the 272 mark happens, the expectation is going to be totally different. And generally people believe that there is going to be a huge boom. So that could be one first wrong step is my sense. The second one...
and sorry, why do you say it is a wrong step?
272 is a good step. Boom is going to be a wrong step. We have seen in the past, our real estate developers, why it went wrong or why it is going to be wrong once again is my concern, is that governance. I don't think any bill is going to change you unless and otherwise you change yourself. Ahmedabad is one typical example. Governance, probably we could expect same thing could happen in All India level, possibly. One structural change which has happened in Ahmedabad, for example, if you take a lift, there is a lift inspector. He said, I don't want any lift inspector. You regulate yourself, but punishment will be in case there is a failure on lift. The society or the person who is managing that area will be given 3 times the punishment if there is no inspector. All of them have agreed, and you regulate yourself. See, that is a situation we need to move in. Probably that's a situation we need to, this government will take us to the next level is my view. It's not probably real estate bill. I don't think real estate bill will be in the same form is my view. Looking at the mindset of the new government which is going to come in, probably they may take you into confidence in total and expect you to govern yourself in a much better way, which unfortunately some of my developer colleagues are not used to, and that will be one major challenge.
So when the boom comes in, the governance will drop.
At that time, governance could drop to a major level, unless and otherwise we know how to govern ourselves, which has not been the case. If you look at the industries in the last 10 years which has grown, or post-liberalization which has grown, the industries which are not well governed or which are not, which are moderately governed, whether it is IT or biotech or any industry which has gone up in the last 20 years, which has grown in India, which is all not, tightly governed. So governance from the government is not going to make you better. Governance within is going to make you better. That's what has happened in IT industry. Probably real estate, if that happens, things will be better. The other scenario what I worry is that, again, supply is going to be big money when the capital is chasing you. Prices will drop. Again, our real estate developers are not used to, including private equity investors, are not used to having anything less than particular growth year on year, month on month, quarter on quarter. So unless you take a long-term view and are willing to play the game, you are going to be in trouble. Prices will come down is my view when there is a supply going up. It's like, any industry, even software what you bought, you are not buying, the upgraded software at the same price. The tiles what you bought, you are not buying at the same price. Here also there is a possibility when the supply level increases. There was a good example in one of the cities where we are operating. There was a chief minister, he said, I need to have bullock carts go in the highway. While you are talking about good cars to go on the highway, I need to accommodate that also. That was the best period for supply and demand mismatch. It was almost zero. Whatever supplied, what was absorbed. I do not know whether that's the right situation, whether that you call that as a best governance, because they stopped all the approvals. 2 years there was no approval at all. What happened? Whatever you were supplied was absorbed in the market. Now the situation is going to be when you are given freedom. Supply is going to be too much. How developers and private equity guys are going to deal with that is a question. It's a challenging time ahead and good time to be in it.
Absolutely. I'm going to come back to that point, Bowman, but let me, Vikas, pick up one interesting feature that we've seen in the recent 12-24 months, and Kotak's been pretty much involved in that, is a number of the foreign institutional funds are saying is playing in the Indian real estate market on the development is too risky. yes, we have expectations of 20% plus IRR, but at the same time, there hasn't been really a certainty that people have been able to deliver 20% IRR. We want to go into core income yielding assets, buy offices which are already rented so that we get a firm visibility to a certain return. Do you think this is something that is going to get a lot more money coming into India? One, and there are 3 points to that. Second, what next? Because at some stage, the supply of core income yielding assets is going to go away. And third, because what is the exit of these core funds?
See, in terms of interest of international LPs, do they perceive significant amount of risk on the development? The answer is yes, which neither the developer nor the private equity investor is ever able to thumb the table and say that the approvals are going to come at such and such time period of time. One of the issues which happened in 2006, 2007, where the developers assumed that the approvals are going to come in 6 months, but in reality, depending upon the geography in which we were operating, it moved from 2 years to as much as 3 years, right? So which actually reduced the return significantly, which became a bone of contention between the private equity investors and the developers. So because of that, what has happened is that most of the large institutional investors are saying that we would not prefer to play an equity model. We would prefer to play a debt model where we may not shoot 25-30% kind of an IRRs, but is there a certainty where one is going ahead and playing a credit model where one can make around 20%. That's one trend which one is seeing from large institutional investors, pension funds, etc. Now, with respect to whether there's a demand for core properties, some of the large private equity investors went ahead and aggregated a decent amount of portfolio over the last 12 to 24 months. Now the question which is being asked by most of the large LPs is that, is there enough FDI compliant assets which are available for us to go ahead and deploy capital, and is there a decent amount of capital which can be deployed? And if the supply is, if the availability of the assets is actually lower, will it actually lead to a cap rate compression, which means you're not making those kinds of returns which people made last 12 to 24 months. That's a big dilemma which most of the people are facing at this point of time. So which would in effect reduce the amount of capital which is going to chase those assets? The answer is potentially yes. Until unless government comes up with a regulation where they say that now we are not restricting FDI only into IT SEZs or IT parks, foreign capital is allowed even in any ready-built commercial property, right? I think that should be the next logical step which the government should be taking in. See, there is actually a capital which is available, which is happy making 13 to 14% return on a lower risk. And that capital, once it's available, potentially developers could go ahead and liquidate their portfolio, which is going ahead, is not going to generate that kind of an incremental IRR. It's potentially to get rid of that capital and potentially get that capital and invest in more development assets which could potentially generate higher IRRs. That's one logical step which the government should be taking in, and as one has seen liberalization which has happened over the last 10 to 12 years, is that something which government would do? Government would potentially do that, right? That's one. Second is, where is the exit route which is possible for it? The exit route is potentially could be once the REIT regulations are enacted, not just what SEBI is doing, but government should, Ministry of Finance should come up with tax regulations where potentially the DDT is something which is removed, like in any other country where there is no dividend distribution tax, which you are in effect getting investors who could potentially have a yield play. As somebody was mentioning, in gold, the total savings of Indians which is there is upwards of $1 trillion, right? Why is gold attracting a lot of retail investors? Primarily because it's perceived to be inflation hedge, right? People can go ahead and buy gold, somebody can buy for 10,000, 20,000, 30,000. But can somebody do that in real estate? The answer is clearly no, right? What are the avenues where you can go ahead and deploy capital in real estate? The smallest one is residential apartments, which could be anywhere be 20 to 30 lakhs, right? How many of the people can do a systematic investment plan in gold? If potentially REITs were opened up and you could potentially attract retail investors who could, let's say, invest $1 lakh, if it's listed, buy like any stock market where stocks you are buying, and you are getting yield and potentially playing a capital gains appreciation, which you can do even with a lower capital deployment, which potentially we believe that there would be a huge demand which would come from retail investors, and that could be one way which would be exit for large institutional investors who are going ahead and aggregating commercial real estate, and for developers themselves to directly go ahead and sell their assets to a REIT.
But because we're then saying is that today there is not an exit available. We're saying is that the expectation is that there will be a REIT type structure that is going to come in, and that's when the exit is going to happen for all the core assets.
Yeah, exit is available for somebody, let's say, who has a large portfolio of commercial assets. Like, let's say today Blackstone, can it potentially REIT its assets? Yes, the answer is yes. But somebody who's having 2-3 million square feet, can he do it? The answer is no.
Got it. So that very interesting points, and you know, maybe a little bit divergent views that are coming in. But let me ask you 2 or 3 things. One, you know, you deal with a lot of foreign institutional funds. And with the rupee, the way that it has played from 2006 or 7, when a lot of the investment came in, to where it is today, how do these guys view the foreign institutional investors? That's one. And do they really hedge the Indian rupee? Second, what are your thoughts of the REIT timing? And the third is, are you hearing from the government that they will liberalize FDI compliant assets to either a smaller size, or perhaps allow completed assets other than SEZ or IT parks for foreign investors to come in and buy? So those 3 things.
Sure. So I think just starting off on the first point with regard to the currency risk, and I think everyone sitting here across on the panel and in the audience here have realized that a big factor which really seems to have wiped off returns, not only for real estate, but every other alternate asset class, has been the currency. And that's a risk which I think foreign investors today have realized and recognized as far as investing in India is concerned. Whether that in itself is a risk which will deter them from looking at India in a longer run, maybe not. And at least the way we have been seeing LP interest in India, many of them do recognize the fact that India is no longer a short-term play. And if you see the quality of investors who are now looking at India, as compared to the initial investors who came in with a very short-term expectations, I think there is a very clear change that we have seen in the new set of investors looking at India, where they are willing to invest with a long-term perspective, which also in many sense helps them take a little more considered view on the currency, because you can probably factor in the volatility over a longer period of time and develop your strategies around hedging more appropriately to that extent. But having said that, are they all going out and hedging their risks? I don't think at this point we are seeing many of these LPs really going around for hedging, because one, the cost of hedging is itself prohibitively high, and the second is the lack of long-term hedging products available on the rupee. And I think that's really something which, so from an investor perspective, I think they look at India and the currency risk as something to be factored in their investment. And I think that's probably the approach that we are seeing them really looking at. We've also, I think, the other significant change, and in terms of the second point with regard to, do we see the regulators opening up the market? And I think that's one expectation from the industry, and I think what we are getting sense is with the new government, there is definitely a high likelihood of the opening up of the FDI sector. And there have been talks time and again, even in our existing government, about opening up and further liberalizing it. But with the lack of leadership in many sense to push these reforms through, I think we, hopefully with the new stable government, we should see the further liberalization on the FDI side of it. And to be very honest, I think if you really look at all forms of alternate asset class, and I think we heard Vikas and others talk about it, real estate is one asset class which has huge potential to absorb the kind of foreign capital which can flow in. And that in many sense also proves to be a hedge to an inflation or the credit side of the story. So real estate is definitely an asset class which the government is looking at from a long-term perspective for foreign investors. And we do hope at least my expectation, again, this is the fourth attempt at REIT, if you really go back into the history of the REIT regime in India. And it's always been further refined, and at least the last form of regulation was very comforting for the industry. There was enough consultation which had gone in, and I think almost everyone started gearing up for the REIT in terms of preparing themselves. And the only thing that was really holding it back was the tax concern. And honestly, I really don't see any fundamental reason why the government should not offer the pass-through, the tax pass-through, because it's really not giving up any right to tax. It's only giving them a more clear credit to the investors who are participating. So, and fundamentally, that's how it operates across the world. So, I'm pretty hopeful that we should see that happen possibly in the current financial year once the new government comes in.
That'll be great news for the Indian real estate industry. Just changing gears, Bowman, and coming back to you. And I'm going to ask you this question where you'll have to probably wear two hats. What should a fund look when they're investing in with a developer? And vice versa, what should a developer look into a fund when he is getting into a partnership with that fund?
Very simply, chemistry. Very simply, identified common goals. Very simply, a clear dialogue between the principals on both the sides as to where they are and where they expect to go. I think, it's the same when you go on a vacation, you're taking one of those rides in one of those parks. You wouldn't go to a park which is like, not rated as safe or whatever. So I think the investors, when they come in and they're taking this entire ride, like everybody mentioned, the Indian landscape is all about taking a ride and some kind of gambling as well. Go with the best. Go with people who've got a proven track record. Go with people who have got the intent as well as the capability to kind of take you through the entire landscape itself. More importantly, go with people who have got a clear stated vision that is for everybody to see and they're consistent about it. Go with people who can communicate and the communication is in alignment with what they do and what they finally, what you read about them or what you know about them. And I think this applies, what is good for the goose is good for the gander. It goes for both. When I now look at, so when I first started looking at private equity, I was just very happy to see the face of the person across, and he spoke sweetly to me, and I knew that he had the money. And it was all very exciting. It was like the first time McDonald's opened in India, and everybody, just queued up outside. I was one of them. And then when Starbucks opened, it was not that I didn't want to taste it, but it was just that I was selective. I said, let a few days go by. Let's sift through the whole thing. So when I look at a real estate fund, I'm actually looking at the people who are behind it. I'm looking at what they can bring to the table other than just the money, because like Andrew mentioned, there's a lot of money chasing us, and in the Indian landscape, it comes through the unstructured finance, it comes through the structured debt finance, and there are always ways to do it. So I kind of look at the people who are there. I look at what are their stated goals, how much can I kind of understand and align myself with it. And that's how I make a choice. And of course, they've got to have the money, and they've got to have larger money, because I'd like to do repeat transactions. We want to reduce the number of relationships we maintain as we go along in life, because relationships take a lot of time. They take a lot of time to build, and you've got to be sure that where you're going or the partner you're going with is at another forum I mentioned, this is like an Indian marriage. Once you get in, you really don't want to get out, because it becomes very unhappy and the entire families get involved, and you have a whole lot of stuff flying around over the place. So yes, look for identifiable goals and go with it. And on the fund side, if I was wearing that hat, I'd really look at the intent and the capability of the developer more than return, which most of these guys are most harping on. And the return comes out of the fact that every time the government increases the taxes or there's a little bit of more murkiness in the water, the only way that my brethren on the fund side look at saving themselves is saying, let's up the IRR. It used to be 18, let's up it to 21. Oh, this is not good enough, let's go to 25. And we're safe. But that's really like, putting yourself in a bucket and trying to pull yourself up and hoping that, you'll reach the top of the well. It really doesn't work that way. So, yeah.
And just continuing, Murli mentioned about the risk if the market was to come back and it was to boom of lack of governance setting in within the developer community. Would you share that risk?
I don't think that's going to happen for a lot of reasons. One is we are wiser. The developers where we were, let's say, 7 years back are in a different state of mind and learning. I think we ourselves understand that we want to grow in a structured, I'm talking the good developers obviously, we want to grow in a structured, happy, safe environment. We want to see our balance sheets being healthy. We don't want to see too many litigations, so developers like us usually try and move away from as many litigations as possible. And I think on the fund side also, the immediate or the first euphoria of the gold rush has gone away. While India has that potential, and like we mentioned that 1%, if it goes up to only 3%, what the change could be, and if it goes up to 7%, what the change could be. I think on the fund side and on the money side also, people have gotten that much more smarter, they've gotten that much more choosy and picky, and opportunities have opened up that much more. So for instance, what is slated to happen in the next 20 years is that 130 new cities are supposed to come up in this Indian landscape. But developers are becoming more and more local. There are not going to be developers who will go out and bid across the country. And just because I've been offered a great piece of property in Bangalore or Delhi, I don't think I'm going to make a rush for it, which I did 7 years back, and I picked up properties which are still lying just as they were. So I wouldn't do that. I wouldn't think most of my developer friends would do that. And I don't think even the fund side would look at people who are just making these kind of crazy calls being someone that they will back.
Sunil, coming to you, we've seen some euphoria coming in to the marketplace and the sentiment of the business community, and you see a lot more sort of positivity when you're speaking with people over the last few weeks, and the thought is that we will have a stable, business-friendly government in place by mid-May. In expectation of that, are you seeing that there is more euphoria coming in from the retail investors to come back and invest in real estate as investment? And equally, are those retail investors willing to put their money into a fund?
Yeah, I think if you see post-global crisis 2008, the kind of money India received as an FDI, and the India could able to raise capital from Indians for Indian real estate. I think the story is completely that monies are available only in India from Indians for Indian real estate. And why is that? Actually, the people who probably have been hearing, seeing the woos around, everybody has a view on real estate in India as much as they have view on politics. So after every 5 minutes, we shift to either real estate or politics. That's India. Okay. So, given that situation, the local family offices, local HNIs and local ultra HNIs love Indian real estate. But probably their ability to hold direct real estate has been shrinking. Their ability to go through an organized structure, because it's no more commonsensical art of investing into real estate where you invest in 2002 and 2014 you made 6 times returns, irrespective of the location, irrespective of the developer, irrespective of the city, irrespective of the growth driver. 2014 is a new paradigm. This paradigm is the prices has been at different level. Indian economy is no more that economy which is at the cusp of growth. It started with that 4.5%, moved to 9.5%, again came back to 4.5%. But mind you, last time 4.5%, Prabhadevi was at 6,500 rupees a square foot. At today's 4,500, Prabhadevi is 45,000 rupees a square foot. That's the paradigm. Please understand. So I think the fundamental story is that instead of holding the asset directly at 45,000 rupees and thinking that 45,000 will become 90,000 rupees will be mirage. So what's fundamental? At 45,000, the developer organization is not doing charity. At 45,000, there is an EBITDA margin for a developer. Accessing that EBITDA margin at 45,000 is to be seen as a much better logic, so that you make your risk-adjusted returns, which may be 2.5 multiple in 3 to 5 years' time. That could be paradigm. But the second important thing that Indian ultra HNIs, I think they are the smartest of the investors, and as much they are ahead of the curve to the institutions, according to me. And that is globally also proved. The family office probably will move much quicker than the institutional investors. Probably they would like to wait and see the things happening. India substantially have changed paradigms. Developers after 2002 and 3 have taken a position. Either you will be national developer, you will be developer with lots of assets, you are asset, not asset light, but you are asset tight. You have chosen a path of taking too much of debt. You have taken a path of saying that I would like to be listed developer. You have taken a path of saying that I would like to do everything under the sun, right from residential to the office to hotel to retail to warehousing to 100-acre townships. It will take time to do the cleansing part of the story. The whole challenge at this point of time is the developer is no more the same developer what you have seen and met. Today, the developer has got his own introspection going on. I have to be regional. I have to be focused on development-oriented assets. I can hold income-yielding assets. What is my weighted average cost of capital? Is equity good? Is my balance sheet capitalized? Do I have equity on my balance sheet, or I always have survived on customer advances, or I have been happy with only debts because I am more confident about it? So fundamental debate happening in the developer organization. As a private equity investor, it may not be everybody is the best suit for you. As Bowman has rightly mentioned, there is a fundamental change in the fund management teams. It is a fundamental change in the developer side as well. The marriage is more important. My money is long-term and equity money. Developer is looking at maybe money, maybe debt or equity. Please ask him clearly. It's very, very important what stage of the whole catharsis happening at his organization, changing the organization so fast. It's very important for the next leg to happen, and that's probably the retail ultra HNIs are watching very selectively. Though last 3 years, everybody was trying to hide behind the garb of 18, 21%. I personally feel that one more change has happened in real estate is real estate returns have come down. The cost has gone up. There is no room to make an error. Inefficiencies are being punished. So I think ultra HNIs is definitely a great bet, no doubt about it. And you will see good capital will get raised for 14, 15 and 15, 16, not only domestic, but international as well.
And they've started coming out into the market now?
Yes.
So because you mentioned a very important point, Sunil, that the ultra HNIs or the retail investors are usually ahead of the curve.
Yep.
So if they have come out into the market and they are starting to look at real estate more favorably, either through a fund or directly, that does mean that there is going to be a lot more interest coming in from institutional funds within the real estate sector.
Absolutely. I clearly feel, look at last 9 months' time, look at the ADIA announcement, look at the CPPIB announcement for a manager accounts, look at the domestically how many of us are standing in a queue to get the new domestic fund approvals, look at the renewal interest of the offshore fund raising. So my sense is that stability of India and India's willingness to change and learn from the past and look forward for the positivity by any economic angle, it's a thumping, good, positive place. So there's no doubt about it. So from that point of view, I clearly feel that the opportunity is there for medium to long term. Short term, going up, going down, changes, liquidity, sales velocity slowed down. These are the part and parcel of the business.
Murli, coming to you, one point that we haven't yet touched is really the stock market. And since the time that many of the developers got listed in 2006 and 7, I think 90% of the wealth at the stock market has eroded. And this is particularly in contrast when we're saying on one hand the stock market at its highest ever, the Sensex is at its highest ever, and on the other hand we're looking at the data and we're saying is 89% of the wealth of the listed developers coming in from 2006 to 2013 has got eroded. So my question to you is, do you think that this market is going to open up to the developer community again?
It has to open out. There is no other option. Particularly, it's a very difficult question for us. We have 60% already of our company held by various investors. There are 4 large investors. We need to give them the exit. Hence, I wish it opens up. At the same time, why probably, people have failed in the listed companies have gone through difficult time. There are 2 things. One is internal, one is external. It is easy to address external because you are blaming somebody else. So, someone was saying, you keep pressing the voting machine, stock market going up. So, that's what is happening now. You keep on pressing the voting machine now, stock price is going up. There is no relevance of what are the fundamentals of the companies today or the stocks today. But stock market is in the last 1 month, probably May 18th, when there is a new Prime Minister possibly takes over with the full majority, could, probably you need to shut the stock market for 2 days. That could be the situation. Probably you are building a pressure, which is undue pressure, both to the industries and as well as to the customers. These are investors to be blamed for that. They are the one set trend for, how to value the transactions, how to give value of the company. They were the one pushing the developers. Developers also to be blamed, because you need to have some sense of your own, what not to do. So you cannot be pushed by somebody else. Probably, as Bhavan said, few developers who were sensible in this country did not do that, land banking business and try to get valuation out of that. That was the first one. I recall one incident when the first investor came in for us. It was about 2007. He said, you are in the mid-market segment. You need to move up in the chain. Otherwise, you will not be even considered as a developer. We said, we don't know. We don't want to do anything other than mid-market housing. That's where we have got our DNA is lying, and that's where our core strength is. We have got, close to about 1 million customers from the group which is supporting in the mid-market segment. Hence, we would like to position here. No. Unless you do luxury housing, you will not be reckoned. 2 years later, when Lehman crisis happened, the same investor community came and said, I told you we need to be in mid-market segment and affordable housing. So this is what investors speak. I'm not saying there are good investors, there are moderately good investors, there are climatic investors. So I will not say bad investors. Investors never been bad, but either they are climatic or good. So the climatic investors come and say that you should have been in the mid-market and affordable housing. See, because of our advice, you stuck to it. Hence, you are safe. And you did not go all over the country. You stuck to your regional position where you are strong. So, good, when there is a success, everyone will take credit. But as a developer or as a receiver, you should pass on the credit, which is important, so that you buy peace. If you do not pass on the credit, you don't buy peace. So stock market, again, it all depends on how the valuation is going to be. If again there is a craze that is going to come up based on the land bank valuation, it's finished. If it is based on the capability, yes, there is a huge opportunity. See, people have failed. One is external factor. We looked at internal factor. People have not built the capability internally, and people are moving around all over rather than focusing on, you need to play the 6 balls. You need to play, if you have to, save the wicket and play the 6 balls, not taking a run. You need to do that. There is no point in becoming heroic and trying to hit a 6 when there is no necessity for you to do that. If you stay 6 balls, you win. You don't have to hit a 6. So that should not happen. That's what developers have done. Probably, staying focused where their core strengths are, where their DNA is, then they will be able to get.
If they were to do that, you think that there is investor interest that will come back?
Absolutely. Investor interest either way will come. Whether they do it or not, investors will make you corrupt. It is up to you to protect yourself. That's very, very important is my view. See, when country is opening up, when the whole sentiments are changing, when you feel that there is a next 10 years is going to be a stable, stability is going to be in this, not only real estate, every industry will go through a big cycle. Investors have no other option. They need to look at. And when India will be the lone player probably next 3-4 years until US go through the next 2 years elections, then if at all there is a revival, it's not only India. 2 years down the line elections in US, so they will slow down for the next 1 year. Then again it has to pick up. Some of the European countries are going through elections in the next 2 years. So China still they have a stable government. They are yet to come out of some of the problems what they have. When India alone shining, probably that's what we all wish. India alone shining in the next 2, 3, 4 years time. Investors have no other option. This 1%, 2% will run away. It will be 30% of whatever the capital available will chase. At that time, we developers, we need to look at what are our values.
Understood.
Just because 10 people are chasing you, you cannot betray your wife. You need to look at how I live with my wife and comfortably. These are all my core values of my family. This is how I live. We cannot get corrupted is my view. If we don't get corrupted,
I appreciate that.
Yeah. My only concern is that.
Anuj, can I just add that one should look at the stock market as something you go to with a value proposition, not because there is no option. So if I were to go to the stock market tomorrow, what I'd do is I'd slice and dice my company a little differently. I'd go into either the development game, which was then something where I had a factory kind of production line that came out with, let's say, X number of units, and then played in the 5 or 10% over there. B, I think I would be wise enough not to listen or not to be drawn in by the brightest light and the highest valuation, but go in for something again where my investor stays on. So it is more or less like doing a deal with a private equity fund as well, where both sides have got a stated expectation, which is very, very clear to both the sides. I think the stock market doesn't want to continually see fluctuations. They reward companies that continuously show some kind of growth, and I think that is what needs to be done. Not a company with a hodgepodge of all kinds of assets, because that is not a value proposition you're bringing across to. And you've seen one or two companies that are still there who've got a very good response from the stock market, and every single time they're out to raise more money, there's more money following them than they want to raise. So I think it's a value proposition for any investor, and especially the stock market, because that's where the smaller players come into play. Give them a value proposition, give them a certain amount of certainty, give them a game plan which they can see or know for the next 5-10 years for a company.
Yeah. Last two questions, Vikas, to you and to Siddharth. Vikas, first to you. There will be interest rate moderation at some stage. It cannot be the interest rates the way it is today. And if that moderation takes place, the yield on the core should start to come down. Do you think that is going to happen, and hence there is a rush from institutional core investors to buy today at 10 or 10.5 because they're hoping that this is going to become 8.5?
See, fundamentally, first, the core investors, what they are doing is that it is not significantly driven by if interest rates in India come down, because ultimately they need to make certain amount of return, right, which is benchmarked against what is required by their investors who are invested in that pension fund. Is there a fundamental thesis that they are thinking that there would be a yield compression? That's a fundamental thesis at which most of the people are going at and deploying capital in the core assets. But if you historically look at in India, at what cap rate have the HNIs been buying, right? Even if you were to look at 4 years or 5 years back when the interest rates were low, right, the cap rates at which the deals were happening were around 10 to 12%, right? We have not seen a correlation where interest rates actually moved up, the cap rates also at which the HNI investors were buying increased, right? It's basically the person who's selling has to agree to sell at a higher interest if the interest rates are high and selling at a higher cap rate. I don't know how much the cap rate compression is going to happen. Is there going to be 100, 150 basis points? Yes. But will it fall down to 5% or 6% cap rate? Time only will tell.
Interesting. So that, you have visibility of all the sort of sectors and the players that sit in within the real estate, whether it's, the developer or the investor or the government. What was your final word that we can expect in, say, 3 years' time, by which time, we would have a stable government which would have been running, for about 36 months, and we were sitting in 2017 at this time and reflecting back, where do you think this investment market would be?
No, I think in gazing into the future, and even in an environment that we operate in is obviously as difficult, but as an optimist, I would think the way the industry has evolved, and if you see the real estate industry 10 years back to what we are seeing today, a matured set of developers, a matured set of investors who've been through their pains in terms of learning about each other, knowing each other, and now talking about a marriage. I think I see a very strong positive development for the industry in 2017, and with the support from the government. I'm sure the government, if you really look back in time, I think many changes that we talked about have really helped in terms of facilitating this growth, the investor confidence, and I don't see any reason why that should not continue. And maybe, and just as an example, like a credit and a mezzanine structure 5 years back for India, that asset class never existed for investors. Today, you have a ample capital which is available across the entire capital spectrum. Equity, you've got mezzanine, credit, and possibly now with more institutional capital, REIT. I don't see a reason why we won't see a full-fledged developed real estate sector in any other developed market that we see. So I'm pretty optimistic on the sector.
Yeah, well, that's a good closing note. Siddharth saying is that he's optimistic over the next 3 years. I think the mood generally on the street is optimistic. I do hear myself a lot of the investor occupiers, developers, getting a lot more confident than what they were sort of end of last year. So it's been a very engaging discussion. I'll try and quickly sum it up. I think, Murli, your points were very interesting in the way that you put in, and I think that is very clear, reflective of the thought process that perhaps the developer community has. Introspect, and then it's not just the color of money or just the dollars. You need to look at it, what is the value that needs to be provided, and perhaps, when the boom comes in, is governance going to stack up the way that it should, or, is that going to get fractured again? Sunil, interesting on the retail investors coming into the market, because, clearly, as you said, that the retail investors are ahead of the curve. If they're coming in, that means, there is going to be not a bull run, but there is going to be some excitement coming into the market. I think, Bhuvan, interesting comments on the stock market, as well as the relationship and the marriage with the fund, expectation from both sides, alignment of interest, and looking at the personalities who are behind both sides, the developer as well as the fund. And I think gone are the days when it was just the money. I think now the maturity of the investor market and the understanding of the developer has come up, and there is more than just money that is going to be discussed. I think because interesting, I think is that you're going to see a lot more challenge on the core because there's going to be less of supply and there's going to be a fair amount of money that will start to chase. So unless the government liberalizes and allows the FDI, sort of non-FDI, to be picked up by foreign institutional funds, I think we're going to be having a challenge because there is going to be very little supply. And then if the yields start to compress to the levels of 5 or 6, I'm not so sure it's an exciting market for any overseas investor to come and play into India. And so thanks for closing it on an optimistic note. With that, I'll hand it over to you.
Thank you, Mr. Puri. This is a wonderful session, ladies and gentlemen. This panel has definitely blown away perceptions. What is the reality in the realty sector? Thank you so much. May I please request the moderator to present a memento to the panelists for being here, sharing the expertise. Starting off with the gentleman to your extreme right, the audience's extreme right, Siddharth Shah, partner, Khetan and Company. Thank you, sir. Moving on to Director, Kotak Realty Fund, Vikas Chimakurti. Chairman, Managing Director, Rastamji Group, Bhuvan Irani. Sunil Rohakale, CEO, Managing Director, ASK Group. Last but definitely not the least, Director, Shriram Properties, M. Murali. May I please request Business Head, Times Conferences Limited, to step up to the stage, Sunita Quadras, and present our moderator, Mr. Anuj Puri, Country Head, CEO, Jones Lang LaSalle, with memento. May I ask the panel for a memento photograph, along with Ms. Quadras? Ladies and gentlemen, we've had a great discussion, fantastic panel, lots of information and lots of views. You can now separate the perception from the reality in the realty sector thanks to this eminent panel. Mr. Puri also mentioned about the money markets. That's coming up in a short while from now, in 10 minutes from now, actually. So, ladies and gentlemen, a quick power break, and we'll see you in 10 with the next session, which is Decoding Private Equity Investments Past to Future. Another exciting session right here at India Real Estate Investment Summit 2014. Ladies and gentlemen, we'll see you back in 10. In case you need to bring in your cup of tea or coffee, feel free, come back again. We'll be starting on time. Thank you so much.
with the fund, expectation from both sides, alignment of interest, and looking at the personalities who are behind both sides, the developer as well as the fund. And I think gone are the days when it was just the money. I think now the maturity of the investor market and the understanding of the developer has come up, and there is more than just money that is going to be discussed. I think because interesting, I think is that you're going to see a lot more challenge on the core because there's going to be less of supply and there's going to be a fair amount of money that will start to chase. So unless the government liberalizes and allows the FDI, sort of non-FDI, to be picked up by foreign institutional funds, I think we're going to be having a challenge because there is going to be very little supply. And then if the yields start to compress to the levels of 5 or 6, I'm not so sure it's an exciting market for any overseas investor to come and play into India. And so thanks for closing it on an optimistic note. With that, I'll hand it over to you.
Thank you, Mr. Puri. This is a wonderful session, ladies and gentlemen. This panel has definitely blown away perceptions. What is the reality in the realty sector? Thank you so much. May I please request the moderator to the panelists for being here, sharing the expertise. Starting off with the gentleman to your extreme right, the audience's extreme right, Siddharth Shah, partner, Khetan and Company. Thank you, sir. Moving on to Director, Kotak Realty Fund, Vikas Chimakurthi. Chairman, Managing Director, Rastamji Group, Bhuman Irani. Sunil Rohakale, CEO, Managing Director, ASK Group. Last but definitely not the least, Director, Shriram Properties, M. Murali. May I please request Business Head, Times Conferences Limited, to step up to the stage, Sunita Quadras, and present our moderator, Mr. Anuj Puri, Country Head, CEO, Jones Lang LaSalle, with memento. May I ask the panel for a memento photograph, along with Ms. Quadras? Ladies and gentlemen, we've had a great discussion, fantastic panel, lots of information and lots of views. You can now separate the perception from the reality in the realty sector thanks to this eminent panel. Mr. Puri also mentioned about the money markets. That's coming up in a short while from now, in 10 minutes from now, actually. So, ladies and gentlemen, a quick power break, and we'll see you in 10 with the next session, which is Decoding Private Equity Investments Past to Future. Another exciting session right here at India Real Estate Investment Summit 2014. Ladies and gentlemen, we'll see you back in 10. In case you need to bring in your cup of tea or coffee, feel free, come back again. We'll be starting on time. Thank you so much. those of you who've used your mobiles and connected devices during the break, may we request you to please ensure that they're on silent mode when you're back in the hall. Thank you.
Check, hey, check. Hello, check. Deepak. Hello, check. और बड़ा. Hello, check.
Good afternoon and welcome back from that quick power break. It's been an interesting power break. I can see there's a lot of networking happening. Well, we have also networking immediately after the session, which is a lunch session. So great.
I think two things will happen. One, in the last 12 months, a significant amount of debt money has been raised for the market. And yes, I think that the number of investable projects where people are looking at, because today, if you ask me, investors want the best of both worlds. They want to take zero risk, yet they want 22% returns. To my developer friends out there in the room, if there are any, I think everybody's now understood in the development community what the hell a 20% annualized return is. That's a lot of money. Okay, that's a very, very high cost capital in a project with minimal risks. Okay, and I would suspect with that, because now the pendulum's gone the total other way, that everybody wants 20+% returns. I don't want any risk. I want residential self-exiting. I think interest rates are going to go down. I mean, a significant amount of capital has come in, both in India and from abroad. And with them competing for deals, I think the rates have to come down. Either that or money will start going back to investors because they won't be able to deploy it.
So I fully agree, actually. In fact.
Two, now for the equity investors, okay, and now let me caveat. We I would say, are about 60% equity investors, 40% debt. On the equity side, I can tell you to deliver the returns that everybody's telling their investors they're going to deliver, you have to take risk. Okay? There's no choice. Okay? Which means you are a land buyer. Okay? And I think what the industry is missing, okay, is that if private equity firms are actually going to deploy equity, okay, not debt, then they better have capabilities, okay, to buy land. Otherwise, we're just fooling ourselves.
Yep. So that's I would totally agree with Subhash. In fact, the earlier remark which he made that people who have made money are in the room. In fact, that is exactly the point today. Why debt is today there, because the industry of private equity or debt, if I may call it, has consolidated. There are very few players as we speak today, because I do both debt and equity. And I agree with him. In fact, I've always said this internally, that how long will this debt at 22% last? It's not going to last forever. And as Subhash rightly said, is ultimately going to go back to private equity. And actually take your point on land acquisition. This is exactly what at least we feel that we differentiate ourselves, because we have, I believe, in the group knowledge of the development sector. And that's why we give a lot of importance to approvals. As you know, I myself, before coming to India, it was running Piramal Realty and was actually doing the approval processes. So it's very important really to understand the nuances of approvals. And again, they are very different from each city, each micro market. So this is going to be the key for the success of private equity. What Mr. Maheshwari mentioned, I think it's absolutely, you cannot compromise on it. Developer quality in terms of alignment, I think it's absolutely a must. And that's where I think sitting in the room, whoever has made the money, is because of that really. Because you have aligned it, you took the right execution risk, etc., etc. Really.
So but the point that you're trying to make is really not really necessarily the interest rates alone coming down, but actually risk premium coming down.
Yes, absolutely.
Not necessarily the risk going away. The risks are there. So the risk premium that you've been able to get away with is actually, you expect that to compress.
Yes.
Yeah, and then the question is the capabilities of the financial firms to actually understand what risk premium they're taking.
Sure.
Right?
Yeah.
Because that's the key.
Absolutely.
Risk premium sounds like a fancy word, right? But what does that mean?
Sure.
So what I hear from all of you is saying that the industry is maturing both on the buy side and sell side, which means in the developer side, there's a differential between men and boys. On the private equity side, from 120 funds now or operative asset management companies, we're down to about 20, 25. So these are people who've stayed on, they have demonstrated exits, and they're committed to that business. That means they're raising new money, so they're growing themselves. So really all the guys who are trying to remote control this out of US, Europe, have all disappeared to that sense, right? So it is not something that you can remote control. You have to asset manage properly. So which leads me to the next question, and I mentioned very briefly that there were 33 cities that received this $14 billion. I'm just going to start from my left and go to the right. Are these guys going to go to 33 cities or even 5 is my question. I think it's getting consolidated to Delhi, Bombay and Bangalore, but I'll let's hear Subhash saying tier 2, tier 3 cities, are they going to get any more money?
I think 33 is impossible. I think that even if we had the willpower to do so, even if all the dynamics in 33 cities make sense, at least for our formula, I mean, we all know that India is a very local, Indian real estate, more so than any market that I know of, is a very local story, okay? India is more kind of similar to the European Union than, for example, the US, right? Every state has a different language, consumer preferences are different, approval processes are different, the developer bases are different, and so for any firm to underwrite a city, it's a different skill set. And so for a firm to say, I can underwrite more than 10 cities, I think is very, very challenging.
Very challenging.
Okay, I won't say it's impossible, because some of my colleagues may be doing it. But more than the underwriting side, I think, you know, the way that we've been successful is literally taking the role of a co-developer. Okay, whether we put debt in or equity in, we actively are involved at an operational level in each project. So for us to be actively involved in that many cities, again, we're a smaller firm and it's impossible. Okay, today we've got investments in about 6 cities. Having said that, I think the last few years we've only done Delhi and Bombay, and there's no real need for us. I mean, call it lazy or call it whatever you want, but there's enough opportunities in the 2 largest markets in India, so why bother?
So you're saying there's enough depth in 2 markets
for what we want to do,
and you'll continue to focus. Pawan, how are you seeing it? What are your clients telling you?
So I think a couple of things. I think we need to step back a little bit, Shobhat. I think it's important to understand where is this money coming from. Who are you raising this money from? Domestic money comes from HNIs, and foreign money is there's been a shift in the kind of LPs that have been giving money, right? Clearly, if you're going to go to someone and say, I want to do stuff across asset classes, across cities, you're not raising that money. Simple as that. I think those days are gone. The second important thing is, and Khushru can add on this, I'm sure that, when these pension funds, sovereign funds are coming in, I think capital is getting controlled a lot more. They want to at least know the buckets in which you're going to be playing. So if you have a specific story and you can sell the story to them saying, these are the cities I want to do, this is the kind of asset class I want to do. And I think there's examples on this panel of GPs who've done that very successfully. They've been very clear about what they want to do. The LPs have come back to them again and again because they like what they're doing, rather than just kind of spray and say, I'm going to just put money everywhere and we'll figure out what's going to happen. So to answer your question, I don't think money is going to 33 cities. Pretty clear about it, right? And I think it'll be hard for GPs to get approvals on going into tier 3, tier 2 in non-liquid asset classes. Simple as that. The one last thought that I'd want to kind of leave is that it's important to know that a lot of the LPs are now controlling capital a lot more than they were earlier, and not necessarily correct, because there's still a lot of people in this country and fund managers who understand real estate much more deeply than they do. Agreed, there's a lot of stuff that's happened, but I think we're getting into a situation where there's a lot of separate accounts and managed accounts. 70% of this, 60-70% of this $3.5 billion is actually a separate managed account and not necessarily funds where there's a bunch of people coming.
By the way, don't mind it, but I think that's a disaster.
Yeah.
I think it'll be 2007 all over again. Yeah. You got people sitting in New York, London, Hong Kong, controlling these managed accounts, don't know anything about India, and they're on the investment committee. It's going to be 2006 all over again.
Right.
You are in a very unique situation where you've raised both domestic and very large domestic and the international fund. And what I hear Pawan is saying is that strategies are becoming more focused, funds are becoming more specialized, and of course limiting themselves to a few markets, as Subhash mentioned. I think you're also uniquely placed because you have multiple offices, you're a very local firm, right? And your depth in the market is different. Would you have a different perspective to this?
So, like Subhash said, I'm fully with him because it's a local game. I mentioned in the passing about the approval process that I believe I understand something about Mumbai market, but I do not understand as much as my local guy there in Delhi.
Yeah.
So today we are in 5 cities. Why are we in the 5 cities? Because we believe in those cities, which is Mumbai, Delhi, Pune, Bangalore, Chennai. But we cannot go to the 6th city unless we really understand that micro market is really a local game, as Subhash said. I fully agree with him. And then I need my local team really, because unless you have your local strong team, we are not comfortable. And again, as he said, we are very happy in these 5 cities. We are getting enough deals. Coming to Pawan's point, I wouldn't say I disagree, but I would say we have not faced this. For example, Canadian Pension Fund really doesn't dictate. They just left it totally to us, and that's what it should be. The reason why they have come is because of the credibility of the partner and the knowledge of the partner.
And your judgment, of course.
Yes,
they like your judgment.
So we haven't seen this.
I think the point I was trying to make more was that you got to be in a specific box of what you want to do with them, rather than them controlling capital. What I didn't mean was they're not going to take calls on your investment decision or whatever, but they want to agree with you what you want to do with them upfront, so there's line of sight.
But the more important thing is what, as Subhash also is saying and what I'm saying, is that really is the local game.
Yeah.
So you, as long as you're comfortable in that micro market, you should be there. Otherwise, you shouldn't really put your money.
Vishal?
Fortunately or unfortunately, we've made investments about 12, 13 cities. So some of them smaller cities also. And surprisingly, some of those investments have done really, really well.
Yeah.
But the only thing that I can say that we have learned is that smaller cities are not big enough for the kind of projects that we can invest in. I mean, a city like Jaipur cannot take a 200-acre township and finish it and sell it off in 5 years. A city like Chandigarh, for example, is just not big enough for a 200-acre township to finish within a. There are not enough people who have that much of money to buy that much of unit and pay for it, etc., etc. I mean, I'm talking about residential. If you talk about commercial, you can completely forget about it. So at the end of the day, if billions of dollars have to be invested in India, they have to be invested in markets which are large enough to absorb that kind of product, where consumers are there to absorb that kind of product. And it's always going to be, at least for the foreseeable future, those 6-7 cities which we are all investing in. The other thing is that earlier there was too much competition. So, if a firm like us who was very focused on making sure, for example, that the developers have skin in the game, that the land is clear, markets are good, there's not too much of competition around your site, did not have a choice but to go to a smaller city. Today there are only 4 or 5 players, so there's not that much of competition for every deal. So if Subhash or us or Kushu wants to invest in Bombay, Delhi, there are enough deals available to invest in those cities. So then it obviously doesn't make sense. But if the market really goes haywire again and we are back to 2007 and there's $10 billion coming into India, you will see everybody again going to Jaipur and Lucknow and
Vishal, can I ask you a different question? I think amongst this panel, you're the only sort of fund who's invested in retail and hospitality. How do you feel? What has been your experience, and would you think that these opportunities will deepen and grow? Will you continue to invest more towards retail and hotels?
So let me speak about retail first. I mean, at the end of the day, basic economics have, at least in our case, won in almost in most of the deals that we have done. If we selected the site properly, there was enough catchment around the site, we built the right product, of not too big, not too small, we got the right tenants, we have done really, really well. So, for example, we recently opened a mall in Surat where we have, Zara, and even, for example, companies like Bottega Veneta, those brands, Genesis brands wanted to open their stores. That mall is doing really well because it's the only mall in the city. Surat is 6 million people with no product to support them. So every tenant is lining up, they're doing pretty well, etc., etc. But there are where we erred in any one of those things. For example, the partner was not good, or the location had too much competition around it, and there have been, everybody makes mistakes. It's not been the same success story. So our belief is that India has a lot of potential for organized retail space, especially in not so mainstream centers, and there is no retail infrastructure for retailers, and you should ask retailers how badly starved they are for space, and if you can deliver the right product, you can do really well. But it's obviously a very tough business. It's very operationally intensive, and you need to have a large team to handle it.
So how about you? Are you underwriting debt and equities in smaller markets?
So I think we are in probably more number of cities and towns, and we have the capability to understand more number of places. But I agree with what has been echoed by Subhash and others, that this is essentially a fairly local game. So as L&T, we have fairly good understanding of real estate and infrastructure in most of the states, and probably have some presence. But then from a financial investment standpoint, I think our understanding of all the micro markets may not be the same. So we've chosen to stay with select markets where we are comfortable, or with select developers. In the long run, I would agree that I think absorbency of the capacity we are creating, or the space that is creating in these macro markets, is something that has to be looked at. If you are looking at a project that is going to actually change the market size in a particular area, then I think it becomes even more difficult. And our perspective on retail is actually, we're saying real estate itself is a very micro market driven, and retail is another element of micro market risk. So you multiply these two, I think we increase the level of risk. So we normally try to stay away from retail, at least that's our view at the moment, and would look at, once they're getting established and there is some track record coming in, then we are willing to take out others. So I think we are very selective in our approach. We think there is money to be made. We are very patient capital, and we are modest about the gains we want. We don't want to make an earthly amount of money. In fact, if we find that there are developers who are actually looking at making 25% return, we say maybe that's a project we don't want to get in.
Interesting. Last word from you, Ashish, and we're going to open the questions, the panel for question and answers.
So I think, everything that has been said on this, I agree with. I just want to add that for a little more geographical diversification and probably a little more opportunistic return, we would definitely not like to spread ourselves thin. It's enough to know 5-6 markets at one point in time. Continuously be plugged into those markets, understand those markets, know what you're doing, what you're not doing, etc. So in terms of just risk reward, the risk is just disproportionate to the reward in going to more than. So I think Subhash was perhaps being generous when he said 10 cities. For us, it's probably 5, 6, 7.
Good, guys. 1 or 2 questions. I think we've run short of time as always. The interesting topic, we couldn't decode it in 1 hour, but yes.
We haven't decoded in 6 years.
6 years. Yeah, so it's a tough topic, but yes, we'll take 1 or 2 questions. Please.
We'll have to make it brief, sir. My apologies. I'll get the mic around. Can we have the mic quickly? And if anybody has a second question, put your hand up right now, because thank you, sir. Mic coming.
I'll be just quick. Number of questions, but I ask only one. I've been asked more and more questions about corruption. About some of you are excellent, and I understand you don't necessarily follow all those practices you have followed elsewhere. One, how do you deal with the issue of corruption at the developmental plans, for example? How do you get through them? Acquisition of land is only one aspect of it. But constantly I'm being asked, because Foreign Corrupt Practices Act in the US, Bribery Act is so stringent, I do not know how much sensitivity exists, and I agree therefore that out of 33 cities, only 2 or 3 cities are a little much more sensitivity to this issue. But how do you look at this, and what do you respond to your investors? Or if I have to answer those questions, how can I be a little more optimistic and say something? Thank you.
I guess Subhash, you're going to
I've been answering that for 8 years. Look, as far as corruption goes, there's two things. One is, first of all, the question of black money. I think for the most part, we all either build residential projects or we build office spaces that we then rent and sell. In both scenarios, when we're building residential projects, there's mortgages, okay, and the mortgage market essentially has taken a lot of black money out of the system over the last 10 years when it comes to just selling flats, right? So that's one element of it. Same way when you sell a building, you're selling a building and you're selling it for at least $100 million. Again, there's no cash element there. As far as approvals go, I think that's overrated. Okay, what we say, right, is that look, when we're a joint venture partner in each project. There's a developer on the other side of the table, and in the list of we have certain responsibilities with each project. Amongst the responsibilities of the developer side is approvals. How he gets approvals, that's his responsibility. It's outside of the SPV, and that's just his job. Now, having said that, if we know an investor better, I call them out and say, look, I was an investor in Chicago. It's the same thing in Chicago. It's the same thing in New York. It's the same thing in San Francisco. So I think people just want to check the box, okay, that yes, these guys are aware of it and foreign corrupt practices is not an issue. Having said that, the same U.S. firms that they're investing in deal with it the exact same way, because real estate across the world is the same.
I think I understand where you come from, and I think the only thing that now what is happening is because recently a judgment has come and private equity fund has been held liable. It was a case of even antitrust, so aiding and abetting or not doing enough due diligence, and some of those liabilities are coming up. Going into more detail than what normally is. I'm not going to extend this discussion, but the liability has become a major issue. Grand Cayman Court awarded $111 million to each director for not going sufficiently into the detail. Same decision was followed in Delaware. So, and I have seen several activist investors now coming up. Right now we are handling the litigation where directors are expected to go much more than what they were usually expected to go. But I take your point.
Yeah, Nishit, you're 100% right, and China has a number of these issues. Again, sorry to my developer friends in the room. The only solution we've come up with is to put that if they violate the Foreign Corrupt Practices Act, it's all on them. It's not their fault.
So, I guess one more indicator from the
being real.
So, Nishit, can I just add a word here? So, and I've also been asked this question for 8 years now. Yeah, 8 years, and at least my answer has been very, very simple. In any project or company that we have invested in, there cannot be an iota of corruption. We tell it to our partners from the day we invest till the day we exit. If they cannot get approvals because they have to pay cash, let it be. And I can tell you that there have been a couple of projects where we have ourselves gotten our approvals without paying a single rupee of cash. It may have taken us 6 months more, a year more, but they still have come. As long as you follow the rules, and in 1 or 2 cases we got delayed, we went to the court, got relief, and we got our approvals. So I'm not saying it's not easy. Of course it is a very tough method, but I don't think it cannot be not done. So you just have to put your foot down and say that even if the way is harder, I still have to follow it. And I think that discipline, at least I have seen, even slowly imbibing into our partners as well. That they don't want to take the easy way out, and they are ready to push and get it done the right way.
On that optimistic note, I'd like to thank you all. I think we run out of time. Thank you all for being here, and to the audience for listening. I guess the panelists are available off stage. If anybody has more questions, you can get to them. Thank you all.
Mr. Garwal, of course, we all know that speed money works. The organizers pay me to speed things up. May I please request Mr. Garwal to present mementos to our panelists, starting off with the gentleman to the extreme right of the audience, Mr. Subhash Bedi, Managing Director, Redford Capital. Moving on to Pawan Swami, Managing Director, Brookfield Financial. Khushru Jijina, Managing Director, Indra Rate Fund Advisors. On to Ashish Singh of Standard Chartered Bank. Photo opportunity. And moving on to Mr. Maheshwari, Managing Director, Chief Executive, LT Infrastructure. And last but not the least, Managing Director, Zand Advisors, Vishal Kumar. May I please request Rishi Kapoor, who is the Sector Head, ETH, to please step up on stage and present Mr. Agarwal with a memento for a very commendable job and a great discussion. Good questions from the audience. I wish we had a lot more time to indulge in that. Time's short. May I have a memento photograph, Mr. Kapoor? All the panelists, Mr. Agarwal. The legend, please give them a big round of applause. They've given us a lot to think about, a lot to discuss over lunch. Before you head for lunch, I got to tell you that Mr. Agarwal did say, what separates the men from the boys. Generally, what separates the men from the boys is the price of their toys. And for those of you interested in really expensive toys, one of our luxury car partners who have a new establishment in Prabhadevi, Porsche, is willing to give you a Porsche free for a day. So all you got to do is go to the Porsche counter, which is in the foyer area. Make sure that you give your card. They will have a lucky draw at the end of the day. And if you're the lucky person, that Porsche is yours, albeit for 24 hours. Well, ladies and gentlemen, before you head for lunch, just to remind you, we'll have a shorter lunch break. We'll see you back 40 minutes from now for the next discussion, which is on capital markets. Once again, the game changer. So, ladies and gentlemen, we'll see you back in 40 minutes. Enjoy your lunch. Bon appetit. Thank you. request you to be seated. As we start with the post-lunch session, once again, the mandatory requirements, please ensure your mobiles, connected devices are on silent mode. And as you seat yourselves, got to tell you that this is also going to be an interesting session. This is a panel discussion on REITs, the game changer. As we start, we'd like to thank all of you for making it a success. To remind you that to be eligible for the draw for the Porsche, to use it for a day, please ensure that you hand in your cards at the Porsche desk, which is just in the foyer area. There'll be a draw later on in the evening. If you're there, you're one of the lucky ones, well, a Porsche for a day. It's good. We'd like to thank our silver partner, MMR, for making this very special for us, our associate partners, Aryan Superstructures and HDFC Realty, our supply partners, FIFA, that's the Federation of Independent Financial Advisors, and AIBI, the Association of Investment Bankers of India. Our knowledge partner is Jones Lang LaSalle. Ladies and gentlemen, it's now my pleasure to call on the panel to the dais. This panel is going to be moderated by the Managing Director of Cushman & Wakefield, Mr. Sanjay Dutt. May I please request Mr. Dutt to take center stage. Mr. Dutt brings a wealth of experience, over 20 years in real estate. As a real estate professional and an entrepreneur, he's garnered a wealth of respect in that amount of time. His expertise includes, of course, transaction advisory, including land acquisitions, dispositions, joint ventures across everything, office, retail, and residential spaces. He, of course, leads the India operations as Executive Managing Director for Cushman & Wakefield, and, of course, all the South Asian markets, he spreads the growth. So, ladies and gentlemen, thank you, Mr. Dutt, for being with us. On the panel with Mr. Dutt, we have Aftab Alam, who is the Chief Investment Officer of Hayat Investment, based out of Kuwait. Hayat Investment is a Sharia-compliant company with interest in multiple assets across multiple regions, and Mr. Alam's experience is across a wide range of companies, including the NTPC, SEBI, BNP Paribas, and Capital Market Authority of Oman. Joining Mr. Alam, we have a gentleman who needs no introduction. Mr. Niranjan Hiranandani is one of our panelists. He will be joining us in a short while from now. I shall move on to the next gentleman. He has 22 years of experience in business management with strategic roles in various organizations. Ladies and gentlemen, he is the Managing Director, Development for RMZ. His expertise includes, of course, real estate, telecom, infrastructure, and insurance. Ladies and gentlemen, please welcome Mr. Arshdeep Sethi. Joining Arshdeep Sethi on the dais, a gentleman who needs no introduction. He's been asking questions, and very in-depth ones too. He is, of course, the managing founder and partner of his eponymous named Nishit Desai Associates, which is a world-renowned organization which has experiences, it has offices all across the world, too many to name. I can briefly tell you that the Lex Witness Hall of Fame has named him as among the top 50 individuals who have shaped the legal landscape of modern India. Ladies and gentlemen, Nishit Desai. International expertise on international law, corporate law, very extremely published, and of course he does also lecture at the best of academic institutions all across the world. Joining Mr. Desai and the panelists, we have, apologies for the papers, the Executive Director, PricewaterhouseCoopers, and he's also in charge of tax and regulatory services as its leader, besides, of course, handling asset management, Gautam Behra. Gautam brings to the dais about 3 decades of experience focusing on asset management, a regular speaker at international fora. He's a member of the National Direct Tax Committee of the Confederation of Indian Industry and the American Chamber of Commerce, and on the Expert Advisory Committee for the Institute of Chartered Accountants of India. Ladies and gentlemen, with this, it's my privilege to hand you over to your moderator. Just to remind you that Mr. Niranjan Hiranandani will be joining us as soon as he's on with us. Once again, the same rules apply. We have time constraints, so time permitting, at the end of the session, if there is time, at the discussion of moderator, Mike will come around. Please stand up, identify yourself, ask a question. Over to you, sir. Now.
Thank you so much. A very good afternoon to all of you. I think this session wouldn't have deserved the kind of profile that we're very fortunate to have with us. Certainly, it makes a world of difference when you have the best stalwarts and the industry experts on the dais interacting and giving the opportunity to all of us to actually ask some very relevant and important questions. This country has gone through several revolutions in the last few years. We saw the IT industry, we saw the telecom, and one can argue that there's more to come and we could have done better. But still, some of the game changers have happened very successfully in the past. And amongst the negativity that we all see every day on the television, if we can just step back and look at some of the success stories that this country has witnessed, and with that angle, if we can approach the next subject that we're talking about, REITs, the game changer, I think it would really help all of us, because sometimes it's the intent and the positive approach that really helps, makes the difference to the subject and to the policies that this country badly needs. I will start. It's a good combination of developers, two developers. Niranjan will join us shortly, and Arshpreet from RMZ, and of course, investor with us, institutional investor, of course, can also wear a hat of a retail investor if we have some questions to answer. And of course, consulting firms, tax and legal advice, of course, very accomplished and very experienced. So I'll kickstart this discussion by approaching Mr. Nishit Desai. Just setting the context right for our discussion, I'm going to ask some very basic but very important questions. What are the key features of the SEBI draft that they rolled out? And I think the first draft itself was very comprehensive. I would like Mr. Desai to touch upon. And very quickly, if we can follow that, what is the current status? And I would ask Gautam and Nishit. Gautam, you can follow after Nishit. And so we can figure out where do we stand today, because there was a momentum. We thought we almost got it, and then we missed it. And I know there's some story that you can share, whether it was taxation or that was some other things that you wanted to include, will be very helpful. So, sir, with all due respect, requesting you to kickstart, sir.
Oh, thank you so much. Am I audible?
Very much.
Okay. So, if you see the history of mutual funds, and even the concept of real estate mutual fund, that began to be talked in the year 2008 around, and but again it fell out because of number of weaknesses. Now we are having the new one, a draft that has been suggested by SEBI, and all the features are actually listed here. You don't want to be bored after a great lunch. In this article, is published in the Bloomberg. ET has been very, very gracious, I must say,
to do that.
And they are very good, in that way. But so, I think, if I may put it this way, most of the features are here. The whole concept of REITs is against what you call the normal AFI model. Okay, is that REIT is particularly meant for the smaller investors as well. But you need to provide proper liquidity. You need to provide proper regulations. Most of the regulations, as you know, have evolved from the US. And the concept is very simple. We are making them a little more complicated with too many innovations in the whole thing, is that you invest in the properties which generate income and distribute that part of income to the investors. Okay, this is the whole concept. And if you invest, if you distribute 90% of your income, generally the REIT itself will not be taxed, only investors will be taxed. Okay. In the Indian context, there are a number of issues at times we are coming across. When we draft regulations, what has happened, they have said, okay, the REIT can invest only in securities. Now, for the purpose of corporate law, it fulfills the definition, but for the Securities Contract Regulation Act, it does not fulfill. So there are a number of micro-level issues in this whole game, which we need not go into detail today, and I don't want to go too deep into this whole thing at the moment. But if we can, secondly, for example, things like investment in LLP, which is another animal that we have innovated. we do not have in India as of now what you call business trusts. I think that is another thing we need to innovate in India. Of course, there are a number of different entities, like LLPs and LPs and whatnot, but business trust is another thing that we need to do. But you can't have everything. So for the time being, trust model works, and that is all right. In the whole process of doing all these things, what we have actually done is to export our capital market, especially in the real estate side. So you go and list in AIM, at the AIM, you go to Singapore and stuff like that. As far as the status of this regulation is concerned, it's awaiting people's comment. Some comments have been already received by SEBI and the government. But my understanding, and somebody can correct me, is that still there is not enough buy-in at the highest level. That is what
Can
is my...
Can you expand on that, the highest level?
I believe that at the finance ministry level, there is still not buy-in. I do not know, but what people have met with the different bureaucrats, and there is still some apprehension. As far as SEBI is concerned, it seems there is a lot more buy-in, but at the highest level, there is some concern. Now somebody else can interact. I'm a lawyer. I'm not here in investor conference to invite investment. I'm very optimistic, don't get me wrong for a moment, but my job is to tell what I feel.
Correct.
And so please pardon me for that. But I feel that this is where we really need, as an industry, to communicate to the finance ministry and the highest level people that why REITs is very important and why we need to have it as soon as possible. Today, look at, I'll just spend one more minute on this subject. I was in the US last 3 weeks. I met a number of people, a number of investors around. First concern is that US itself is doing well now. It is growing at the rate of about 2.75%, some say about 3%. India at the rate of 4%. So why should we not invest in more allocations go to the US? Some people will be able to comment. Second, from BRICS, we are now moving to BRICS because Russia is out. So one opportunity is that what investment would have gone into Russia possibly can be tapped in here. Next 2-3 years, you do not know. China and Japan have already been at a friction.
So please join us. Yes.
Niranjan, I think you...
Maybe you're... I think
lawyer should have last word.
Come. No, please. Come in.
Sorry. So, no. So, just I was giving a little flavor as to how I see things around the world. As to the US, real estate has been doing extremely well. The investment that you made in Silicon Valley 2.5-3 years ago is doubled. New York, 57 and Park has become billionaires row. Maybe you have some.
And probably so has London, Singapore.
Everything. Now, India has an opportunity, but I think we need to move fast. Industry has to make a noise and make sure that government listens to my understanding on RF. I was just being asked a question as to what do you think the status of REITs in India is. Okay, all of us know that SEBI rules are there, but there is not enough buy-in. That is what is my understanding at the top as far as REITs are concerned. We need to communicate to government that why we should bring in REITs as soon as possible, both for the benefit of the small investor in India and also to attract larger investment. Because if we do not use this opportunity, then we'll have a problem. Because a lot of investment in Russia has stopped at this point in time. So from BRICS, it is becoming BRICS. And China-Japan relationship has gone haywire. So they want to invest in India. And third, US is already growing 2.53%, so investment may go on that side more in other parts of the world. But I think we need to, so that is what is my understanding of the status. But somebody else can always correct me that I'm wrong.
No, not at all.
Thank you.
Thank you so much. I'll move to Gautam very quickly. I believe you were working with the committee as well proactively. Can you throw some light on this?
Yeah, I thought what would be useful to the audience is just for me to share some experience on over the last 6 to 8 months. We spent quite a lot of time and effort on this, and we came this close probably to seeing it through. So 2 or 3 comments. One is the interaction with SEBI has been very positive, I must say. So SEBI, right from the start, was very eager and willing to know what are the international best practices. They were quite transparent in getting stakeholders together, and I'm not just talking of developers or asset managers. They got representatives of investors, of retail investors as well, all to sit in a room and say, all right, let's discuss what should be the approach towards the big ticket items, valuations, related party transactions. So they went through it in a very systematic way, and and they came out, as everybody knows, there's the draft REACH regulations out, public comments were invited. So all of that piece has gone up well. The other piece where I mean, they've also been very proactive is in taking up certain matters which was showstoppers with even the ministry level. So while I've had quite a few flights to Delhi, earned quite a few frequent flyer miles around this, but I do know even the regulators were pretty active in trying to push some of this through at the Delhi level. As is stated in the media, I think where things got stalled was the tax piece. And without getting into too many details, tax can be quite complex, and if you add India in front of it, it's complex and scary. So, but just keeping that aside, the feedback we got from institutional investors who were eager to come and invest in India, put in more capital, was saying, broadly looking at a 10% return, any tax leakage beyond a 20% rate, 10%, would make this investment not very attractive. And therefore, whatever structure you put in, whether it's a trust, it's a SPV below, dividend distribution tax, corporate tax, all of that stuff, we're looking at a net effective tax leakage of 20%. Right? The way the law stands today, I think you have corporate tax and the DDT, tax rates could go up to as high as 35, 40%, and that's to making some assumptions around some interpretations. So clearly not a workable solution. I think we did manage to get this issue across to the ministry as well, and as Nishit Bhai correctly put it, it's a question, the concern about export of capital out of India, right? The Singapore listing, Fortis has done that successfully, as well as foreign investors wanting to come in but not having a structure by which they could get in good amounts of capital under this route. One of the technical issues which came in the way was, yes, this I remember was sometime in December or so, where I think we almost saw them getting a bit positive on it, and then they stepped back and said, hold on, we don't see the budget coming through in February, right? And what you're saying requires amendments, serious amendments in the income tax law, because the ask was very clear. We do not want to do any cute structuring. We want a law which is very clear, categorical, and leaves no room for any doubt whatsoever. And this whole election thing and the budget not happening and getting pushed back, I think that was one of the things that contributed to putting things in a spin. Right? So if you were to ask me, when is this going to happen?
Roll out? Realistically,
I think it's going to be a question of, as he put it, the buy-in from the top. So depending on who comes in, I think in terms of regulations, wordings, etc., we've already put all that in the table. Right? So if somebody wants to do it, it's a matter of picking that up and putting it in the budget,
so
which is in June.
after a stable political, ministerial environment, a year from there?
I would say if there's a buy-in, the change could happen in the budget now.
Sure.
And that could be the starting point. Obviously, there'll be time lag for people to get things together, register, put assets in place. Could be another 6 months more before investors start coming with money. But the start has to be this change in the tax law.
Great. Thank you very much.
I think it will take about a year to year and a half.
Least, I would
I think.
yeah.
At this
And
because
I was quite pleased by the statement that he made that we'll get it right the first time. That'll be the first ever in last 60 years, in my opinion.
And
but
I
that'll
hope
if
be great
they
to see
take,
it.
If they take 6 months more, doesn't matter, but let us get good rules out.
Correct.
The problem is we bring rules in hurry and then we keep on going.
Changing
so this
it and
time,
we lose confidence.
Yeah.
I agree. Moving on to the obvious discussion that we wanted to have, and we think it's a game changer, but why do we think it's a game changer, and how is it a game changer? Game changer for developer, game changer for investor, institutional investors and retail investor. Just wanted to have some discussion around it, and I wanted to start with Aftab, if you can step in, and not just limit yourself to the question, but if you have something else to share as well.
Sure. Before I come to this question, I would like to buttress the point which you made, the taxation leakage of 20%. Just to give you a perspective, all these instruments, especially REIT, it came in US first. It came in 1960, but it was not a success story till 1986.
That's not a good example to follow.
I tell you the
I would
reason.
be worried.
I tell you the reason. Because till that point of time, there were certain structures which were more favorably placed than REIT, which was LLP.
Okay.
Only that this advantage was removed,
sure.
REIT took up. And that's why the issue which you are raising up is very important.
So it's better to get that right.
It is better to get that right before starting. Coming to the question, what kind of instrument this is going to be, whether the game is going to be changed. Let's first look at what kind of creature is this. Globally today, it is practiced in 30 countries, 30, 40 countries maybe. Take all my data as ballpark numbers. There are 300 REIT instruments whose valuation is roughly $800 billion, and it accounts for 6% of the commercial assets. Globally, if you are asking for regional breakup, North America, that accounts for 40%, Europe accounts for 15%, and Asia accounts for 40%. But that's slightly misleading, because in Asia, Japan and Australia, they account for 80%.
80%.
So they are in developed category. If you are talking of India, in India, a rough estimate says that commercial estate is roughly $400 billion. Now there is no REIT except some private REIT, which I hear.
And you would say that investable grade A assets?
Will come later to
All
that.
right.
Now, if the existing commercial asset, which is 400 billion, if at the average global rate of 6%, if it gets converted into REITs, we are talking of $24 billion. Yesterday, I was having a discussion with a gentleman who is well informed in the industry. He says the moment rule of the game is ready, roughly $10 million is ready to roll out.
Wow.
So, this is the existing potential, immediate potential.
So why do you see it that way? It's because when you look at India and you look at greenfield investments with so much of issues, development, approval, marketing, and there is this income generating asset, is that the appeal versus the other, or it's just globally there is capital seeking so much of income?
See, we cannot be in a different bracket than what is practiced globally. Sooner or later, we have to fall in that line.
Okay.
If I say that globally 6% of the commercial assets are in REITs, sooner or later in India also the story will come. So we are talking of $24 billion immediately. And size of India's commercial real estate compared to its GDP at this point of time is not favorable. In the sense that India's GDP compared to global GDP roughly is 4-5%. If you are talking of India's commercial real estate compared to global commercial real estate, it is merely 1.3%, 1.4%. So we have plenty to catch up.
Okay.
So there is tremendous potential immediately as well as in times to come if we are looking from the supply side of it.
Okay.
Now, supply of instrument may come, but it has to be demanded by someone. Why it should be demanded by individual investor or institutional investor? Now, there are plenty of advantages for all the players. If the rule of game is certain and if it is marketed properly, there is plenty of advantages for institutional investor as well as retail investors. Let's look at advantages for retail investors. All the retail investors, they have got sort of romantic relationship with real estate. All of us either hold or aspire to hold real estate. We have not been holding it because of certain reasons. Either we don't have deep pocket or right kind of instrument is not available. Now with REITs coming in, what are the beneficial features which we will be getting it? First of all, this is an instrument which protects you from inflation. There are many instruments which protect you from inflation, but this instrument particularly protects you from unanticipated inflation. And that is very important in our kind of market where things turn topsy-turvy.
Mm-hmm.
The second thing is, it is income producing asset. Everybody loves to have income, but its associated beauty is that when it is income producing investment, it has to be designed with a lot of seriousness. You cannot have a trophy asset in your portfolio. You have held out to the investor, you will be giving 6% or 10%. You have to give out, so there has to be a very scientific way of investment here.
Okay.
The instrument itself forces you to do that. The third beauty is that it is a great diversifier. If you read finance literature, it says that with equity, its correlation is, say, roughly 0.5%. With REITs of other countries, its correlation is still less, a quarter. So lower the correlation, better the place of that security in that portfolio. So from that angle, it holds a lot of promise. There are certain other advantages also. One is your asset allocation becomes very easy. For example, you are an investor, you are building a portfolio where you want to allocate 5 lakhs to real estate. Would you be able to allocate 5 lakhs? No, no way. The only way you can allocate is when this kind of instrument is there. That is the initial allocation, and after that, if you want to change the allocation, suppose its pricing has run up, you want to size down, you want to do 10%, you can easily do that.
Sure.
And
so mostly from institutional and retailers' perspective, I would say.
If I'm looking from institutional perspective, for institutional perspective, see, if you're talking of institutions like bank, for them this is the opportunity to deleverage themselves because they have given a lot of money for commercial development. Money is locked up. So risk will be reduced in the system when this kind of instrument is available. Secondly, if you're talking of institutions like pension fund, etc., and I talk of pension funds and charitable institution in Gulf, in GCC region where I work for, there is plenty of money chasing low but stable return with certainty. In India's context, it becomes slightly different because currency fluctuation also comes into play.
Correct.
But
good to know there is capital chasing India.
Increasingly now, earlier their focus was not in India, but increasingly they are looking towards India.
Very assuring.
We are investing in India. In fact, just to digress from the topic, first investment after being set up in 2009 we did was in India.
Amazing.
If I'm
one of the few people, I must admit, who seems very happy after investments in India. We should talk about good stories. You know, how come we miss it?
That's
beautiful. We made our money in India. We intend making our money in India.
We need to do a case study on that. Yeah. Are we done, sir?
Yes, that is.
I'll come back to you if you think appropriate. I think we had a good look on institutional and retail investors' perspective. I think it will be equally good if we cover developers, so we complete the round. So to my left, Niranjan ji, and then followed by Arsh. Is that all right?
Perfectly fine.
From developers' perspective.
I think we've been chasing the REITs for only 15 years. So it's about time we look forward to it. Last December, as he correctly said, we were almost there, but we are not there, and the slip between the cup and the lip was pretty long. Three things have come in the way. One was the question of what would be the stamp duty in terms of transfer to the REIT. And the issue was if it is equivalent to conveyance, then the REIT doesn't work at all. Second was the issue of how do we do it and what should be the rate, because it's land being a state subject and stamp duty being a state subject. So at the end of the story, the whole, from a balance of convenience from nil, which we were wanting, it was said that if it is equivalent to a mortgage, which is between 0.1 and 0.5% in most of the states, it would be something which would be acceptable to industry as well as developers, including financial institutions, and provide viability for such a transfer to take place to a trust or a company or a corporate or an LLP, depending on how you create that media. And the third, the other part was a pass-through, which was 90% a pass-through of the income to go to the holders, which was okay because it was equivalent to what the mutual fund route is there. And the last was the question of capital gains. And that became another factor which required the Finance Act to be amended, because when you transfer to any other body, whether it's a trust or a corporate body or a limited company, etc., we have capital gains, whether short-term or long-term. And so we said that the first transfer, which is transfer to the REIT, should actually be exempt from the capital gains, because otherwise the residuary value coming into the REIT requires an outflow of tax at the initial level. So that's the issue which is now pending before the Finance Act and the Finance Ministry. Barring that, I think the hard work put in by everybody has been very fruitful. SEBI has, of course, been the leader, but even the Reserve Bank of India has given its green signal. So that was a very, very great positive that we were able to obtain from the central bank of our country. And I think that means that whatever government comes into place, or the finance ministry, the whole cake is ready on their table. So it's only to pick up these issues and be able to get it done. And I think it looks like a possibility. If it happens in the immediate budget, wonderful, but I'm sure within a year's time we will have it in place. So I think the REIT is looking like it's there, and it will be useful. From a developer's perspective, I think it's a wonderful thing to pay off the institutional investors when you have amounts, so you get your money back as early as possible, especially in the case of commercial real estate. I think that's it could also be for retail, it could be for hotels and other things. I think it's a good exit route that I think the developers find it to be able to pay back to institutional investors. So I think it'll be a wonderful way out. There are a large number of people who have not been able to exit, not lucky people like we have here, but other people have not been equally lucky. And I think those people will find it extremely interesting to see if that conversion through a REIT could provide liquidity into the system. But I think there is something more than that I'm looking for. I'm looking for rentals to come in much more stronger, both on the residential side and the commercial side, because if you compare our country with any of the developed countries of the world, the amount of rental, whether residential or commercial and others, is much, much larger. So even in the United States, 40% of the total leasing is rental in the case of residential, and commercial, I don't know, I believe the percentage could be as good as 80 to 85%. So obviously the commercial, residential put together, the potential that we have in India is very large, untapped, unheard of. So I think the benefits which is going to come up in terms of opening out for the developers side, both on the residential, commercial and retail, I think there's going to be a huge change in what is going to happen. As far as guesstimates are concerned about the numbers, we had a chat with the Reserve Bank governor about 2 months ago, and we speculated that if it was opened out in the budget of this year, we would have got $5 billion before March of this year. Wow. And we will, because there are so many commercial assets waiting, correct, which are actually mature, and people are actually looking forward to this happening, so we were expecting that. But having said that, we said there'd be 20 billion in the course of the next 1 year once it starts getting into operation. So we, of course, this figure looks ambitious, but don't be surprised if it goes through, because India looks interesting to most of the people outside at this point of time. We're coming back into the investment curve, and I think there's going to be an opportunity where REITs will be a starting point of the FDI, and not FDI pure and simple, but you'll see the REITs coming in first, because it's, as you said, more safer in terms of taking a risk profile, and you are able to get an exit route by investing in a REIT. So since it's going to be a tradable asset in the stock exchange, you'll be able to exit out at any point of time, which an FDI cannot do. So I think the liquidity parameters available to investors worldwide is going to change, and I think it's not going to be a great game changer. It's going to be the greatest game changer as far as real estate is concerned in the next 12 months. So I really think it's going to make a change. I think what 2005 did in terms of policy change, in terms of investment of FDI into India, I think 2014 and 15 will see the same thing happening. Not that FDI is going to come down in real estate, but I think REIT will overtake that investment in the next couple of years, especially in terms of what you said, pension funds and other funds which are actually not really into the Indian market. I think they will come through the REIT market. So it's very, very interesting, very, very attractive, and fortunately, thanks to SEBI, I must repeat that SEBI took huge steps and very constructive, positive steps in bringing about this policy, very well studied, and I think they covered every aspect of all the stakeholders who were really to take, participate in this whole thing. So I think we're looking forward to this particular thing as a game changer for India real estate in the next 12 months. And I don't see any which way, if they want money to come into real estate in a big way, REIT will not come. I mean, it's the other way around. Somebody would be quite stupid not to do it, because it's simple. There's no risk profile. 15 years ago when we pushed it, one of the criteria for not bringing it was there was not enough highly rated commercial real estate rentals available in the market. So it would be wrong to allow it to happen. And I think that maturity has reached, may not be in the volumes which Aftab is talking about, but obviously I think a beginning would make a difference to India completely, and also the financial part of bringing it in.
Thank you so much. I think before Arsh, you take up, we have
I have a quick comment at this point in time, and that's just do analysis. And that's what is the likely impact of BJP not allowing retailing in India, because 1/3 of the assets will be commercial. I would say half of it will be commercial, but 1/3 will be shopping malls. And for shops, you need goods, so you need warehouses. So if you do not open up real estate, the retailing will have serious implications on 1/3 of the asset class. And that's where my guesstimate. I am not an economist, so please pardon me on that. But I think this is something that we need to carefully address, because we are talking exactly, we talked about the commercial real estate, and that's where my concern is, that how do we go about, and that's what I also hear from other quarters of the world, this retailing, we should find some way. There are always going to be problems. BJP has its own issues, but industry has to find its own solutions in terms of developing some models.
My view, I was watching an interview on the television of one of the senior leaders of BJP.
Yeah.
Don't want to name it here, but I think the way he went about articulating, it seems like he was the only person concerned. And as far as the manifesto is concerned, it's more like a timing of the manifesto and elections rather than actually the things going to happen on the ground. I think that once the office gets rolled out, I think there would be enough for them to then consider other, segments of real estate.
This is only one sensitivity point, that we are.
No, absolutely right. And I think that sector also needs more organized shopping center play. And there seems to be a kind of a disconnect again between cost of building such assets and the rentals that they are able to secure today, or the revenue share that they get from most retailers. But I think there will be a maturity in that place as well, and you will see that. But
on regulations, we are almost there, I think.
Correct.
What you rightly
Correct.
said, just
Correct.
final blessing.
Nitish, only one small point to distinguish. One is the retail for the malls.
Right.
And the second is the retailing in terms of FDI into retailing. So we'll still have the malls which are there, which are stuck with capital investments to be able to exit out through this route. But I agree with you that we won't be able to get into the FDI for a single unit, single brand retailer will still be an issue. But I think what they have done is probably allowed 97% to go through and kept 2 or 3% behind, because I think Delhi has a lot of single person retailers and they want to win Delhi votes also. So I think there's an issue in terms of city of Delhi, where I think a lot of pressure came from the BJP at the organization level. So probably so I think I agree with you, Nitish, it's a concern, but I think at least the malls which are sitting with a lot of investments done would be able to exit out. But I agree with you that new FDI in retailing could be still a concern.
Sure. Yeah. Ashpit, over to you.
So I think I can't agree what Mr. Hinandani said. I think the 3-4 points which are very important, and I think the structure is ready, but the soul is missing in the existing draft note that we've got. And I think, as you rightly says, the SEBI is highly proactive to really consider the amendments have been sought by the industry. And having said that, if those are done, I think to me REIT is a clear winner. Because don't forget that for last 10, 15, 20 years, everyone has actually built retail and office, and unfortunately few of the development companies has gone for a listed option at a lower and higher stock options. And you could clearly see that they potentially have not done exponentially well, because clearly it's a very hybrid structure. So you've got a bit of resi, you've got a bit of retail, office, everything there. So therefore, from my investor standpoint, there's no clear focus that where are they really making money on this. Unlike in this option, you have a clarity of asset class, if it's an office or if it's a retail, you've got a long leases, and therefore a much more transparent and a foreseeable returns than one can have it. But I think there are a few concerns beside Mr. Hiranandani talked about on the stamp duty, pass through. I think there's few more concerns are there. As much as I, personally feel that the size is really important, but I think having said that, the size which is there, it is really good, but it may prohibit the smaller players to come in there. I mean, if you look at,
but that was intentional by the government, I think.
No, I appreciate that, but it's good for. I mean, if I be biased on that, I like to have only 3 listed entities, and therefore everyone merged with us. But I think when you look at a little more broad perspective from industry standpoint, I think
Obviously.
then we having 5-6 people really being macho about it, and this is typically you see in Singapore as well, where you see a capital and has got a similar model that they're really just doing. They've got an understanding of REIT. They're just going out in China and other markets and really buying it there, which is very good. But I think to me those are much more mature market. They ran the REIT for last 10-12 years. We being obviously starting a baby step on this, and I think it's important that have some bit of an opportunity being given to a smaller players as well. So that's one. Second, I think is also important, which is obviously part of the revised revision, is that the foreign investment needs to really come in there, because today if you look at retail has got a tremendous potential on that, but as Mr. Hayat also talked about, the amount of capital which is still waiting to come into country is very large, and unfortunately there is no exit mechanism that you have it. And I can promise you from a development standpoint, the time that you discuss 90% on an agreement is how to exit a developer or an investor. There's absolutely no other discussion. They're more concerned on exit because these are all privately held companies. So unless you have a right exit on this, and I think it takes away a lot of opportunities and efforts on that.
If I was to throw in a question, just to get the conversation more exciting.
Yeah.
You have a trust listed, and you put together a portfolio of 10 or 15 million square feet, and you explore the reverse merger with the listed entity in Singapore, versus wait for next 2 years and explore what would happen.
So, I have a little more biased and a little more hybrid opinion on that, because, and as much as we're highly optimistic, we look forward to a new government coming in there. We're only hoping the new, set of people come and they're pro-business and they'll do it. But to me, personally, and again, to me, the REIT, I'm not too sure in terms of the priority, where does it stand today. I mean, there are whole tons of economic issues, the currency issue, the deficit issues, and there are high priorities on this. So when will this really fall in and gets an attention from a Ministry of Finance and Commerce, say, yes, please proceed on that. So I think point number one is that as I talk about 15 years of waiting, I mean, pardon my saying, we're getting now a little frustrated, I mean, that much patience, we really don't have it, I mean,
well,
whether you call
some of us are mid 40s, 50s, we got to change things. Right?
So you could call a youngster, you call anything, but I think we're a little frustrated now, and how long you can really continue waiting on this. From our standpoint, it's important that we have a clear vision. If that's going to take 24 months, then we keep high tide on this, and 25th month we know.
And get it done right.
Yeah, but unfortunately, the crystal gazing ball that today we have it, we all hoping 272, we all hoping new government, we all hoping the Prime Minister, we all hoping it. If that happens, applauds, and we all happy,
It comes in the budget and the first budget.
So I think real estate developers or investors are highly optimistic always.
I have 2 more very interesting angles to get the little excitement in the room. So imagine you have a common man standing near the Bombay Stock Exchange who invested in all the listed entities last few years, very excited because they made romance with the real estate, the way you spelled it out. And they really had a long romance, right? It didn't work out. Sometimes it happens in marriage. But imagine if they were to, given this opportunity now, and present, look, there's another opportunity to have romance. How would they view it? In true sense. I mean, they've experienced some already, and they believe in tangible asset, owning, touch and feel, ye bachche ke naam, ye uske naam, ye bibi ke naam. there may be many more, but
can I?
Yeah.
Sorry.
Go ahead.
No, let's take two international examples. Let's take Hong Kong and Singapore. The success in Singapore has not been followed in Hong Kong.
Yes.
So let's be clear that you can either go the right way or you can go the wrong way. Hong Kong didn't go the right way. There were lots of issues in terms of the Hong Kong REITs which did not work as successful. The Singapore REIT has succeeded beyond imagination. And that's why probably the conservativeness in terms of size in the beginning is what SEBI has suggested, though I agree with you and I disagree with SEBI on the higher size. So I'm with you, Mr. Sethi. But the point is that one of the reasons why SEBI was conservative in the initial stages to do it is that they are very keen that we should be Singaporean way, which has succeeded hugely as compared to Hong Kong, where you saw a fall in prices in terms of REITs because wrong type of properties went into the REITs portfolio as compared to
how do you
Singapore.
filter that?
Yeah, that's exactly the point. That's why they said that in the initial stages, they'd like to see larger sizes of REITs, which are well managed and well portfolioed, rather than having that across the board in the initial stages so that there could be more effective control in that part of it, is what is visualized by SEBI at the first instance. Again, I disagree with that, but that's the view which SEBI had on the table when I argued with them that about the size. Exactly what Mr. Sethi said was one of our arguments with SEBI, that why should it be 500 crores plus, every one of them? Why, I mean, how do you really, it didn't make sense actually.
So you're saying large is good?
No, they said they expected that HDFC, ICICI, larger funds, even the international banks and financial institutions and others would come at the first instance with larger sums of money where, where the transparency and the best practices would come on the table at the first stages so that at least you have the first round of great successes story coming on the table, instead of the other way around where the first stories would not be successful.
So I want to throw in one
Which is
angle.
exactly what happened in Hong Kong. I mean, let me say Hong Kong has gone the wrong
wrong
way.
way.
And it's a very sad story that Hong Kong has not succeeded, while Singapore has succeeded beyond imagination.
But I think Niranjan says Singapore succeeded because the second most transparent economy in the world after Australia. But I wanted to throw in another angle if you can answer this. So if there is anybody from the valuation department in the audience, thinking caps on, and we're going to start some Q&A very shortly, so giving you a heads up. Imagine there's a grade A asset. It's a question for all of us. Fully leased, grade A occupier profile, and that some of the rental stream actually includes rental of HT power being drawn but converted into LT power and being charged at a higher power tariff to the tenant, and there's an income stream that is coming out not linked to the asset but to the service drawn from the asset. I wanted to understand how would you value that if there are any experts on the valuation, and imagine that asset getting listed at 20% premium at the REIT, and first cycle of market corrections or renewal, you see renewals happening at 20% at a lower rentals than forecasted. This is one of the many that I witness. Every day I make a living out of this. And I'm telling you, 20 rupees per square feet just on HTLT Delta on a AAA asset, which is very likely to be listed, the first listing probably. How would you address issues like that? And there are many more.
I can add one more. The government of India, the Prime Minister and the Commerce Ministry made a commitment to all investors coming into India that SEZs would be tax-free for 10 years. And then they decided that the Prime Minister and the Commerce Ministry doesn't make sense, so the Finance Ministry decided to put MAT, so you put a tax of 18% on the net profit. Correct. So if you're listed before MAT came into the picture, then you would calculate on the basis of a zero tax portfolio. Nitish Bhai would confirm the tax rate and the issues, which I'm not as expert on, but I suffered on that side. So I know a lot about it because of sufferance, not from a law point of view. But at the end of the day, that listing would obviously make a difference because there will be a 20% difference in the listing price to add to the type of example you have given, which is, But here the government, after making a commitment at the level of the Prime Minister and the Commerce Ministry of India goes and backtracks after 3 years after the money has come in. So you're going to get strange...
That's why government, everybody says is going to lose.
That's a good angle.
Don't get me wrong, I'm not being judgmental.
That's a good angle.
It's not a legal opinion either. But
I think that's not a bad answer at all.
Everybody says, I don't say.
Yes.
The point is, I think you asked a question. A small man like me, you're standing outside the stock market. Would I invest in the REITs or not? I think that was the starting point, right? There are two answers to that. Number one is that this time the regulations which we are proposing, I think are much better than what they were 4 or 5 years ago. So transparency and the related party transactions are the biggest stumbling blocks in any valuation, and that is really hitting it. So there is one side, so regulation has taken care of small investor in many ways, nothing is 100% perfect. And second, it will be for the industry to show governance and one step ahead of what elsewhere, because if you, howsoever good regulations you have, if industry and real estate with respect, there are few people like you and some others, in the industry, but there are a lot of malpractices going on. The image and the governance, so I think selling on that side also will be very helpful. So, governance and the regulations put together, I think.
And the institution will bring the best practices. So I think we headed towards closure. There's something
just one small point on this. You spoke about somebody standing outside the Dalal's street and wanting to invest. There's a lot of discussion and debate about the minimum ticket size as well.
Yeah.
Right? So SEBI, after hearing everything, said 2 lakhs minimum ticket size. Now, obviously, somebody who's going to invest 2 lakhs will have a net worth of, beyond that. Right? So they deliberately stopped a 5,000 rupee or a 10,000 investment out of this. Right? And coupled with the size of thing, I think where they were coming from, it's more likely to result in better governance and have a more sophisticated investor investing rather than just the retail.
Which is the right way to go about it. Yeah. Thank you very much. Sorry.
I'll just like to add on this. You were talking of romance with capital market, and probably you were hinting at the people who have burnt their finger in real estate companies.
And many other things beside fingers.
Many other things, their shirts also. Well, investing in real estate company and investing in REIT, they are two different things.
Yeah.
When you are investing in real estate company, you are giving total discretion to the builder. What he wants, what fanciful thoughts he is having, right or wrong. Here, things are much more disciplined. Notwithstanding that, investors have to be educated. Like you are saying, in Hong Kong, it was not a success story. In Singapore, it was a success story. And Singapore is the only country which has capped its leverage to a very conservative level, 35%.
Which is very good.
Probably because
conservative.
Despite that, there have been problems all across. For example, in Hong Kong, liquidity has been a big problem because of bad assets going into it. In Singapore, some failures have been there. In Japan, one of the big problems which was noticed was that there was a lot of vested interest between managers who were external and the REITs itself. And the return across this kind of REITs was significantly inferior to REITs which were internally managed. So there is a need of education amongst investors. They should not jump in just thinking that their money will triple in 3 years.
So education you highlighted is very important.
Very important.
Great. I think the house is open for Q&A. Before we give a round of applause to our panelists, if there's anybody in the audience wanted to ask any question. Great. I think, thank you very much, the panelists. A round of applause to all.
Nice.
Thank you. Pleasure to see you. Pleasure to see you.
My pleasure.
There is a publication on REIT in case you guys want to have a copy collected.
Personally,
so it's comprehensive.
Thank you.
I started with scrapping of ULC.
Sure.
And
may I request Mr. That to do the honors and present matters to the panelists, starting off with gentlemen to your extreme right, to the audience's extreme right rather, to your left, Mr. Dutt. To Nishit Desai, Founder Managing Partner, Nishit Desai Associates. Gautam Mehra, congratulations. To Mr. Alam. Mr. Hiranandani. Mr. Sethi. Mr. Desai. And Yes, of course. Do us the honors. I request Mr. Hirandani to do the honors and present. May I request a photo opportunity with the panel, a full photograph. Thank you. Ladies and gentlemen, we'll give a round of applause for this panel. Exciting discussion, finished well in time. Thank you, Mr. Dutt. Thank you, gentlemen. We'll have a 5-minute recharge break. We'll be back with the next panel, which is already ready with us. So don't go away. Be back with us in 5. Just to remind you, if you still haven't put your cards in at the Porsche desk to win a Porsche free for a day, please do so right now, because probably after the next session, we shall have a draw, and if you're in the hall and your name is called, you have that Porsche for a day. welcome back. Thank you for being back with us. After such a long tea break, I was wondering if you guys had already gone for a drive in the Porsche. Good to see all you guys back. We've got two more very interesting sessions before we wind up for the day and we find out who's going to drive in the Porsche. This session is on securing debt financing, and we have the moderator for this session, who's the co-founder and director for Kotak Realty Fund. He brings to the dais a wealth of experience, almost 2 decades, 17 years actually, in investment management and corporate finance. His former experiences include, of course, Jones Lang LaSalle and C.B. Richard Ellis. Ladies and gentlemen, your moderator, V. Hari Krishna. Sir. Seated next to Mr. V. Hari Krishna, we have the lone lady on the panel. She is a director and VC with Milestone Capital with various experiences. She leads the management of 8 private equity funds, equity schemes with an AUM of 32,000 crore rupees. She's also a member on the real estate panel of FICCI. Ruby Arya. Next to Ruby, at her left-hand side, yes, we got that correct, we have Sailesh Srinivasan Gopalan, my apologies, Srinivasan Gopalan. He is the CEO and CFO of the Vadva Group. He also brings a wealth of experience, started off in the financial departments of chemical companies like Ghada Chemicals and ChemBoss International. He was last the CEO of Rotu Technologies, Life Sciences and Chemical Organizations, and now, of course, he is with the Vadva Group. This end of the panel, we have Amar Mirani, who is the CEO, Xander Finance. His experiences include Lazard India, ILFS, PricewaterhouseCoopers, and head of the real estate vertical for Kotak Investment Banking. With about 15 years of investment banking experience, he now heads Xander's credit platform in India and oversees the regulatory and financing areas of Xander Finance. Completing the panel, we have Shehzad Madon, who is the head PMS and alternative assets for Reliance Capital. He's best known as being the guiding force behind the launch of the first ever real estate offering via the PMS route. With about 25 years in the industry, encompassing banking, investment management, and financial services, he's here with us today. Thank you, sir, for being with us. We have a dropout from the panel, and that is purely due to personal reasons. We will not be having Mr. Ambrish Singh of DSP Merrill Lynch Credit Capital with us today because very suddenly there was a family emergency and he's not with us. But we have an eminent panel. We would, of course, miss Ambrish Singh. And now it's time to hand you over to your moderator for secure debt financing, Mr. V. Krishna.
Thank you.
Thank you, sir.
Post-2008, structuring has obviously become a bad word. It's probably right up there with cannibalism and Yuvraj Singh. But I guess on today's panel, we will try and delve into the real issues that a lot of the debt capital providers and debt capital absorbers are facing at this point in time, and indulge in a bit of crystal ball gazing as well to see how things sort of pan out. Now, coming to the panel discussion format itself, one, I've been watching a lot of times now, prime time hour, so that's one alternative. The other alternative is I could pose a few questions to all of you, and then please feel free to jump in and add to that. And may I caveat the audience that the composition of the panel is entirely it's accidental because there are 4 capital providers and 1 capital recipient here. So let me start with the capital recipient.
I have enough appetite though.
So Sheen, let me ask you a question. Do you think that the real estate companies, developers such as yourselves, actually make the kind of returns which would justify the debt financing rates which are prevalent in the industry at this point in time? And 2, why is there lack of equity, especially so in the last few years? What's your take on that?
Very good question. I think I was just been sharing who makes money in this entire value chain. To be very honest, we are primarily very Mumbai focused developers, and if you buy land at the current prices, the margins are not at 18-20% that we are talking about. So I think as institutions, you need to get wary when someone borrows at 20-22%, because he may, and if he doesn't negotiate at all, right? Because he may be wanting to just pay you your 20-22% and not the 100 rupees that you have given. So somewhere there has to be correction. Two places where there need to be correction. One is in the land price itself. So that at some point in time has to go down if this industry has to survive. The second thing that we are facing is the cost. The cost that we put on the Excel sheet when we buy the land and where we land up, there is a difference of at least 50%. So because of a new law that keeps coming, fungible comes on one day, and then there are some of the committees just don't sit for years together, and the cost of holding it actually kills you. So if there is an efficient system, then I think we will make around 16 to 20%, and if we run the system well, external as well as internal, and in that case banks construction finance can charge us 12 to 13%, and Shahzad can charge us 16 to 18%. But under the current circumstances, I think what most developers would be doing is to replace one debt with another, or they would be funding the interest through these high costs. So that is where I think you as institutions need to be really wary as to where is this money actually getting used. Is it for servicing or is it for replacing a debt? Somewhere the color would be that is my assessment. Coming to the second question of why is there no equity? I think unfortunately developers have something called an appetite for infinite risk taking, right? And when we actually sit across and negotiate with a private equity guy for pure equity, we assume that he will have a similar equity risk taking ability as what we have, which can never match. So the valuation game it just doesn't happen. So when there is no clear equity coming in, and I don't really blame, because there are so many uncertainties that you will have absolutely no control of. Once you give money to a developer, then the developer runs the show, and we would prefer that you don't interfere, because your USP is money and our USP is running this thing. Given that, you don't know whether we will get permissions or not. How innovative have we been in our design to get our permissions? So given that, I don't blame. There should not be pure equity from a pure institution. There should be a strategic tie-up where both are developers and have equal appetite to do something. That is where the real equity can come. Then comes the structured deals, which is the topic for today. I believe today the financial world talks about more structures than what we make. We make the real concrete structures, but there are so many exotic structures that people talk about. Ultimately, these are all debt. Somewhere you need your capital protection, somewhere you need your minimum return. You may take a 5% risk here and there. So equity to come into this country first needs a policy at the top which ensures that there is an exit time which is finite if the developer knows his business. So unless and until that happens, I don't think we will see pure equity coming.
Do you want to add to that?
See, on the first point, I have a view which is different from Srini's.
Please don't say that.
It's as follows. My sense is that the higher cost lending, and when I refer to higher cost, I'm talking 18 plus, right? It's sort of fixed with little variable, etc. Typically is for land funding. My sense is land funding almost ever, if you look at history, has never been cheaper. In fact, it's always been 20 and 20 plus. That's our sense of it. In fact, more often than not, I could argue that more money is available today with more competition among lenders, and it explains that there is one developer and so 4 sort of financiers sitting here, right? There is that much more competition for lending, and there's always somebody new, there's somebody else coming out. So my sense is that I don't think the rates are exorbitant. I can understand from a developer's perspective, and I completely take Srini's point here that what's really impacted a lot of the, in terms of calculations, is especially approvals and the time taken. So let's just say if I had borrowed 100 rupees and I had assumed that I'm going to get cracking and I'll go out and start selling. When I realized that, यार ये तो 2 साल लग गया approval में, तो 2 साल में मेरा 20% का meter चढ़ रहा है, so to speak. That makes it unaffordable. So I guess the approvals and all the other costs which have come off have that sense made it difficult. Bombay more so also, if anyone had used some of that leverage partly for doing commercial, and a lot of the, let us say, difficult situation developers are in some cases, not in all, is on account of the, what's happened in the commercial market, which we all know, more so in Mumbai. When you stack this all up, it's at this point in time that and when you break it up project by project, if you took something like a higher rate on commercial, that didn't make sense, so to speak, or it's not making economic sense at this point in time. But longer term, when you look at it, all things said, all put together, you look at it this way, look at the last few years, look at projects which developers did over the last few years. Generally, they have not been, even at a 20-ish% rate, they've got return. The other thing which I would just, sort of remind everybody here is that it's not just the margin, it's the ROE. Example, see, a lot of people, leverage. Srini spoke about the infinite capacity for sort of risk. If there's 80% leverage, 20% equity, and chances are sometimes, not in all cases, the 20% too is borrowed from someplace else. When you actually look at the equity return, and even if you're talking about a smaller margin, if you're talking about a far smaller margin, in terms of the ROE on the developer's investment is large. 50 crore dal ke, he does 1,500 crore, 2,000 crore ka, plus top line, 2,000 crore ka project. So when you look at the, net, even if you make 150 crores on that ends up in terms of ROE a fair amount. So, my submission would be that from a land financing perspective, these rates are probably reasonable. As far as the second point which Srini did mention on the equity part, and I completely agree with him that, there's a risk mismatch in terms of appetite between the developer and, let's say, most funds or most fund houses or most investors, including ourselves. But one other thing which I'd like is that, in many ways, there are two points which I just want to make. Very often on the, sort of debt return or debt mezz return, when you're getting 18 to 22, why stress yourself too much about equity? Jab mile nahi mile, Bhagwan janta hai. Might as well take what you have in hand. Beast for most guys is good, right? So that's one reason. That's one reason which you would want to. The other reason is historically, and maybe that's a learning process. We've seen that in every market. You've seen that in the listed equity space too. The initial phase, not all investors had a very happy experience. Of course, you could argue not all developers too had a very happy experience with investors, but you know what happened to a lot of investors, and they never ended up making money. Because if people make the money, I'm sure the money will be available. If investors start making money, they will find a route, they will find a way to get the money back. So net, that's my take on both these points. That current rates, assuming you have a more, let us say, a smoothened out approval process, things work a little more as per expectation, maybe they could sustain. That's my sense.
Thanks. Ruby, let me ask you this question. How have you seen the market evolve over the last 3 to 4 years, especially on debt or equity kind of mixes? And could you also comment on the fact that whilst equity is getting raised, certainly in the residential vehicles as well, you have seen Godrej APG joint venture. Similarly, there has been a joint venture between Mahindra Lifescapes and Accenture. So there is equity clearly available, not as much as probably what's available in the office space market where there is significant equity. How do you see this? How do you see this evolving over the next few years?
So just to sort of take you back into the evolution stage, and probably I'll delve even earlier than 3 to 4 years. So if you sort of look post 2005 and the pre-crisis era, I mean, all the deals that were inked, especially in the residential, in the real estate space, were all equity deals. And there was a reason to it because, there was a sudden influx of money, there was a rush to invest, there was more money chasing very few deals, and hence you found that, there were valuations were high, people took exorbitant risks, the project timelines were not dealt with properly, and people just invested the monies. And not all of that investment has really yielded returns, if you look at it. Then what happened is after the crisis, I mean, we saw 2009 to 2000 era was all structured debt lending. Because people realized that, you've taken a risk, you've lent money in equity, but has it really given you the returns that you were looking for? Probably not. And again, there was a liquidity crunch, and the bank financing was not available for the, the land stage. And you could get structured debt at an early stage. There was no end-use restriction. The developer could use it for growth capital, for, taking money out, putting it in the project. And hence, there was an alignment of interest between the developer and the investor. So you saw a lot of structured deals, taking place. However, we realized that there were deals as high as 24%, 27%, which has got inked. But, of course, a lot of refinancing options have now come into the market, and are we able to sustain those high IRRs? Probably not. So now we feel that there will be and this is a different point of view than what Srini said. I personally feel that it will come a full cycle, all the way, and there will be a comeback of equity, but in a slower fashion. So, you will see the interest rates probably coming down, maybe in a year or two's time, and which is when these rates at which you lend to the developers will also come down, which is when you will find that, top developers, I mean, we named the Godrej, we named Mahindra Life Spaces. I mean, these kind of developers, they will be they have already attracted equity capital, and, they are the kind of people who have a good corporate governance, transparency, and investors will want to participate with them with equity capital. Also, the other set of developers which will probably be able to attract equity is the kind of people like Shehzad mentioned who've given returns. So if you've given returns on the whether it was equity deal or a structured debt deal, I'm sure you will be able to attract equity capital. In the commercial space, of course, most of the deals that are there are equity in nature. And Milestone themselves has, in fact, we've done all kinds of deals, so we've done pure equity, we've done preferred equity, we've done structured debt, we've done debt with equity upside. So, I mean, I personally think that depending on who you are lending money to, there will be a lot of hybrid of debt and equity that you will find in the market, and probably that's the way to go. But yes, for the moment, as long as the valuations remain high, the liquidity crunch remains, the developers are stressed, sorry, I mean, no offense meant, but, as long as that is the system, I think, for some more time, structured debt will remain the flavor. But will equity not come back? Yes, definitely it will.
Thanks.
That's very encouraging.
Shehzad, could you comment on what's the sort of appetite out there in terms of undrawn capital commitments or otherwise amongst the different capital sources, whether it be wealth management-led private equity firms or global private equity firms or mutual funds or whoever else? And do you see any difference in the risk appetite amongst these 3 or 4 different capital sources? Okay. And Amar, if you could weigh in on that subsequent to that.
Sure. Okay. My sense is that when you look at it, of course, there are a lot of funds who've raised. There is some amount of undrawn capital. There are a lot of wealth managers raising money. There are people doing direct deals. There are funds under AIF. There's offshore money. There's equity. There's just about everything. One of the, just to add to what my colleague said here is that, globally, just before I start answering more specifically, that there's been the last few years, it's been the years of debt, not just in India, but globally. People haven't been that much open to taking equity, but in general preferred more sort of debt, and debt has yielded fairly well, both in India as well as overseas. And I'm not referring to just the real estate space, I'm referring to the overall markets. As far as appetite is concerned, as things stand, my sense is that, Hari, appetite here, it's almost limitless. The constraint is supply, it's not demand. That's my sense, is that there is more demand for, let's put it this way, if you could get good quality investment or good quality paper which could yield you, well, anything in the category we spoke about, 18 to 22, right? I don't see any limitation in terms of appetite, right? You look at it, it's today that the various funds all have had a fairly good reception. And to those, I think somebody made this point here, to those who've been able to deliver, both on equity, there's no shortage of equity, as well as on debt. In fact, you know the situation out there, since a lot of people on the panel as well as out there are practitioners, that there's a competition for refinance. You do a deal and then somebody's ready to take you out in 1.5 years or so forth. So in terms of the fund availability, it's my sense it's fairly good. Certainly in the, call it the AIF space, the VC space, people who had fundraisers, all have done well. The key challenge is to be able to deliver. I guess, a very, very generic statement, a very, very generic statement, that, there's no shortage of money. It's about confidence. And if people believe that party X or party Y, be that a fund house or a developer, is delivering, they've never seen, to my mind, a sort of a shortfall of money. So that's just my take on it. I think just on this in terms of appetite too, I would imagine, and it comes back again to this, that on the equity side there could be, but again timelines get a little more elongated. I'm saying even if the returns come through, even if multiples are higher, that I put in 100 rupees, I take back 250 rupees maybe after a period of time, but the timelines get higher, and at this point in time at least, and maybe in the near future, people want to see cash flow come back. They're not so interested in the longest told story. 5 साल बाद क्या होगा? वो पहले cash flow थोड़ा देख लेंगे. It's sort of that. So I'm not sure if I've answered your question, but I think there's a lot of appetite, both domestic, and I'm sure Amar will put more on international too. But our sense is, again, it gets supply constrained. You can't give investable names or investable deals to offshore investors. That's my sense.
Amar, you want to add to that?
Yeah, I'll just add, and a lot of points may overlap with what various panelists have said. Now, as far as we see the last few years, these have been debt-oriented, debt-dominated years for a multiple set of reasons. One is, of course, equity did not perform since 2006-07 and then the crisis. Second is that various corporate governance practices, not just of developers, but across India, across various sectors, we saw that there was a significant shortfall between what was promised out in the mid-2000s to what happened in the late 2000s until now. Exits did not happen to the extent desired. 20 billion came in, 3 to 4 billion got exited. So it's a multitude of reasons, and that's why everybody found a convenient way out in debt. Now, if we just rewind ourselves, let's say 15 years back, which is when, let's say, I started my career, it was, again, very similar circumstances in the mid to late 90s, wherein coalition government, less decision making on the macro front, currency crisis, Asian crisis, interest rates going up. So SBI PLR then was 15.5%, today it's around 15%. 1996, 2013-14. It came down all the way to 10.25% in the mid-2000s, it's gone back. And I'm sure it will come down, it's a cycle, ultimately cycles do play out. So all I'm trying to say is that equity will come back, but it won't be the kind of equity rush that we saw in the mid-2000s. It will be far more muted, at least to start with, till people gain confidence, till people deliver returns and are able to exit with at least a semblance of profit compared to what has happened in the last 10 years. Real estate and non-real estate both. I'm not just saying real estate. Because if you look at the private equity experience in non-real estate, exits and performance of companies and the governance have been separate and significant issues. Now, as far as fundraising is concerned for real estate, we have seen a spate of real estate issuances, real estate funds issuing their paper either to HNIs in India or institutions in India and offshore. And this money is slowly seeping its way into the market. Now, what happens to the market in terms of rates? Obviously, the rates are coming down and will come down as time goes by in the next few months. Particularly with elections beyond in the next 1 or 2 months. And however, I don't see that happening very fast, but yeah, rates will come down, A, because of more capital from HNIs and from funds, and B, because also banks will slowly start turning on the taps of lending to real estate. So if you again go back and see how banks have been lending to real estate in the last, say, 6 to 7 years since 2008, bank exposure to real estate was around $8 billion in 2007-08. It's about 24-25 billion today. Bank's exposure to NBFCs was around 8 billion in 2007-08. It's about 48 billion today. So what it means, it basically shows that banks are lending to NBFCs and NBFCs are lending to real estate. Banks to real estate has been far more muted because of what happened in in the mid 2000s, and RBI has taken a cautious stance to banks, and therefore they have been holding back a bit. So post-elections, new government, RBI governor may just say that, yeah, let's look at a revival and let's look at a situation where we're looking at a more calibrated increase in funding from banks. And if that happens, then obviously rates will come down faster. As far as equity is concerned, that also we're seeing signs of equity money coming in. The base, if one can call it that, is getting formed in terms of equity capital getting attracted. Appetite is there, interest is there. Structures have all become conducive for getting equity money. So it's some time away because people have to deliver and get some returns and some exits. And then I think equity money will come in. What it would mean is that once more equity money comes in, refinancing will be a lesser risk than what we see today while we enter a transaction. And therefore, while the volume of transactions would go up, rates would come down is what my general assessment would be.
Do you see any parallels between the China's shadow banking crisis with what you're seeing on ground in India in terms of debt capital raising and allocation and everything else? Do you think there are any parallels at all?
It's similar in some ways, but there are quite a few differences. So I don't think that there is, there are some bit of similarities, but again in India it's far less, it's far more muted than what it is in China. It's far more restricted to a few cities in terms of what the funding goes into. It's not as rampant and as unrestricted and unbridled as what it is in China. So there's a fair bit of difference. And even today, as one looks at when we're doing transactions in India, for example, it is still fairly under control in terms of the credit standards, the underwriting, the processes that all of us across the industry follow. Sure. So it is nowhere close to either a bubble or a overhyped situation what it is perhaps in China, is what my submission would be.
Sure. And this is a question to the entire panel, and Shehzad, you can probably comment on it as well. Do you think there is adequate appreciation of the risk involved in providing this sort of debt capital? And I would draw two reference points. One hears of a lot of the mutual funds, debt schemes, FMP plans, etc., providing capital for land acquisition financing at interest rates which are in the range of 10 to 13%, as against a lot of the capital which is being provided by NBFCs and private equity funds at fairly significantly higher rates. And also, given that the foreclosure experience, the asset sale, asset divestment experience is fairly limited in India. Sure. So if you could comment on that. And sure. I would certainly need a comment from Srini, who's on the opposite side of the table.
See, one, just in terms of, before I directly address your question, one thing which I just want to leave on the table, and I'm sure most people will agree with me, that the risk in real estate primarily is, I think as a security, real estate has generally been a wonderful security, possibly the best security ever that you have, and I'm not commenting internationally, but certainly domestically. It's a good, solid security, and as yet generally has not lost value. So unless you got your title horribly wrong, generally it's great security, great, and the best security, right? The risks come more in terms of liquidity, i.e. it's a wonderfully safe and a solid asset. It's not a liquid asset. Especially, your ability to monetize an asset, especially if it's a large land parcel, etc., is a little limited. So the earlier you come in, obviously the more risks you run. So with that general statement as a backdrop, I just want to make the following statements. That, see, one, in general, my sense is, and I am not speaking here, that we understand and others don't, but I'm not sure there is enough of appreciation of risk across all players. Because when you really look at it, the guys who've been in the market for a long time, when I say long time in this business, is about 10, 12 years. Because that's pretty much, I'm not saying from the developer side, but from the financer side, who probably got more experience. And there is a lot, like in any bull market, and we've seen a pretty robust bull market, at least for financing of real estate in the last some time. A lot of newer players, etc., a lot of money available. And my sense is that there's probably not too much of appreciation in terms of the due diligence, the effort, the nuances of each market, and so on and so forth. And that's probably, you will see some amount, and you've already seen it even in the, call it the NBFC high yield space. So I would imagine you will see more of that going forward. So far, you've not even had too much of an opportunity to see it, because kuch bhi hai, to there's enough of refinancing opportunity, to always someone to take you out 1.5, 2 years later. If you have a slightly tighter market, then people's underwriting standards and all also may be that much more visible. In terms of the last point you did mention about funding by mutual funds at lower rates of interest. See, my sense is, okay, if you just look at the history, at one point in time, the mutual funds did some amount of lending like that, but that was probably more in the unsecured space in terms of CPs, etc., but that was in this 07 period. Since then, most have stayed away. There is limited participation in terms of, you did mention some deals and some names, and without getting into the specifics of that, because beyond a point when only years, one doesn't know the actual what's happened there. But my sense is that stayed limited, and I suspect it would stay limited to more of names where it's corporatized, and not that others aren't corporatized or something, but what I meant where you have another business to sort of lean back on, or cash flows from another business or something that way. And that's my sense. I would be, this is just my sense, and there could be people who are better informed than me. I don't think this will reach the scale it reached earlier. That's again my take, and I don't think it would, I imagine it would stay very limited to a narrow apex, right? Sorry, a very, very narrow level right on top. It would not go too much down. That's at least my sense, because I don't think investors underlying, and the investors in a lot of the funds are, especially a lot of the corporate types and so on, look, if they wanted to chase the high yield, they could have come to maybe any of us. They didn't know to go, you don't need to go through an MF to play that game. So I'm not sure there will be. I'm not sure it would get that much more rampant.
So absolutely. As far as MFs are concerned, I think the primary consideration they would employ is a credit rating. And typically what we've seen is in real estate, even the best of developers don't get even half as good a rating as they perhaps should have got had they been normal corporates in other sectors. So if they wear the blinkers of a rating and only then filter out and then they look at proposals, I think 99.9% developers will not meet the grade, and therefore it's not really a source of financing as much as it should be, and because ultimately it is a low cost financing, but it's not really taken off because of this strong reason. Of course there are some stray instances, and that also, like Shehzad mentioned earlier, even those have been in the late 2000s or 2006, 7 and perhaps 8, where stray mutual fund treasuries from some allocations could have done it, but now I don't see that happening also.
So, and just one more thing, typically the MF prefers 1.5-2 saal ka funding. That doesn't really fit in with the.
So there's a duration discount.
There's
as well.
a duration difference. Now, of course, if you say that it's sort of bridge funding, etc., which could well be the case, but then that comes with its own risks.
So the way, therefore, it works, the market has evolved is that MF provides money to the NBFC, NBFC provides money to the real estate provider. So that's how the market.
But some mutual funds are breaking that chain.
Yeah. So some mutual funds absolutely are funding NBFCs, and that's how it's working. So.
Srini, what's your take on this?
I would love to have these mutual funds lending to be at 10-13%. But as you rightly said, real estate unfortunately is an untouchable. Right? Just because you belong to that sector, you don't get a AA, वो तो नहीं मिलेगा, आपको B के बाद बात करो. So under these circumstances, I don't know how an investor will even evaluate a real estate company. The second thing comes on the transparency. What kind of transparency do these real estate companies maintain? You've mentioned a few corporates. Their background is corporate, like Mahindra and Godrej. They have sold soaps and jeeps, right? So from there they come into a real estate game where they have this Pushtani land with them, and then they are working on it. So they are not developers as far as I am concerned. They are corporates. They have their culture, which is very different from developers who actually till the land. We are people who identify the land, look at the vibration, do some Excel sheets, and then go by the gut and go build buildings. So unless and until this becomes a regulated market with complete transparency, we will not get access to cheap funding. And I don't, I'm not against it. We want transparency to come in. For developers, at least like us, we try to follow all corporate standards in order to maintain transparency. But we get lagged out just because we belong to this industry. So I'm not very sure. We were looking for issuing some bonds. And if I want something like 13 to 14%, which from an industry standard, it would be very high, I need a AA+. And I know that it's a futile exercise for me to try that. On the other hand, from the risk point of view, from a security point of view, once the asset is created, Hari, I think this is the best security that you can ever have. You want to lend to a chemical factory which has got boilers and it will have some clariflocculators, whatever names that we won't even be able to, and you are okay to take that security and lend at 12%. And if there is a default there, I don't know what will you do with those green and red pipes. Here at least, there are homes where you and I can live, if I'm not able to liquidate. And these are real either offices where you would want to move. I mean, you are a great example, right? In BKC, moved into an office space, which no comment. So here is an asset which is completely secure. Here is an asset which has got alternative uses. May not tell me something. The shares of a company, these are bloody paper. I am providing you with brick, steel, sweat, blood, everything in that, and yet it's a security which has got provisioning which is more than any other industry. So long as you don't treat us like an industry, and so long as developers don't treat themselves responsibly, cheaper finance is going to be a challenge. I do agree for a developer like Vadva, there is a lot of money chasing us. And yet the questions that come is, yes, why do I come to you? Is because you have delivered in the past. However, there are no concessions on the costing. Right? There are no concessions on the due diligence that will be done on to you. We will evaluate you as a Dawood Ibrahim. Okay? We will check, we will frisk to see whether you are carrying bombs with you. So that is the kind of an attitude, and maybe it is because of the past, it is because of how other developers have behaved, who have gunmen protecting themselves. But unless and until this taboo is removed out of the real estate this thing, we will see these things happening. I'm very happy to hear from my colleagues saying that equity capital will come in. And we have exited 7 funds with what has been documented as returns. Okay? No negotiation at the time of repayment, and repayment done exactly 3 years from the date when you have taken. I don't see anyone chasing me to say that here is the money and I trust you. I still don't trust you because you belong to a category which I don't like, but I know I'll make more money through you only. Okay, because nobody else makes a return like you provide. Tum sharif ho, that's why I'm coming to you. The very fact that I've knocked at your door is because of your past performance, but nothing else. So I think things should evolve, and developers also need to demonstrate that they are transparent and they can deliver. There is so much of stock available today, Hari, but I don't believe that that is the stock which is offered is not the stock. The stock is really the lock and key that comes to you. What has been the delivery of this guy, and then you look at the costing, then you look at the kind of due diligence that you want to do. Today, institutions have become larger developers than developers themselves. The first question is, environment में कहाँ पे अटका है तुम्हारा project? अरे अटका किधर है? There is a process. I have applied for environment. It takes 6 months. It takes 9 months for a baby. That is acceptable. But 6 months for an environment is not acceptable. And for no fault of mine, I have done my duty. Like a father, I have done my duty here as well. But these are the questions that come. So, please treat us like human beings. All of us are not Dawods. Trust me, we are the people who can give you the best returns than any other asset class. You take gold, you take shares, you take real estate. Even during a mandi or a slowdown, real estate will give you, because we want to liquidate stock. We want to run a business. And banks are against us. We have private equity guys who are friendly with us at a high cost. And so that, I don't know how friendly that was. So what कर क्या सकते हैं?
I'm going to send you a therapy wheel for getting your lunch right. So Ruby, let me ask you this question. First, if you could comment on the risk appreciation. And two, when you underwrite a transaction, are you as vigilant and are you as involved from an asset management standpoint if it's an equity transaction? Is there any difference in the underwriting standards? Just because it's a debt transaction, do you look at it differently?
Sure, I mean, just to take forward from what Srini said, I mean, let us understand, we keep talking structured debt, equity. I mean, at the end of the day, all of this security is a comfort that you are taking. I mean, I don't know of any instance when you've actually enforced that security. So it is at the end of the day, what you have to see is how you are underwriting the project. Are you factoring in all the risks? Are you ensuring that your project stays on track? I mean, are there cost overruns? Are there time overruns? How well are you managing it? I mean, that is what is important. Whether it is a debt deal or an equity deal is just a structuring of, it's just a structuring mechanism. But the basics will remain the same, So a real estate fund house, if they are lending money to a developer under whatever structure it may be, will have to ensure that you actively manage the project. You, sort of institutionalize everything in the value chain. So, your sales are happening. If your approvals are stuck, what can be done? There are certain things that we can't control, but at the same time, you have to ensure that in your organization, you have a mechanism to be able to monitor everything. I mean, structured debt is just a tactical opportunity. I mean, if we could lend money to you at 24%, 25%, we did that. Tomorrow, you may not want to take, I mean, when I say you, it doesn't mean you, but...
I would still not want to take.
So, developers may not want to take money at those levels, if interest rates come down and, they may not want to take money, which is when you will have to trust them for their competence of actually delivering on the project and just ensure that they deliver. So I think that is important, so, and when I say, I mean, you have to have a downside protection, so you have a downside protection, you partnered with the right, developer partners, you are monitoring the project. debt or equity is just a structuring mechanism, but at the end of the day, you have to do what you have to do to ensure that you are able to get those returns and deliver it back to your investors.
Right. According to sort of variety of different estimates, the Indian banking sector has a hole anywhere between $15 billion to $30 billion. And these are a variety of different estimates, largely stemming from the infrastructure debt financing that they have provided. Now, how do you see, Amar, for instance, if you could comment on that, how do you see that impacting our end of the business? Do you see banks withdrawing because they do not have the capital going forward? It'll take some time to fill up this hole. There'll be cash flow issues. How do you see this impacting our end of the business?
So, till 2007, 6-7, everything was hunky-dory. Banks were lending freely. Everybody was lending to developers. But then brakes were applied, and that's not just in India, but even in Europe, for example, banks have actually held back, and capital to so-called riskier areas like infrastructure, real estate, or early stage ventures has been moved from either private equity or specialist entities like NBFCs in India. And the same situation also happened in India from 2008-9 onwards. So as I mentioned earlier, in 2007-8, banks' real estate book was about $8 billion. Today it's about $24 billion, 3 times in 7 years. Now going forward, and the growth has been pretty much organic in line with banks' overall increase in exposure with all the other sectors. So for instance, banks' real estate exposure is between 3 and 3.5% on the whole, as a percentage of the overall lending to all sectors, including agriculture, put together. Now, if tomorrow banks decide to start funding once again, obviously it will have repercussions on what we just spoke about. But coming back to the bank side of the equation, today if you look at banks' balance sheets, so if you spoke to any banker from March 1 to March 31st last month, none of them would have the time to meet you for normal proposals. Everybody would be in the restructuring and the NPA recovery mode. Everybody, right, from the CMD to the manager. And therefore, now that that is out of the way, again, same thing may happen again in June and September and so on. So they are saddled with a huge amount of legacy issues which they have to resolve. But at the same time, all of them have growth aspirations, all of them want to lend money, build a book, list it. So all those considerations also are there, and therefore lending to real estate will, in my mind, start increasing once again in the next quarter or 2 quarters, and that the signs of that are already apparent with the tier 1 developers, and Srini would vouch for that, I guess, in terms of higher lending from banks into acceptable developers in the bank's frame of mind. And that is only an additional source which was there earlier, which will come back once again, which would mean a reduction in our rates, the divergence between equity return and debt return, because today both are in the early 20s, so equity and debt both are the same, the divergence has to happen. Equity will go up to the late 20s, debt will come down to the late teens, and banks would be at 12, 13. So I think that is what will happen in the next year to 2 years. Of course, banks have to, they are restructuring their balance sheets, they are resolving their NPAs, and of course that depends on macro, economy, government, politics and all that. But the change and the shift has happened, in my opinion, and we are seeing banks containing their NPAs, restructuring their books, and taking some more amount of incremental exposures in areas like real estate, if not infra.
Sure. We've spoken quite a bit about the residential end of the business, and but on the commercial real estate side, I would think that there are a lot of changes probably already visible, especially on the structured side. You've been hearing about CMBS. We've been hearing about bullet-only kind of loans. Srini, in your conversations with some of the capital providers, I don't know if you've been reaching out to the insurance companies, mutual funds, and some of these other guys, do you see some of these products actually evolving over the next few years?
See, on the commercial side, the challenge that the developer faces is that it's not as liquidating as a residential one. Residential, we use the sales proceeds for construction as well. But in the commercial, you need to have that wherewithal to really put some 500, 600 crores of your capital and wait for the building to come up. The facade comes up, and then you start the leasing happening. So the desperation of the developer is much higher there, right? So we had this huge deal which fell with Morgan Stanley, where that was for one BKC, where everything happened well, and it was a pure equity deal. With a preferred return, but at least there was no minimum guarantee and those kind of things. But we still feel that investors are averse to construction risk that they would want to take on a commercial asset, and that is why you don't see AAA buildings actually available in Bombay, because the land is so expensive. You land up doing strata sale in order to get the cash flows, and once the building goes through a strata sale kind of a situation, the value significantly drops from an institution perspective. So here there is some kind of innovation that is required from institutions level, where an opportunistic funds ties up with funds like Blackstone, who are wanting to have only the leased asset. That is, you give birth to a baby, make it grow, शादी होने के बाद बच्चा रेडी मुझे चाहिए. So that is the kind of fund that is there on the other side. So you need to map these two. That is an opportunistic fund which is there, and the exit is given by these kind of funds. Once we have those kind of things, you will have buildings like Capital, no strata sold, 1 BKC, no strata sold, completely world-class buildings which are standing there, and the market has to evolve. Currently, we do not have any kind of a product which motivates people like us to go and bid for one more land in Bandra Kurla complex, wherein you land up paying more than 2,000, 2,500 crores only for the land and land related, plus any kind of interest that you need to have to hold those. So I don't think there are any kind of even efforts being taken to forget the developer, to motivate this industry to make world-class products. But similarly, if you look at, if you go say south to say Bangalore or Chennai, where the land cost does not contribute say 60 to 70% of the project cost, is where you also start seeing some good developments, and most of the acquisitions of even leased assets, completed buildings with leased assets happen there and not in Bombay. So very nascent stage on the commercial side, not providing exits to the creators at all.
Sure. Do you have a view on when one might start seeing these innovations, bullet-only kind of loans, CMBS, and what's stopping them?
I guess one of the reasons what's stopping them is people are enjoying the returns on doing the regular stuff so much that why bother yourself with something which may or may not happen or which is innovative. I personally, I would believe there's opportunity in the commercial space, especially given all the pain that one has gone through, and given the fact that when you look at values where they are, especially in Mumbai, I would think that if you have a slightly longer perspective, there is opportunity. Unfortunately, I'm not so sure because we don't manage much of our prop money. We have all third-party money. I don't see that happen as much as from my investor side. It's not that we can't convince them, but it's not as if we haven't struggled to come out with what may be an appropriate structure, but we've not yet been able to crack something on that front. But I do believe there is appetite there, and these things can turn very fast. They can turn on a coin. You just have, let us say, maybe perception of economic growth coming back, maybe post-elections. You have a few licenses. Of course, you've got a few banking licenses. You have something more of that coming through. You have more commercial office space going. You have something on insurance sector going through, and then suddenly you find yourself short of commercial office space. So these things can turn on a coin. And the honest answer is no. I don't have anything which can answer that question today. But we're working on it.
Sure. One final question, Amar. A lot of the groups are trying to obviously address the India real estate debt opportunity, and variety of different routes have been used. The FII debt route, the domestic capital is obviously coming in through the AIF format, and obviously the NBFC opportunity. How do you see, what do you think are the key differences, and what are the different outcomes that you see in different formats, especially with reference to the NBFC versus FII opportunity? How would you want to choose?
So I'll keep it short. So NBFC opportunity versus, let's say, FII, I think it's a question of the vision of the shareholders and sponsors, whether they have a vision for the long term or whether they want to have a transaction by transaction approach. If it's a transaction by transaction approach, then I think the FII, sub-account, listed, rated securities coming in, going out, opportunistic investing is what suits, and it makes sense immensely because of lower taxation also. But if you have a long-term plan to create a platform and to grow the platform in not just the NBFC space but also into other areas of financial services, then notwithstanding the higher rate of tax, people are going ahead with the NBFC option because there's a certain platform value, there's a certain, in some cases, an exit value that some sponsors are focused on, and at some point a potential listing, and therefore that opportunity is, I think, more favored by people who are in the long-term business as a financial services provider. Additionally, the one area that makes a big difference is leverage. So leverage from domestic sources, if one is able to tap, it makes immense sense to go for an NBFC because effectively your post-tax cost of debt would be less than 9.5–10%, and if equity is at whatever late teens, your blended cost of capital comes down, and which would only help you to protect your margins once the rates start coming down. So effectively, domestic leverage is a game changer, and that is what makes a big difference.
Thank you. Depending upon how much time we have, we could take up a few audience questions as well.
These people have had enough of us.
This one.
As developers, we have been trying to innovate to bring down the cost either of the land acquisition or the cost of construction through innovation. Can we expect that the debt funding of the structured institutional financing or the banks, can that be brought down with regulatory influences or with some kind of internal soul searching? Because that would allow much more lending and much more happier wedding for lifetime.
Sure. We will do some soul searching.
I am with him. So
the silence.
Hari, give a commitment. Come on.
I would leave it to Shehzad.
Thank you. Sorry, I'll come back to what I said again, and then I'll just allude to what Srini said. What I said initially, I don't think 20% is high for land funding. Land funding has never been cheaper at 20. Tell me when in history has land funding been cheaper than 20%? It's never been, number one. Number two, developers, in spite of a 20-ish% return, end up making, barring maybe, like you have, look, you can't get all, sub-ball pe to 6 nahi maroge na yaar. It's like this, a lot of the commercial projects.
एक तो लग जावे,
यार
एक
बहुत
तो
सारे
लग जावे
हमारे
शहजाद, एक तो लग
मैं
जावे।
ज़्यादा बोलना नहीं चाहता हूँ. But see, the fact is that 20%, 80% leverage very often, etc. ROEs are very, very comfortable. That's my sense for developers. And I can't see it getting much lower. The risks involved in real estate are there. I think we'd be fooling ourselves if we say, and when I say real risks involved in real estate, all I'm trying to say, the risk primarily comes from a delay perspective. We've seen so many cases happen. Boss, you think everything is going well, suddenly you have all of a sudden a bomb. That bomb can come in the form of a PIL, it can come in the form of anything, even when you have a structure up there, standing. So to say that funding should come significantly below, down to levels where CF, etc. is, in my view, might take some time, and I don't think that makes sense. And the only thing my submission would be here, sir. I'm sure that all the developers here know far more than I do. But whatever little we understand, our sense is, I don't think, barring a little difficulty here and there, but most developers are still doing fairly well for themselves at these rates.
Just to also give you a bit of perspective again on this, if you look at the best time for Indian corporate sector was between 2004 and 2007 from a sentiment perspective, results, operations, everything. In that period also, there was a 3 to 4% difference between banks lending, not banks, between debt provided to normal corporates and debt provided to real estate. Debt provided to real estate was between 16 and 18%, and to normal corporates was around 11–12%. So the difference has only widened marginally. That is on account of all the factors that happened from 2008 to 2013 in terms of the macro, the various things that have happened in the country and overseas. And my guess is it will only come back to where it was, but it won't come down to the corporate levels ever, at least in the next 5 to 10 years at least.
And there's so many more options for debt now. I mean, there are so many more people, there are so many more players, there's
just
domestic, there's
to
overseas.
tell my colleague, I think what we should do is just keep selling. That's the real equity. And we should reach a situation where we don't go to them for money. Interest rates will come down automatically. So, and I think, no pun intended, but if you look...
There's something you said about, what was that thing about appetite for risk?
Yeah, the appetite. So we take risks even in selling, right? We don't know what the elections are going to get, but we are still liquidating stock at whatever price we get today.
That's de-risking.
For us, that's a risk of lost opportunity post-elections. Anyways, so to cut a long story short, I think both of us, both the institutions as well as developers, need to, I like the word of soul searching. We also need to do soul searching, provide information. Sorry? That's more important. Yeah, I think both ways, sir. If you're saying both ways, then I'm fine.
The opportunities of 80 to 20% are probably limited. That's the reason why we're coming here. If that was available somewhere else, we would have gone somewhere else.
Exactly. So I think.
So searching in that.
So developers need to be more transparent, get in much more corporate governance in place, and that would reduce 200 basis points of yours. Get a good auditor in place, and that would give us 200 basis. But that you promised, right?
Subject to due diligence.
Just kidding.
Any other questions? On that note, thank you very much.
Thank you, Hari.
Thank you.
May I request to please present mementos. First off to the lady on your left, Ms. Arya, Director, Vice Chairman, Milestone Capital. To Ruby Arya. Please give it to me. Can we go on, sir? No, one by one. Moving on to Mr. Gopalan, CEO, CFO, Valva Group. Turning to the other side, Amar Mirani, CEO, Xander Capital. To Shehzad Madan of Reliance Capital. And may I please request Rishi Kapoor, Sector Head, ETH, do us the honors for a moderator, V. Krishna Kumar of Kotak Equity Fund. Can I have a quick panel photograph, please? Well, ladies and gentlemen, a big round of applause to this panel. They proved that the real funds are still in real estate. Big round of applause. Thank you. Moving on very quickly to the next panel, which is future investable asset classes. We have to remove one chair. Thank you, sir. This is going to be moderated by Balaji Raghavan. Mr. Raghavan is the president of the real estate arm of India Infoline. He brings to the dais about 20 years experience in the real estate and banking sectors, a member of various real estate industry forums. He is eminently suitable for chairing this session. Ladies and gentlemen, your moderator for this session, please welcome Balaji Raghavan. We need to add one more chair. Sorry. Immediately after this session, of course, we'll have the lucky draw, so I hope you're still here with us when we do pull out who will ride the Porsche for one day, absolutely free. While we await our moderator, it'll be my privilege to welcome our panelists. Our panelists need no introduction. First off, we have a gentleman who is freshly into his industry. taking over his reins of Managing Director, Raheja Universal, just about a decade ago. He very quickly was the recipient of the Young Visionary Award in Real Estate Infrastructure, awarded by the Construction Source India magazine and CNBC Awaaz TV 18. Ladies and gentlemen, on the panel, please welcome Mr. Ashish Raheja. We'll keep the center seat for the moderator. Ashish, choose to sit wherever you feel like. Thank you. Joining Ashish on the stage, we have the Managing Director and Country Head of Hines India Real Estate Private Limited. He brings to the dais a varied experience with international organizations like McKinsey & Company, Price Waterhouse, and of course the family business Durvani Cables. His last assignment was CEO Silver Glades. Ladies and gentlemen, Yash Gupta. Mr. Gupta will be joining us. A gentleman who was the very recent recipient of the Inspirational Leader of New India Award. His experiences are wide-ranging, including refineries, textiles, real estate financing, and now construction. They have the singular honor of providing 30 lakh square feet superstructures across 37 projects. Please welcome MD Aryan Superstructures, Ashok Chhajjar. Joining on stage is Director and Head India Retail Business of Kohlberg Kravis Roberts. He brings to this dais a wealth of experience, being also the former Executive Director and Head of Acquisitions for Morgan Stanley Real Estate. Experiences include Kotak Investment Banking and Ernst & Young. Ladies and gentlemen, Ashish Khandelia. In the panel, the Managing Director and India Country Head Tishman Speyer, who of course, besides having the overall responsibility, Tishman Speyer will be doing as a yeoman service on stage here. He joined Tishman Speyer from GE Capital Real Estate, and before that he was with JLL. Ladies and gentlemen, please welcome Avnish Singh. And ladies and gentlemen, our moderator for the session, President Real Estate India Infoline, 2 decades of experience in real estate and banking, member of various international bodies on real estate, Balaji Raghavan. So ladies and gentlemen, our final panel for the day, future of investable asset classes, view from both sides. It's over to your moderator. In the meantime, just to remind you that time permitting at the end of the session, we'll have a Q&A session, and as soon as this is over, we'll very quickly have a lucky draw for the Porsche ride. And with that, it's time to hand.
So are we also
eligible?
Absolutely. If you put your card in.
Free Porsche.
We got free Porsche.
I thought
you missed
by
it.
you.
Whole Balaji get the
So let's forget the panel. Yeah? Let's do the draw. Okay. So I must admit that this is the first time I'm moderating a session. Normally used to speaking. And initially, of course, I was a little stressed, but after seeing, what Hari did, which is just ask questions and sit back and relax, I was really stressed. So it's a good thing to do. So really happy to be here. Just to set a brief backdrop of today's topic of discussion, I think what we are trying to do here is to evaluate various segments in real estate and look at the past performances and also do a little bit of, I would say, look into the future and see which are the best classes to invest in, both from an investor's perspective and also from a developer's. Just to quickly cover the asset classes, if you look at, let's say, residential. Okay, let me first cover, let's say, real estate, as an industry overall. What we have seen in the last, I think, about a year or so is a bit of a stressful time, because given that the industry has a high beta to macroeconomic factors, we've seen a slowdown in the economy, so therefore we have seen stress in real estate. On the residential side, if you see, there has been stress in sales because pricing seems to have reached in a lot of markets a point where, affordability is a question mark. Interest rates are high, again impacting affordability, and therefore sales and cash flows. If you look at commercial, offtake has been, I would say, not as great as what we've seen in the past. I mean, even addition of supply, addition of new projects in the commercial space has not been so great. And most of the demand, which is again driven by ITES, also comes at a price because one needs to, as a developer, I'm sure people will agree, one needs to really give competitive pricing. So given that this being the backdrop, I would like to start with, let's say, Ashok here. You being a developer, I mean, and you have seen residential, commercial, both these segments. So I'd like to get a view from you as to how do you see, let's say, 2014, 15, and onwards, as far as these segments are concerned.
Speaking about the asset class, among all the asset classes, real estate always has seen an year-on-year growth when compared to non-traditional as well as the equities. The residentials have always been a sentimental decision and have never been taken by a manager of an house, but the whole members have contributed to the buying of the asset as an investment. So 2014 will look forward for an improvement as well as headcount growth also in the major cities. The two-tier cities needs to be watched across. How will they moving in 2014?
Okay, specifically, Ashok, in residential, I had a couple of more questions. Now, if we see, there seems to be a lot of delay in purchase decisions, even whether it is the, the end user or the investor and so on. Again, driven by a lot of sentiment and economics and so on. So do you see that changing significantly post-elections, or do you see a similar situation? How do you see it panning out?
All depend upon the stable government to come across. Major of the citizens of India are hoping for it to be a stable government, and 100% in that scenario, it would be an upward trend. And the buying decisions would be more fast for residentials also. It is good that it has slowed down in the last 1.5 years. That has at least filtered out many of the speculative players. The industry now, the investors at least need to see to it that it is not going to double up in a shorter span of time of 24 months or so, but it will give a better yield comparative to any of the asset class available all globally.
Ashish, specifically to you, is that what we see today, especially in cities such as Bombay, is that we see that there is a vast difference between, investment decisions as well as pricing in under construction properties versus, properties which are completed and ready to occupy and so on. So I think the difference is just about, been widening over the last 1.5 years or so. So what would be the reason, and then do you see any change in the coming year, and do you see an opportunity from an investor perspective?
Well, there's two perspectives here. Firstly, yes, ready housing does command a premium, and it's primarily because the last 4 years, ever since the government of Maharashtra changing policies every 6 months, the rules keep changing, so and half the projects in most of Bombay, maybe 80% in South Bombay, is stuck because of approvals. So the premium for having a ready asset for an end user is very high, because there's no risk attached. We ourselves have actually received maybe 30% of our sales in central Mumbai from people buying a second time because their primary project is stuck. But in North Bombay, when it comes to the actual investable class in the 2-3 crore segment, we are finding that if the all approvals are in place, they actually prefer to buy and come in at the ground stage. That is where trust and credibility comes in. The branded players are getting an advantage where they like the idea. They'll actually pay a higher price for under construction, or maybe the same, because mentally, for a 2 crore house, they're putting 40 lakhs now. They can pay 5 lakhs in terms of their earning capacity. That's more practical. They don't look at interest cost and EMI. They look at this is practical for me. If I tell them move in now and you got to pay 3 crores, they'd rather pay 2.5 crores over 3 years. So there's contradictory trends happening in South Bombay and North Bombay.
True, but therefore, do you also see an opportunity from an investor perspective, as I said?
I do see an opportunity. There's a lot of hidden arbitrages prevalent. You got to, like, developers are going contrarian. Even the investors should go contrarian. For example, why should traditionally you would say Lower Parel 3-bedroom hall will sell, or traditionally Kandivali 2-bedroom hall will sell. How about a luxury 1.5 in Goregaon, or a compact 4-bedroom hall? There are different asset classes which are getting a high arbitrage value if the investor can purely see the perspective. If there's a family that needs a 4-bedroom hall but cannot afford it, but there's a compact 4, the price of a luxury 3, go invest in that. Traditionally, that's a big 4. And there's a small family who wants to have a lavish, he just got married, he can afford it. So go contrarian, take a little bit of risk. Do not take a risk on the developer or the trust or the title, but take a risk on what is considered a safe haven product. buy a one-bedroom or duplex. And that differentiated product always command an arbitrage to a niche market.
Ashish, as an investor, so therefore, given that these kind of plays do exist in the residential segment today, do you see an opportunity, therefore, to get in at, I would say, pricing which is probably far better than what we used to see a couple of years back? And also, do you think that from a fund perspective and pooling in of money, do you think it makes sense to invest in an asset class which is, let us say, purely under construction apartments and so on?
So I think there are two perspectives here. I think the first question, if I'm understanding right, is more as an individual investor, can you come in at these kind of prices and still make sense?
Yes.
And the second is more from an institutional standpoint as to how, as a fund or as a investing institution, you can make sense of some of these investment opportunities. I think on the first point, my feeling is that for whatever reasons, and I would say government has a certain role to play in that, is there is a significant loss of confidence in under construction projects. For some of the reasons that Ashish just pointed out, that I think the delay has been inordinate. There has been a fair amount of unclarity as to what's going to happen and not going to happen. And the prices per se has not been cheap in the meanwhile. I think now there are more schemes and so on and so forth available. So one thing I feel better about is if you are really buying for your own consumption, I think it's not a bad time to buy. And some of the negativity which was there is hopefully getting behind. People are fed up. Both developers, government is forced to take certain action. And at least we have seen, at least that has been our experience, that you see some of these cycles still coming back, some approvals still coming back, and the flow improving a little bit. And the market, people are also interested in moving inventory. So you can get that. On just from a pure individual investor standpoint, I think I'm personally less convinced for 2-3 different reasons. One, I think the transaction cost has gone up significantly between VAT, service tax, stamp duty, registration and all that. All the leakages that have started happening in terms of just flipping properties, buying a residential and kind of selling it off and all that. So unless there is a significant arbitrage available, that is less so. And the second thing is, I think still the pricing has moved in a certain manner that not many projects offer a reasonable risk reward in a way. So let me put it this way, it's not really a macro thing that you can do, but it's like a stock picking. So you will still find projects which are probably interesting, probably the product makes more sense, probably that particular location is less appreciated, and so you have to do a little bit harder work to find those things, just purely from an individual investor standpoint. From an institutional standpoint, I think the landscape is a little bit different, and the way we are, of course, as KKR, very focused on growing business on the real estate side. And I think that conviction remains that India as a country and most of our cities do need a fair amount of development that will continue. I think when we all started in this industry 7-8 years back, it has come a long way. It started with a massive equity thing, and it has, I think, moved to a massive debt kind of a thing. Yeah. And we ideally need to be somewhere in the middle, I mean, where you have both of these things and they offer their own risk reward. So today development equity has almost vanished. I hope that situation will recorrect itself over next 3 or 4 years, where both developers and investors actually see differentiation both in pricing and risk spectrum when you invest as a debt or as an equity. Today that is just not there. Right? So personally we believe, I think that opportunity is going to remain. You have to be a little bit more cautious. Partner selection has become extremely important. So all of those criteria, basic criteria remain. Residential as a class, asset class, I think is going to remain big. Any which way it is about 70-75% of the overall real estate activity that goes on. So it is not unfair to assume that about 60 to 70% of your own investing business will actually remain focused on that. But we do want to try and not ignore other asset classes, which are, I would say, somewhat getting ignored.
I have a take on that, if I
Please,
may.
Yeah, of course.
Yeah, but I think that's a great point that Ashish made. And we as clients, which is the point that the institutional, there is... Ashish? Oh, sorry, yeah. Ashish. Well, I think actually both of you did make, and this is the thing. Let's compromise here. But the chat, and what we are as institutional capital have been thinking about residential pretty seriously, about how to enter, and where is the value arbitrage. And the value arbitrage we're finding today is exactly what I think both of you alluded to, which is there is a big jump in the value of under construction versus completed asset. And the two real main reasons for it is, one is exactly as you said, which is the fact that people are not comfortable with what the timeline would be of completion. And the second one, which is on top of that, is people have, especially in North India, have been burnt a lot about the quality they expected versus the quality they actually received. So the uncertainty on these two parameters has made the customer a lot more wary of buying under construction projects. And on the flip side, the premium associated with completed projects is a lot greater in the same vein as a flip side to that. So as institutional capital, what we are thinking now is we are saying, fine, there are the market is now painting all the developers and all the projects with the same brush of under construction projects. Yes. So what we are thinking is, we as institutional capital come in, let's help the right developers in the right locations with the right kind of a product. Let's help them with our equity capital complete those projects. And we are also developers. We have a little bit of development expertise, which we want to bring to bear as value-add capital, and say we will help the developer be a little bit more disciplined about the development cycle so that they can actually complete on time. We can bring some international knowledge to help you a little bit on the quality front. But if the focus here is, if you can actually bring that equity into the project, complete the project, and then offer the project to the customer after it's completed or nearing completion versus right at the beginning, it's good for the customer, it's good for the developer, and it's good for the institution.
Absolutely.
And that is really how real estate and residential real estate is sold in most parts of the world. Absolutely. So that's exactly the game I think we can all play in the next version of residential real estate.
Excellent. Just to supplement that, would you also like to add on, if there are, I would say from an investor perspective, that if there are any specific geographies or specific segments that you would want to dwell upon as far as these kind of investment strategies are concerned?
Yeah.
Bombay residential.
Bombay residential.
I mean, from a cost bracket or the price bracket, the mid market, as everyone defines it, mid market is defined differently in different micro markets, but it basically means the part of the market which is the broadest. So it is the lowest market risk if you target that. So in a Gurgaon, that bracket can be, depending again on which location, but somewhere around the 6,000 rupee to 8,000 rupee mark. In a Mumbai, I think I'm told it's from an 8 or 9,000 rupee mark to 11,000 rupee mark. Bangalore, it's about 3,500 rupees to 5,500 rupee mark. So mid-market would be the part of the segment that I think is easiest to back. Now, from specific geographies, it just seems that the cities that everyone's talked about today, those 3, 4, or 5 cities, which are the 2 metros plus Bangalore plus Pune plus maybe a Chennai, are the ones which have the greatest depth of demand. So again, that's an easier one to mitigate your market risk. So those are the two takes.
I want to add here, the whole tier 2, 3 play even crazy about in pan-India. From personal experience, stick tier 1, the gap is massive. It's not like a gap of 10% or 20%. The depth of demand, the volume, is probably a tier 3 won't even be 4 or 3 to 4% of the depth of Bombay or Bangalore. It's a highly avoidable investment class.
Yeah, no, the depth part I certainly agree, because even in earlier roles as mortgage providers, we have clearly seen that the volume of business one would do in a tier 2 versus a tier 1 would be probably 1/10 or even lesser than that. So I completely agree. To Avnish here, since you are also a significant player in markets such as Gurgaon and so on, and in NCR we have always seen a lot of, I would say, investor interest and bulk buying and speculation and so on. So in the residential segment, do you see any significant correction that would happen, or has already happened in Gurgaon and NCR?
Just a quick correction. We're trying to be significant in NCR and 3 or 4 other markets, but yes, from our limited experience, which is not really in residential investing in Gurgaon as yet, but that's obviously part of our both medium and long-term strategies. I think as far as the correction in Gurgaon is concerned, I think it's one of the most unique markets where largely we believe that 60 to 70% of all new bookings and new launch investing is actually done by investors, and to use Hari's term, people who cannot afford more than 20% of the unit price, and the whole perspective is to invest at a pre-launch stage or a pre-launch stage, depending on how you define, and then kind of flip it as it moves on to a formal sort of a launch stage. Correct. So I think the market is unique. It's 60-70% really driven by investors, more traditional investors, as well as more retail investors who are trying to deploy their surplus investable corpuses in a second or a third sort of a house after they've bought their principal residence of stay. Gurgaon, what we've seen is clearly since Q4 2014, one already saw the signs of slowing down. In terms of the price escalations that the various developers in various pockets and precincts of Gurgaon could undertake in terms of the subsequent phase launches, because most of these projects are large. They range from 500,000 to almost 2.5 million square feet, depending if it's a group housing or if it's a township. And that slowdown kind of sustained significantly into the first half of 2013. And the last 3 quarters, you speak to our friends who are executing some of the projects, let's say in the NPR region, which is the Northern Periphery Road, and certain other pockets of Gurgaon. Clearly the velocities have fallen. Hidden sort of price discounts in terms of free car parks or reduced PLCs are also kind of evident, and that's clearly a function of the fact that between after the GFC 2008 2009 when there was this 2010 2011 sort of restart or a element of exuberance that came around, not only Gurgaon but most of the resi markets in India. I think that did make sure that certain capital values in a lot of pockets around the country went beyond the usual affordability indexes. If you try and look at an HDFC affordability index, or really from hearsay. So therefore, I think it's great that there's a bit of a slowdown just for developers and investors and landowners to take to kind of sit back, relax, wait for what happens in the elections, and then re-strategize as far as their price points are concerned towards new resi development that will come around in NCR. On the other hand, it has given a good sort of a reality check to a lot of HNI investors and investors of other categories, right? That this just cannot, never in the history of the world and the real estate markets, you've had a secular, 10-year sort of a bull run and a 15-18% CAGR year on year over an 8-9 period. It's just not possible. Correct. And therefore, I think this break was required even from a customer or a retail investor standpoint, to just kind of reassess and possibly reprice both the risk as well as the return expectations from investments in resi.
Understand. So, I mean, between Yash, you and Avnish, just to sort of round that off. So, therefore, I mean, if you look at, if I look at, let's say, anecdotal kind of, experience that you see, or people whom you meet on a daily basis in NCR, now everybody seems to be booking, 1 apartment to 5 apartments and paying 20% and, flipping it and, making a lot of money and so on. Yeah. So that seems to have obviously stopped. So do you actually see, Dubai or a Middle East kind of situation happening over there, where suddenly everybody is left with stock and no money to pay up, and therefore a crisis and therefore an opportunity?
After you're done, I'd like to add something to that.
Sure. Shall I go? Okay. Yeah. It's not a across NCR kind of trend, but definitely certain micro markets have gone to a price point where the price doesn't make sense for the market. So I do think that there is going to be a correction in certain markets. I hope that there will be a correction in those markets, because it's healthy for those markets to have that correction. Even after the correction, if you're an original you're an original buyer, you will have seen some appreciation, maybe not the same appreciation you're seeing today. So I am in those markets, when we are looking at some projects, we are actually underwriting at the levels which are 20% below the current level. So I'm actually hoping that will happen, and yet there are certain other micro markets where the location makes sense, where the infrastructure is in place, where people have started living, and I think those might sustain their value.
Okay. Just adding on to the underwriting part, the way we have started to kind of look at a lot of residential and even office transactions is that. I think in one of the previous panels, somebody talked about certain reduction or correction in land values. If you just try and benchmark land as an input cost, right, to your total project costs, in India it's ranging in a Gurgaon between 40 to 50%. To a Mumbai, it could be much higher. If it is land bought at market value, this is largely pre-approved land, not the 7-year grunt that a lot of,
yes,
or even more, that the Mumbai developer would generally go through and kind of cleaning up the land and getting it to a marketable sort of a stage.
Correct.
This 50 to 80% input cost of land as part of TPC, right, is just not sustainable, and therefore clearly you've seen a lot of investments, be it FDI or otherwise, that came around between 2005 and 2008-9. I think clearly, one of the reasons was obviously the head rush as far as India is concerned. There was this general environment of, state of trance, where it was a 45-degree, sort of a trajectory being projected for India and many other emerging markets. So that has clearly not happened. It's not going to happen again in the near time sort of future, and therefore, Yash talked about finding those kind of right partners where institutional capital can strengthen the balance sheet of a single project, not the balance sheet of the entire development company where cash is kind of circling around, which also kind of creates those little movements. If there is some sort of an imbalance in one of the projects, and then the cash flow gets affected, the retail investor gets affected, and also the projects and the project delays, and therefore the lower sentiment as far as under construction property is concerned. That's something that we have witnessed over the last couple of years. Therefore, really kind of partnerships on a joint venture basis, wherein we and a local partner would kind of come in, and the local partner could be a developer, or it could be a landowning company, or a traditional family house that does all sorts of businesses, but just seems to have a lot of legacy land banks. And therefore, opportunities like that, and then really mark to market, it's very difficult to pay today's market value. For example, I'm talking of Gurgaon, I'm talking of Bangalore and Hyderabad, some of the markets that we are focused on. Try and put today's cost of construction, escalated and not at the usual what we'd like to underwrite at some 4-5%, but because your costs never end up being 4-5% on a year, because there's a lot of hidden and extraneous costs involved. And just based on that, if you see, for example, office, we just digress for a second to the office side, your yields on costs, on total project costs in any of these cities are somewhere between 12 to 13%. Now, if the so-called institutional cap rate is trading at 10 to 10.5, here you are buying land, constructing, taking the entire lease-up risk, right? Because we traditionally don't do strata sales. We like to own assets medium, long term. You take the leasing risks, you take the marketing risk. There might be certain hiccups somewhere in terms of approval, so it is not necessary that your 12-month pre-development time period would remain 12 months. It might become 2 years or 2.5 years. We have faced that in our portfolio over the years. And therefore, a 12-13% yield on cost going in, and then flipping it at 10.5, 11 in a 4 to 5 year period is not going to generate your 20% IRR. Right, it's going to be more at a 15-16% if your underwriting kind of goes per plan. Therefore, either the land values would need to correct, and we have started to see pockets of that already in the NCR and in other pockets like Hyderabad, because it's been a largely stressful market, or you get into a JV where you don't have to put in upfront equity for the land.
Looking into the trends also, I would like to add up that we won't see a scenario as UAE or in Dubai, because there is no local population over there to buy properties. And if you see countries like Asia Pacific region, including India, there's a good amount of population. And that can be seen from the shift of investment portfolios of pension funds as well as souvenir funds increasing on 200 to 400 folds. Percentage fold from 2007 to 2012, which has also yielded up and return of 25% plus.
Absolutely.
So I think there is a trend of buying real estate by the major investors as well as the macro level single, second home or third home or fifth home investor. First buyer, we need not consider, he has to buy according to his need and requirement of the hour. He is going to buy it.
I think this trend is unique to certain cities. In Bombay, we don't have this flipping issue, like Dubai and maybe pockets of NCR, as you said. We've never heard of flipping. Flipping is that the guy doesn't want to live in that particular building anymore. Because firstly, we have a policy, most developers have a policy of one buyer, one home. We don't allow you to book 3 apartments.
But you do have investors in Bombay too.
Very structured investors. Structured investors, you guys. Not that simple middle investor who actually buying 5 and flipping it, not the scale. There it's off balance sheet. The same invested products remains in our inventory. It's structured invested with any of the NBFC, etc. But on balance, it's still available as inventory. But here that inventory is blocked to one guy. He puts 10%. That 10,000 rate becomes 12. Then he flips it like Dubai and he makes a 60, 70, 80, 100% IRR. That doesn't exist here. or at least we make sure in this, because the second rule most of us have is a lock-in till possession. So in a way, investors shy away, but in a way, investors are attracted because a smart investor knows there will be no resale in this product. Because when things go bad, then suddenly a 200-unit project has got 170 flats for resale and 30 end users there and 170 guys putting on park. But in a lock-in product or 200, we have only 20 investors, and these 20 investors are safe because 180 are not selling. So that's a little differentiation investors should look at. If the developer has a lock-in, it's going to have a less liquidity, but almost your downside buffer on resale.
Just taking on from there, Ashish, you also, I believe, do have an NBFC platform that you also sort of intend to invest in real estate. Now, what we've also seen is that large underwriters, specifically as Ashish mentioned here in NCR, I mean, not to take names, but who have large portfolios of such nature of, underwriting units and, then selling them onwards and so on and making their margins. Right. And these are again, most of them or a lot of them are funded by NBFCs. Right? So do you, as an NBFC, see an opportunity here, or do you see this more as an opportunistic kind of a model? Or do you see this expanding across in other markets?
I think so that in a way is a bit of a new trend where people are trying to invest through that stock model per se, right? If that's what you're referring to, I mean basically NBFC is helping either underwriters get some capital and just block that unit, or NBFCs themselves are actually taking a bulk of stock and just providing capital on that. I mean my personal view is it is actually fundamentally no different from trying to do a project level investing in one way, and there are two key drivers for that. One, if the project is already fully secured to a construction lender. Now, how do you really get inventory out of that which can be handed over to an NBFC on a first charge basis and still take more financing?
Innovative way of
this creates that, because to the construction lender you are kind of positioning it as a sale. Yeah. Truly it is financing on that, right? And correct. It is that financing is very akin to a home lender financing. But I think from an NBFC standpoint, personally, I think there is a fundamental difference. When a home lender is providing money to an individual against his home and taking the same collateral risk, I think the home lender is actually very focused on who he is giving that money to. And most people, even if the unit is not getting constructed and so on and so forth, do really worry at an individual level to actually pay off the bank, do whatever. And as an individual borrower, I think that risk perception as to who you have lent to is very different. Correct. When you are actually lending to the same project, all the risk of the construction and all is same, and you have just taken it on that inventory, I think people should be thoughtful about that, is my personal view. And we have thought about it. We're still evaluating if that from our own perspective makes sense or not. Right. Okay. At the same time, if you are convinced that overall the project does have that much of money, I mean the interests are aligned, even the developer has enough equity in there to be realized once all different parties are paid off. Right? I mean depending on your partner comfort and project comfort, you can think about that. But the basic philosophy with which at least we are trying to look at some of these situations is that that once you're doing that, I think the fundamental issue that we see it is for necessarily not fault of developers or anybody else. The time to get lands to production, or then even once you have started because of approval delays, market slowdown, etc., the time has elongated, and therefore the interest cost and so on has gone up so much that many a times it is almost trying to either wipe out the equity, or you are in a constant stream of financing, refinancing and all that. Right? And I think the whole goal is, if you do a structure, if developer later on can certainly refinance you in a healthy way, and he can really do that to lower his overall cost of capital because there is improvement in the project, I think that's fine. But at a going in basis, if you can actually provide a solution which will not force him, day one knowing fully well that it will force him 2 years down the line to again refinance you because the project is not going to support your amortizations and so on and so forth, then we worry a little bit more. So the whole objective is to try and provide a solution which will sail through the project over the life of it, even if it is longer dated, even if it is structured in a manner that can be supported by the project cash flows and all that. And in some cases you can get 100% of the way, in some cases you can get 70-75% of the way, but the endeavor is that, to just kind of try and do that.
Thank you. So before we move on to commercial, I have one last question in residential, which is open to all. Is that both from a developer side as well as an investor. So would you believe that now is the right time to invest or get into this segment, or one should wait and watch to see what happens? And if you believe now is the right time, what could one expect, let's say, over the next 12 months, 24 months, etc., as returns from an investor perspective?
That's what you're asking. The developer will say it's always the right time. And the institutions will
Just
say...
Just now we heard about transparency and...
Exactly. The institutions will always give a mixed answer.
Yeah, honestly,
it
is the right time. Honestly, it is the right time. Only thing and small-time investor, we should say to them that they need to balance up their wealth and allocation towards the asset in a very correct manner. Not put all the thing into the real estate asset class. He could put up 25% of his complete wealth, leaving apart the residential house or the ownership of his to the asset class, and 75% he can allocate it to the different asset class, which may be even metals or maybe even equities or fixed deposits and cash in hand.
So spoken like a true fund manager.
My advice.
So what about you, Avnish? What are your views?
I think there is always the right time. If you're an opportunist investor, right? Even be it the last 3 years or the next 3 years, irrespective of what kind of comes out as far as this. And personally, I think both global investors, domestic investors, both institutional, non-institutional, are laying just too much emphasis on what's going to happen on 16th of May and thereafter. But I think if you're an opportunistic investor looking for an opportunistic return, I think no specific environment should deter you from looking at investment, especially in residential real estate in India. And then it's very, very difficult to paint a single brush towards, for example, when you meet somebody even socially, so how's the market, right? Given you're from real estate.
Where should I put money next?
So where do you start, right? I mean, which market are we talking about?
Ali market.
Ali market. So clearly, I think
after
it's
a couple of drinks, it's boss, tell me which house to purchase.
Exactly. So we believe, if you want to take a contrarian approach, I was looking at the yesterday at a FICCI meet, a FICCI Knight Frank index that they have recently created, and there's a new report around it. I looked at Hyderabad, for example, where Q1 2009 is the base 100, right, and it's at 101. For Hyderabad after oscillating between 95 and 105. You look at Bangalore, it's from 100 to 155. Bombay is pretty much close by. NCR as well. So if you were to believe that the political risk is out of Hyderabad, Hyderabad today is the most affordable mid-segment market available to a retail sort of an investor. At 3,500 rupees, you can get a decent sort of product in most of the micro markets there. Then maybe Hyderabad. It's not a recommendation, but it really depends that even in a market like that, or Calcutta, if Calcutta and the administration and the politics get the heads around, possibly Hyderabad and Calcutta could possibly give you the next 50% return over a 24, 36 month period. But obviously there are risks attached to a strategy like that.
Absolutely.
Yeah. From an institutional, I guess from an institutional investor point of view, the question really to ask yourself is, what risk are you trying to manage when you're trying to figure out, is this the right time to invest or not? My view has been over the last many years is it's very, very difficult to really get a good handle in the short to medium term on what the values would be, because the macro factors in India move a lot. Emerging markets by definition are very volatile. So valuations, especially future projection of valuations are tough. The only thing one can really manage as an investor is liquidity, is what will sell and sell easily, even if whether the market's down or up. And in that context, I think there's a great correlation between good locations and liquidity. And in this market, for residential, which is normally a self-financing mechanism, as Ashish was reminding me earlier today, that it's self-funding, why do I need your money? There are many developers today who would be willing to take in capital for good locations, which they would not be willing in a bull market. So what as an investor you can do today is really lock in good locations which would provide you a little bit of lower risk in the future, taking advantage of current environment.
Thank you. Moving on to our... I'm sorry. Oh, I'm so sorry.
Okay, I have nothing to say. Our brochures are outside. Buy from us.
You talked about Bombay.
No, sir, buy from us. That's it. I did my plug. Now we can move on. Just one thing, but generically, actually, I agree with all you guys. Go on.
No, please.
Generically, of course, firstly, I would say buy. The base levels we are at right now, there is no massive jump on a base of 4,000 Kantan. We already at such high bases. Generically, buy only with your home. It's not a great asset class. It's not a bad asset class. Buy with your home, buy. Otherwise, as Ashish said, it's stock picking. If you can opportunistically find it where there's an arbitrage, then you have to hunt. If you're adventurous, like Avneet said, then you go to other cities as well. But unless you're going to put the same effort as an analyst or an investor puts in stocks to pick the right one to cross that 15 or 18% return, buy. If you're going generically, Bombay is going to do well, let us buy in Goregaon. No. Buy if you actually want to live there.
So bottom line is give your money to people like us to manage, right?
So you made your plug.
Unless you're buying from us, then you always buy.
So anyway, coming to the commercial office space segment, again, as we saw, there was muted demand, again, mostly driven by IT, ITES in the south and so on, and a little bit of BFSI in Bombay. So given the backdrop of commercial now, starting with Yash over here, if you could just give your views on how you see the year panning out as far as commercial spaces are concerned. Do you see investor interest as well as returns?
Yeah. Investor interest and returns. I think investor interest is definitely muted right now because a lot of investors have got burnt by this segment where they've gone into properties and those properties haven't done well. Commercial is directly correlated to the GDP growth rate, and that's why a lot of new demand for commercial is not coming up. We have a few commercial properties which are in the leasing mode in NCR, and we are finding that most of the demand that we are getting is from people who want to consolidate, people who want to move from current offices. This is not really expansion space for them. In that context, what we are finding is people are gravitating more towards developers they trust and towards quality that they like better than what they have. But I do find that till the economy doesn't get better, therefore there is an expansion in demand for as such. It will be a pretty sketchy market to invest in, especially with investors with tenants not appreciating strata sold, office buildings.
Understood. Avnish, we also understand that in commercial spaces, there is a very different kind of capital structure which is required for funding and so on. I know that, there have been earlier panels which have covered REIT and so on, extensively. However, in our discussion outside, Yash believed that they have not done it properly. So therefore, I, would like to again throw this question back to you that a little bit of views on. Yeah, they didn't have the right experts. So, how do you see the proposed regulation which is coming out, and do you see challenges? Do you see capital flowing into this segment?
I think clearly, if you look at different positive regulations, obviously are great for the long term, but I don't really see how a REITs regulation, if it were to kind of come around over the next 6 to 12 months, is going to fundamentally restructure the way offices get financed. Because one thing to note here is that you can flip your 100% owned or a leased commercial or an office asset. It could be an ID park, or it could be a commercial CBD style building into a REIT once you've kind of developed it, right? Because these are not development oriented REITs. These are more for stabilized incomes. Absolutely. And therefore the capital structure, so the question here would be that how would a REIT legislation 6-12 months down the road have an impact on the funding and the capital structure of an asset that needs to be built out?
Precisely.
Right. Therefore, land acquisition would continue to be, in our opinion, equity financed. And the regular mode of construction finance as well as equity as a mix would continue to be the mainstay for office equity investments, at least in the medium term. And our medium term is a 3 to 5 year sort of a period. REITs legislations, if they were to come around in the right sort of a tax efficient manner, is going to be an alternative exit mechanism available to both institutional capital who are investing in India, be it FDI, or Indian development companies who have painstakingly over the last 5-8 years, in spite of all the headwinds that one has seen in the office sector, try to create wholly owned portfolios. And why I emphasize on that is because 85% of commercial office development for many years and even now is actually strata sold to investors. Correct. And once it's strata sold, the question becomes that, okay, your REIT legislations come around in the next 12, 18 months, where is really the investable stock available in India, right? There's somebody was in some previous panel was talking about some $5 billion of capital waiting, and in 4 years some 20 billion, etc. I personally completely disagree with those numbers because grade A, investment grade assets are just not available. Yes. You could actually count them. The biggest institutional global buyer, and I won't name them, but we know whom we are talking about, of stabilized assets, has transacted on 1 or 2 transactions with 2 partners, and they've gone dry over the last 18 months because it's very, very difficult to find, that kind of investment grade office portfolio or even single buildings. And from a REIT standpoint, given the the minimum cap and a certain sort of a size you would want for the REIT IPO, you would need to have a portfolio in place. The two or three portfolios one can think of belonging to, let's say, 2 NCR developers and maybe a couple of them in Bangalore. I'm struggling to think of a portfolio of office assets income earning in Mumbai. I think there are none. There might be a few, but there's no significant portfolio available here to purchase, which has been owned by the developer and is now would kind of flip them into a REIT structure. Therefore, clearly, our senses, Tishman Spire perspective is that this would continue to be a construction and development risk-oriented market when it comes to the office asset class. And if you want to hold long-term core assets as a strategic institutional investor, as a pension fund investor, or as an insurance company, and insurance obviously hasn't opened up here as yet, or as a REIT framework, you need to build those office assets in the medium long term to create an institutional structure around REITs, which in my opinion is going to take another 5 to 8 years. Therefore, it's going to be more private capital, developer capital, building assets to a core level. So you've got to build to core rather than core assets or value add assets being available to you to purchase under a REIT or a non-REIT structure.
Understood. So today, as we see, there is a high demand from most high net worth individuals for leased office spaces, especially if it's grade A and so on. So Yash, do you actually see the REIT platform which comes on as an opportunity for such investors, or you would agree with what Avnish says that there's very limited portfolio available for such opportunities?
Well, the question is which tenure we are talking about. In the short term, what Avnish is saying is absolutely right. Yeah. But in the long term, I think it will be a solution which will then look for a problem at some level. REITs are absolutely the right way to go for high net worth individuals or for any even individuals to own commercial assets. It's just, it is the most efficient way to make the market. If there aren't good enough assets, but there is enough demand, I think in the medium term, then the supply will come. There will be people who will build better assets because they know there's better exit for those assets therefore, and I think it will be a very virtuous cycle for the entire industry.
This question specifically for you, Ashok, and Ashish, since you're on the development side. Today, what we observe is that on the commercial side, now, there is a high vacancy, and the difference, I would say, or the delta between a vacant property and a leased property, I think has widened over the last couple of years. It goes up to almost about 30-35% now. So therefore, would you advise an investor to probably get into a vacant property with the vacancy risk, and carrying it, and therefore and thereby making superlative returns? Do you see that situation happening?
What
most by over and large, he should not opt for an commercial property until and unless he finds it out it's at a very good value down the line compared to the market price. Because as we see, there is a regulation which is coming. The REITs, if it forms out, it would be the major purchaser of the commercial properties and would be renting it out. So they would have the biggest purchasing power at an undervalued or underwritten rates from the developers or from the holders. It's better to keep it off and wait for at least 12 months.
I would just to add to that, sorry.
No, you go ahead.
If it's a retail investor, I believe that where capital values on offices are today, a 2025 or a 28,000 in BKC, right, or a 15 to 18,000 on Golf Course Road, or a 8,000 to 10,000 rupees on Golf Course Extension Road, and similar kind of capital values in Bangalore. These capital values today are trading. If you see the replacement cost of doing an office, right? You buy land, you construct, you pay the interest cost. This is today. If I had the money, I would go and buy. If I'm a strata unit buyer, I would go and buy empty vacant spaces by grade A developers, be it in BKC or KRH or Universal or Hines and ourselves, sell strata. But today is the time to go and look at selectively and buy half a floor plate or units on a vacant basis. Don't worry for your developer builder to try and get a lease. It would come around. Even if it doesn't, if you have leveraged it, largely your lease income is going to pay off of any leverage that you might kind of pick up, given the structure that kind of exists. It's a pure capital market value play. Today you're buying constructed vacant spaces at capital values below what you can build them for. So this is the time to go for buying vacant commercial assets, in my personal
I was
actually
so just following through, I just have something to add so that you can add to the answer itself.
Okay, go ahead.
Just following that logic, yes, we have seen a lot of assets which have come probably equal to or even lower than replacement values, right?
Yes.
And we have been seeing this over the last, I think, at least about 2 years now.
Yes.
Yes. However, if I use the same logic as what Avnish says, over the last 2 years, then the capital values should have gone up, or there should be a trend which has to,
Okay, so you're kind of showing the contradiction in his argument. I'm trying to say exactly what both of you together are saying.
Yeah, so that's my question to you. Do you think it's still worth it?
The logic in 2000, we did it. I'll give you a case example. We're developers.
Yes.
We went and bought half a floor plate of another developer. We're looking at, I won't disclose the specifics, we're looking at land in that location. The replacement cost of land and location for office gave me a capital value of 14,000 cost. And he was selling at 9,500 booking. So I said, let's buy the vacant strata space as an investor. As a developer, I'm making negative returns. As an investor, I'll make more returns.
So did you break it and make residential then?
I wish we actually did in one place. Our own project going, we broke the basement in residential. That's a different story. But in this particular thing, exactly Avnish's logic what we applied in 2011. And we went aggressively. For the first time in history, we put in a significant, not too large, of our own capital in another at 11% cost of equity in another developer. So you know what, let's play the replacement cost arbitrage. It's 2015 almost. Capital value is down 5%.
Exactly.
And reinforcing, and it's leased, then I got 20% more. But on the pure strata office replacement cost theory, which I still believe in, one day it will pan out, but the 2-year time horizon did not pan out, it did forward. But in the long run, I still strongly believe it has to pan out, because how can ready assets trade cheaper than land?
Yeah, one thought on that. Sorry, if I know we're out of time. The big delta in this is how you're calculating replacement cost. And replacement cost is cost of development and cost of land.
Correct.
I think the cost of land is really something that could move quite a bit and is at some level artificially controlled. I mean, if the government increases the FSI, that cost of land could come down.
Correct.
And in that situation, so either, maybe the cost of land by itself goes up, but the per FSI cost comes down. So if that happens, then you have to be careful as to whether the future, this will actually sustain its value or not. So that's the part that's kept us away, because I personally don't believe, or at least hope, that the value of lands that are there today should not be sustained into the future. On
it
an
again
FSI basis.
about depend upon the proportion of commercial to residential happening up in a particular city or a locality. If the generic requirement is about 5 to 95%. The commercial office workspace is required would be something around 5 to 7% or so. If the city is producing more than 10-15%, it will never see an appreciation. If it is exactly to the same mark, then there is a requirement of that space. So that also has to be kept into account.
Ashish, you have something to add?
No, see, I think this whole argument, in my view, holds. But the only thing I worry about is buying empty office. I mean, you can buy leased office even at a tighter cap rate.
Residential is also empty when you buy it. Now you have to move.
You know, I mean, basically you can buy it on lease or whatever. But the fact remains that, see, today, unless you're impregnated with the office development and barring very, very few micro markets, how many people are actually starting a new construction of this building, right? It is the same situation when people came in 2007, 2008, there was actually absolutely no office space to occupy at that point in time, and things actually went absolutely crazy at some point, right? If today again you do not build any new office,
how many
right?
Three.
So if there is no new office that is going to get built, I don't think the capital values are going to move in any incremental way in a short term. So you've got to really sweat it out for the next 3-4 years, this whole supply cycle to actually pan out in a way, but then it has to catch up at some point in time. Right?
Market does
but
not respond
then
to
you
supply
need the
cost.
lease to pay off your interest rate in the interim.
So do you also therefore...
So personally speaking, I mean, on the personal investment front, if I have to actually try and buy a residential unit, unless it is coming through some really good stock picking kind of a exercise, I'm actually happier buying a leased office, even if it is coming at somewhere between 8 to 9%, because the inflation will continue to catch up, and 4, 5, 6 years time frame. And it's also like you're trying to do an equity play within real estate, which probably is more like residential, or a debt play within real estate.
So just to add to that, Ashish, I just wanted one more view of yours before we go on to Avnish, is that do you think that, you mentioned that 8 to 9% is, you would still consider that. See, today, ultimately, vacancy or lease, a decision which a corporation makes is probably dependent also on interest rates, the cost of buying versus the cost of leasing.
Right.
So as interest rates come off, right, so do you see, therefore, vacancies in lease spaces increasing?
As interest rates come off, the vacancy in lease spaces...
The cost of purchase decreases as compared to, let's say, the cost of leasing.
I think one thing, at least we have tried to kind of cap it across many, many markets. We try and find this very good direct correlation between the interest rate and the cap rate per se, and it has not panned out very well, because there is always this focus on some capital appreciation, at least inflation linked in a country like India, that will pan out. And while you can easily put your money in between 8 to 9 to 10% in FDs or certain other debt instruments, still HNIs really want to go for these 8 to 9% leased offices, right? One, the tax arbitrage is clearly there.
No, my question was slightly different, is that do you see vacancies increasing and therefore acquisitions going up, as interest rates come? I mean, anybody in the panel who can probably answer this.
I think the general vacancies, of course there are a lot of caveats to this, was stable government and stuff like that.
Sure.
Right, the general sentiment, because last year 2013 was 27 million square foot of total leased absorption in the top kiosk, the top 7 or 8 kind of markets that these companies track, which is way below the 34-35 million one saw in 2006 or 7. Having said that, the last 3 years, a lot of plans to do office got either converted into resi. A lot of developers and owners of commercial plots actually kind of stopped constructing. Given there was a complete sort of escalation as far as resi is concerned, it made more sense to do resi. If we came across a statistic of around 90 million square foot of vacant space in India.
Yes.
That 90 million with a 26-27, assume nobody builds office anymore. That can get absorbed over the next 2.5 to 3 year period. One of the banes of the sector has been that rental growth since 2010, 2011 has been extremely tepid. We have talked of the same rents. BKC was being talked of as a 400 to 450 sort of per square foot rent. Post the crisis, right?
Yes.
We know what the actual transactions have happened, including concessions and stuff. Property tax structures have also kind of undergone a change in the last 4 years. We believe that if the economy starts to pick up at a 6 to 7% sort of a level. There are, and we speak to occupiers, we have a large office asset in Hyderabad, for example. We're building something for somebody in Bangalore. The kind of expansion plans that have been on hold over the last 24 months, if just 50% of them convert into reality over the next 2 to 3 years sort of a period, I think we can see a fairly quick sort of a contraction of the vacancy rates and a parallel incremental increase as far as rental growth is concerned. So we clearly believe that if the economy were to stack up, I think the office asset class, which today trades at a 30% discount to a resident. So a grade A resi capital value of $10,000 has a neighbor which is a grade A office asset, partly leased, partly vacant, strata sold, is trading at a capital value of $6,500 to $7,000.
Yeah.
So that's why the theory of replacement cost. It's been kind of well tested all around the world. And in terms of buying a vacant sort of a unit, I think it really depends which investor you're talking about, because there's if it's a retail investor today wanted to kind of buy a 50,000 rupee house in Mumbai and thereby invest, let's say, a 5 to 7 crore sort of a ticket, depending on what that specific unit is. You try and compare that with a 25 to 30,000 commercial sort of a asset. Clearly, I think we believe just the capital appreciation and HNI's. Our investor base is not HNI kind of driven per se, but HNIs in India continue to look at equity multiples and a 7, 8, 9% sort of yield. Really on a post-tax basis. I don't know where that commercial risk arbitrage is there in buying a leased asset. Therefore, I think an 80% of any of the underwritings, your investment return is more on capital value appreciation rather than the yield. If you do a hold and a sell sort of an approach.
So I think it's treated more as a hedge than anything else, and rather than expecting a multiple. Yes, you had something to add to.
No, but I think the only thing is it's also a strategic decision for a lot of companies.
Yes.
So irrespective of where the interest rate is, a lot of companies don't want to have fixed assets or want to invest their capital in fixed assets. They'd rather just lease.
Correct.
Just to add that we always look at IT and commercial. Office is only in the commercial class. It's also a different much more small class which we are looking at actively is industrial. As far as Bombay goes, it is traditionally an industrial hub, which has totally been relocated because of IT and office and residential coming in the main city. There's a big contingent demand for industrial, which could actually see higher capital value somewhere between higher than commercial but less than residential.
So do you also think, Ashish, that there is an unmet demand which exists for, let's say, small office space in this country?
Small office space, in up to 2009, we all went strata office, which actually did well in limited locations where there's a strong residential business pocket nearby. In Goregaon, Andheri West, for example, it's still, you do only strata office. You never do leased office there because the demand is only SMEs and media houses. But in Goregaon East, the small office where I can sell at the most a limited supply small office. Ultimately, it's the big corporates who are leasing there. So it's very location specific. But we actually look at industrial. Strata office has a finite, small office has a finite demand capacity.
Just one limited point on the REITs that we kind of touched upon as a discussion point earlier is that while REITs is going to be a great sort of an exit and potential opportunity, yes, I think it's. I continue to believe it's more a medium term sort of an opportunity. On the other hand, I think we need to seriously think through that if it's an office REIT, and offices, in my opinion, over the next 5-7 years in REITs are going to be the most established asset class to go into a REIT structure. Because shopping centers and hospitality has its own set of issues, etc. We need to think about the fact that when you're investing in an office REIT in India, your 70% of your risk is related to just one industry, which is information technology, because 70% is the occupier demand is coming from one industry. So let's just kind of keep that in mind, that you are investing in office, you're investing in real estate. But at the back of it is the information technology industry credit, which is 70% of the occupier market here.
Correct. Just a last question, which is more to the developers sitting here, is that given a choice between, let's say, a residential development and a commercial development, would you still, which would be a development of choice? Obviously location being appropriate and so on and so forth. So,
of course, residential. It's the easy game.
Let me put it this way. All things being equal, I think you answered the question. We analyzed one particular location. We had already sold half the space. We were built commercial. We found it better to sell the land. We were making a better return by selling the land. The replacement cost for commercial, the selling the land, we were making 20 crores more than after calculating the commercial profit. So that answers itself. But as I said, if you're here for the long run, with the GDP growing, if you have the holding capacity, we would like to have a yield portfolio to balance it out. But all things being equal, I'll still do residential.
Thank you so much. I don't think we will have enough time to cover retail, otherwise we would have loved to do that. So just to sum up, I think the way things are panning out, residential, commercial, everywhere, there do seem to be opportunities which exist. What we hear from the panel here is that one needs to be obviously extremely careful, pick your, do stock picking, look at specific locations, specific developments across either of these segments, and have a very clear, I would say, objective and a expectation from whatever you are acquiring. Thank you very much. All,
and look at good, specific good developers.
Which goes without saying. So, I would assume.
Most of the Indian people are driven by other factors also. Maybe a particular community. They go by, rather than the developer, credibility, etc., weightages to be given, they would give up to more freebies or discounts or the price factor. So it's better that they get.
I think markets are maturing to a large extent. I don't think we see that
anymore.
Although
I'm becoming a Jain, I would very clearly tell that the Agarwals and Jains and Mehtas, etc., all get very much carried away with discounts and offers.
plus a Jain temple inside. No? So anyone else from the panel has anything to add? Please feel free.
No, I think you are.
Thank you.
Wrapping. Yeah. Thank you.
Thank you. Thank you so much. Thank you very much.
Thank you.
Thank you. Please request you to present mementos to the panel, Mr. Raghavan. You can choose. Well, there are two Ashishes on extreme ends, so now you'll have to decide which way you turn. Well, we decide which way the market turns. We never really know. So, all right, he's going to turn to his left. All right, to Ashish Raheja. Moving on to Yash. Managing Director, Country Head Heinz. Moving on to your other side, sir. Avnish Singh. Ashok Shajjar. And now Ashish Kandelia. May I please request Rishi Kapoor, Secretary ET Edge, to do us the honors for our moderator for this session, Balaji Raghavan. Very quickly, may I have a memento photograph of this panel, please? Ladies and gentlemen, a big round of applause for this panel. Thank you, gentlemen. While you've been listening to the panel, we have quite a house here. I'm sure you must be wondering also who's going to drive home in the Porsche, or who's going to drive the Porsche at some point or the other. To tell you more, it's my pleasure to call on yet another Ashish. He's the marketing manager for Porsche, Ashish Bosman. Ashish is going to step up on stage and let you know about the draw and its details.
It's Kurush Sedhwa.
Kurush, are you here or are you going to miss your chance? Oh, Kurush is here. Congratulations, Kurush. You're going to have a good drive. Thank you, Kurush. Thank you, Ashish. We already had a backup in case Kurush was not here, but Kurush waited for his drive. Enjoy it, Kurush. Ladies and gentlemen, I do hope you enjoyed yourselves today. We come to the conclusion of India Real Estate Investment Summit 2014. The summit has more than done what it pretended to do. We had a great deal of discussion out here. Lots of myths were blown away and lots of views for the future. With this, I'd like to thank you all, one and all, for making it very special. Most, of course, especially our speakers, our moderators, our panelists. And not forgetting our partners who made it very special, our silver partner, most especially MMR, our associate partners, Aryan Superstructure and HDFC Realty, our supply partners who include FIFA, AIBI, and also APREA, our knowledge partner, JLL, and of course for keeping it on the web, 24 Frames Digital. Ladies and gentlemen, until we meet again, thank you for being here, making it very special on behalf of ET Edge and Times Conferences Limited. You are fantastic. That's all for now. Good night. Thank you.